a great indicator for measuring volatility and using it as part of your overall tools to buy and sell a security at the right times is one of my favorites, which is the Bollinger Band. And I love Bollinger Bands because they're named after me, Steve Ballinger. Well, they're not. They're named after some guy named John Bollinger. I wish it was named after me, but so you can see it's Ballinger versus Bollinger. Okay, great. But it is very, very popular and useful as a volatility measure. So let's look at Bollinger Bands and how they're used. And they're very easy. Once we go through this lesson, you'll find that they're very easy to understand and apply. So I think you'll like Bollinger Bands as well. So kind of what are they, right? So it's a simple but powerful calculation, that's going to be put on top of your chart here. When you're using your trading platform, you just choose Bollinger Bands and it'll show this nice graphic. And we're going to look at some here in a moment here. So you get a feel for what it looks like and how to trade off it. But basically what it's doing is it's taking the 20-day simple moving average, that's moving average line, and that simple moving average of closing prices. And then that's kind of like the main kind of line. And then there's a band on either side, above and below it, that is two standard deviations away from that simple moving average. Standard deviation looking at that deviation from a mean or from that, from that simple moving average. And so the bands are going to show those relative highs and lows in the context of that moving average. So they're going to kind of travel together. There's going to be one below, or excuse me, one above, one below, and you're going to have that moving average kind of going along, and they're all going to kind of travel together. But then they expand and contract too, and that's very important. So in effect, the bands are moving standard deviations that you can measure volatility and use to trade off of as these go forward. So let's look at an example of a Bollinger Band so you can kind of see what this looks like, and it'll make a little more sense here. So here's just, this could be anything. It could be any security, because the Bollinger Bands are going to look the same, or they won't look the same. The pattern won't be the same. The patterns will all be different, but how it works is the same. So you can see we've got our price bars, our up and down black and red price bars, our volume on the bottom there, going left to right as far as back in time to more near time. And you can see in the middle there, we've got this dashed line or a dotted line, kind of this dotted line going through the middle of these two bigger bands, these two solid lines, one above and one below. Middle line there, that's our 20-day simple moving average, right? And then the two standard deviations above and below as that moving average goes forward is the high and the low of those Bollinger Bands. And that can tell us quite a bit as far as now, if we see this, there's different things that are going to tell us what to do in terms of trading. And that's what's really important too. But get a feel for what these kind of look like, and we're going to show you actually how to trade off it. So one thing when you're looking at Bollinger Bands, you're looking for walking and squeezing. Oh, that sounds like fun, doesn't it? So a price touching or slightly breaking a band, like an upper or lower band, is a continuation signal of a trend, right? That's a good thing, right? Remember the kind of that whole classic phrase, the trend is our friend. We want to identify and know trends. So when it's touching or slightly breaking that, it's called walking up or walking down the band, those upper and those lower bands. So during an uptrend, walking up the band, the prices are hugging that top line. And as those prices start to exhaust and those higher highs are not being reached, you'll start to come off that. And the price will start to move down towards the center, down towards that simple moving average, and then possibly beyond it down towards the lower band. So when it's hugging those bands, that's showing us that's a continuation signal of a good trend. That's telling us, hey, the trend's there. We could either buy into that trend, or if we're already bought, we want to stay in that trend, depending, again, whether it's an uptrend or a downtrend. For walking down the band, it's just the exact opposite. It's on the lower band, hugging the band, and then if it comes off that band, the prices are going to start moving up towards the middle. So it's just basically the opposite. So walking up and down bands are great continuation signals of a trend. The trend is established, and then it's going to continue on. Now squeezing, as these bears are squeezing here, when bands contract, so the overall bands are getting closer together. And I'll show you this, don't worry, just in a moment I'm going to show you this. But it can show that traders are indecisive. There's not much standard deviation. In the price range, there's not much difference in prices. So things are starting to contract and traders are indecisive. And they're not willing to go to new highs, but they're also not willing to go to new lows either. Everything's starting to narrow out. There's less volatility. It's narrowing out. It's squeezing together. And that's what's going on here. The narrowing of the trading range, the Bollinger Bands get closer together. That high and that low get closer together to the middle, and that's called the squeeze. and implies an impending breakout. It's either going to go higher or lower at some point here, but something's happening. So get ready. Something may happen. Hopefully something good will happen, which would be a new trend, a new established trend. And if it can start walking up a band, that tells us something, or walking down a band, that's that continuation of the trend. The squeeze is kind of telling us that something is, going to be changing. So it's important to know, that when you're looking at Bollinger Bands, are you in a period where things are walking up or down a band? Are they squeezing, or are they in the process of, one of those two things happening? So let's take a look at an example chart here and see what we see. Do you see where it might be walking up the band, right? So the middle is, the dashes is the middle of our band, upper is the top, and bottom is the bottom of the band. So if we're walking up the band, we're looking at our top band. Do you see places on this chart where it might be walking up the band? And then also, as you're looking at that, think about, is there a part where the bands are getting closer together, where they're squeezing together? Otherwise known as the squeens. There might be one definite place, but there's another place where it's squeezing together too. So we were looking for walking of the band and squeezing of the band. All right, let's take a look and see what we see here. So I would say if you look at it, you can see how the prices are touching or exceeding on the far left. Let's start at the far left. You can see where it's walking up the band, right? Prices are either above or touching or close to that band. So that's walking up the band, and you can see it's a continuation of a trend. This is definitely an uptrend, actually a nice strong uptrend, looking at where it starts. And so that would be an indicator to me, depending on when I get in onto this trend, I'd say, hey, this trend is strong, it's looking good, market sentiment, the volatility is all looking good. I'm going to hang with this trend. I'm going to buy in, I'm going to hang in until I start reaching that peak there. And you see how it starts to come off the top of that, off the Bollinger Band at the top, and starts turning red, the price bars, and starts going down. That would be a pretty good indicator that even after first day or two, that I'm definitely off the trend. I want to sell now, because it's definitely off that trend as it moved towards the middle. If we keep going to the right there, you can see the squeeze now. This is a pretty good example of a squeeze. It's almost like a snake, right? Where there's got a thin middle there, maybe it ate a couple things, so it's wider in two parts in this snake. It's digesting lots of stuff. But you can see where it's squeezed together. The upper and the lower band are squeezed together very close to that middle where the dots are. Where we were walking up the band, see how far away they are? Here we've squeezed together. Now squeeze is telling us what? Tells us we're in a narrower trading range, less volatility, traders are indecisive, they're trying to figure out, should we go higher, should we go lower? There's a little bit actually touching on the bottom of the squeeze there where it touches the band for a little bit, a little walk the band down there, but it really stays in this longer time frame of the squeeze. Okay, so what happens at the end of a squeeze? Do you see it? There's a gap. Do you see it at the very end where all of a sudden it jumps up to the upper end of the band and starts to go up from there? So that's a breakaway gap. If we learn about when we talk about breakaway gaps, and now we see a breakaway gap, we see the next day that's kind of confirming that. We're looking at our Bollinger Band as another confirmation of a breakaway gap. See how we're using multiple things together. And now we're on a walking up the band again, and I'm going to walk up that band, and I'm going to sell once it comes off that band. And then kind of repeat that process with the squeeze and a little bit of squeeze there, and then another walking up the band. It really never really squeezes that tight. It never really even gets all that way onto the simple moving average right on top of it, or crosses the line. Another way you could use this with moving averages, did it cross the simple moving average line? So this is where you can use these types of indicators together. And we saw a little bit on the far left, there's a little touching of the lower band at times. It doesn't really walk it for very long, but if it was this is a particular case where it's a real strong uptrend, so we're really showing walking up the bands, walking down the bands would look different. Let's look at another example real quick that has some, a couple more examples just to reinforce this here. So again, look for walking of the band, look for there are some definite cases where they're getting closer, touching to that, walking down the band more than we saw in the previous chart. And do you see, a squeeze? Do you see the squeeze in there? So you might see where things are going walking up and down the band here. This is happens to be for Procter & Gamble, consumer products stock. So we look at the far left, you can probably saw there, right, where it's walking up the band. We have a nice little gap. The band is, comes off the band, a little bit, but it walks it up a little bit. And then we got some volatility there, some ups and downs, some big downs there. You see those, as we move to the left to the right, or the right to the left, you'll see those red candles coming right into the squeeze. It gets very narrow, actually touches the bottom band a little bit, walks down the band a little bit, but it starts to really narrow. People are indecisive. Then it starts to get above that simple moving average. That's a buy indicator when our prices get above that simple moving average, as we learned in the moving average lesson. And then we get on that up, walking up the band, and we have that nice strong trend up, walking up the band. And then as we go to the far right, you'll see where it walks down the band a little bit, and another squeeze is forming and starts touching the band a little bit. And if you see in the middle there too, I didn't label it, but you've seen in the middle that really long red one right in the middle there with some volatility to it. That's a real outlier, right? It like in one day the price went, as far as the price range, and the price itself, started above the moving average line, moved above the Bollinger Band line that was an opening price. We know it's opening because it's a red candle, and we know it closed lower because it's a red candle. And so we know that opening price was above the upper Bollinger Band, in the price range even a little bit above that on the high, on the upper shadow. But then it went way down. Something happened. It went way down, not only past the upper Bollinger Band, but past the simple moving average, way past that, and then almost getting towards the bottom band. So what a crazy day. So if you're a trader, you might be like, one, you might not be in this at all because it's not either walking up or down a band the day before. It's right in the middle. So you might be on the sidelines at this point. And then this happens and you're like, this would be a good opportunity to say, what's happening here? I need to let this develop a little bit more. And you let it develop, and it's kind of staying in the middle there, and it starts to move up, but it never really moves up or down until it gets to the squeeze. Well, there's a walking down the band before the squeeze on the far right. But you can see by using our Bollinger Bands, we can kind of measure that volatility. We can see where there's a big market volatile moment here, and our prices kind of match up with that. But we can, take our action based on these indicators around that. So if you look at Bollinger Bands, you can see that they're very easy to kind of, observe and look at, right? I'm looking at the upper band, that lower band, that simple moving average. I can apply it to any type of security, and all that, in any type of time frame too. And it really gives me a good indicator around that. And I think it really looks good as pairing it with another indicator too, to get that confirming, either as a primer or getting another one as a confirming signal, or using the Bollinger Band as a confirming something you're seeing, and using Bollinger Band to get an understanding of volatility and that market sentiment, and using that whether you're walking up the band or walking down the band, or maybe just squeezing together. Bollinger Bands, they're a lot of fun. Wish they were named after me though. In this lesson, we're going to talk about Fibonacci as a trading indicator. And I tell you, as trading indicators go, this is really highly debated in the trading world. Some people love it, absolutely love it, really believe in it, embrace it, use it all the time. Others like, I don't like this at all, and they don't use it at all, and they just think it's kind of a little bit, more mystical. And some people think it's got mystical qualities in a good way because it's based on, Fibonacci math. So all of our mathematicians out there watching are saying, "Yay, more math, Fibonacci." And people also, it can be a little bit more of an advanced indicator, by the way. The understanding how it works is not too bad, but then applying it can be a little bit more tricky. And as we go through the lesson, you'll see how we do that, and you can decide for yourself whether that's easy or hard for you. But the big idea with Fibonacci is you're trying to identify pullbacks or retracements. You're trying to see these different support levels and resistance levels. You're trying to, see what might be going on in terms of, mathematically what might be going on in terms of a volatility or market sentiment type indicator. And the trading platform will automatically calculate all these things for you as far as the actual Fibonacci and how you use it. The platform will calculate it for you. So you have to do any math or calculations, and then you take what it calculates and you overlay that on top of the chart. So that's where it can get a little tricky, is where you place it on the chart, and we'll demonstrate that here for you coming up. So first off, it's actually pretty instructive to understand, well, what is Fibonacci? What is it? Where did it come from? What's the big idea behind that? So at its heart, Fibonacci is basically math. It's a mathematical sequence of numbers. As the sequence of numbers described by the mathematician Leonardo Pisano Bigoglio, I might got it wrong, I don't know. But Fibonacci is a sequence of numbers that he discovered and came up with, and it's a very well-established idea in mathematics. Basically what you do is you start with a 0 and 1, and then you add each number in the sequence to the previous number to get the next number. It's a sequence of numbers. So if you look at the example here, this is the Fibonacci sequence. It's 0 and 1 is 1, and then 1 and 1 is 2, and 2 and 1 is 3, and 3 and 2 is 5, and so on as you keep going on out into infinity. So that's how it works. It's a mathematical sequence of numbers, kind of interesting that way. But how does that work for trading securities? Like, okay, that's nice. Well, if you look at your Fibonacci, if you take how it's applied in trading, actually, again, you don't have to calculate this math, but it's good to understand the underlying why, because these numbers that you're going to see highlighted in the yellow are going to be important to us when we start actually using in trading. But basically with Fibonacci, if you take any two adjacent numbers in the sequence and divide the lower number by the higher number, and you keep going, and you'll keep going, and you'll this calculation, and you'll approach the ratio of 61.8, is where it approaches. So an example, 5 divided by 8, two adjacent numbers, 5 and 8 is 0.625, 8 is next to 13, 0.615, and everything starts approaching this 61.8 as kind of an accepted average for Fibonacci. And then you do the same, but instead of using the two adjacent numbers, you use two further along the sequence, and they get close to 38.2. So it would be like, let's say instead of 5 and 8, it would be like, say, 5 and 13. And the same thing with 3 further along, it would be 5 and 21, for example, as you go further along. And these are 38.2% and 23.6%. So those numbers are actually very important because they're going to show us when we do our Fibonacci overlay. These are important numbers that we're going to use for making trading decisions on. So when trading, the key numbers are 0, 76.4, 61.8, 50, and these are all percentages, 50%, 38.2, 23.6, and 100%. And the levels, these are the key numbers that they use, and we're going to talk about why they were chosen in just a moment here. But the levels are calculated in relation to the vertical distance between the high and the low, looking at it as a percentage basis. So it's a 0 to 100% is the full trading range of, let's say, a security. And then there's percentages based on between 0 and 100%. Again, these are not prices. It's not 61.8 rupees or dollars or whatever it might be, euros, or 38.2 or anything like that. It's a percentage. 61.8% would be an example of a number in our trading range as using Fibonacci. Now, first off, you might look at that and say to yourself, well, wait a minute. Not all of them are truly Fibonacci. I saw some of them were, but not all of them were truly Fibonacci. So let's talk about that for a second. So the 0 and the 100% represent the high and the low price, the high and the low price. So we need that to kind of use that from a trading aspect, so even though it's not truly Fibonacci. 50%, you sometimes see in there, sometimes it's out of there, sometimes it's in there depending on your trading platform. But 50% is based on another theory, actually, it's a Dow theory, that says a trend has a good chance of continuing once there has been at least a 50% retracement in that. There's a 50% turns around, you can see that the trend will tend to continue, and once that retracement of 50% has happened. So that's where you see the 50%. I'll talk about that more in a second here. And then 76.4%, not Fibonacci, but it's basically taking 100% and subtracting a Fibonacci number, 23.6. And that kind of developed over time by Fibonacci trading supporters. They wanted that number, and there is another indicator, another level to look at. So that's where they kind of came in. So you have true Fibonacci, and then trading over time has kind of developed to add a little bit more to it to make it more of a complete indicator is the idea behind it. So the idea is, in the theory behind trading Fibonacci, is if a security has shot up over a period of time and is starting to pull back, or starting to pull back, there will be support at the Fibonacci levels, below that high. So if it's gone up and starting to come back, you have these different Fibonacci levels that we just talked about, and then as it approaches them, there's a chance it's going to rebound and go back there. Likewise, if a stock has fallen and bounces back, starts to bounce back up, you'd see resistance at the Fibonacci levels, as far as seeing resistance to going above a Fibonacci level. So it's looking at going above and below, looking like at those support and resistance lines. So using the concept of support and resistance lines, you're basically adding that into Fibonacci levels. So we'll take a look about how that's actually applied here in these graphs here, so you can kind of see that a little bit better in action. So this is just a diagram here. We have our prices actually on the left-hand side. You can see it started at 15, whatever units you're using, euros, dollars, whatever. But it started at 15, and then our time goes from left to right still as normal. But in the most recent time is to the far right. But here where we see on the right-hand side are the actual Fibonacci levels, or some of the Fibonacci levels we're highlighting, 100, 61.8, 38.2, all the way down to 0 there. And remember, the levels are based on the trading range over a period of time. So if I choose a period of time, and I can choose that period of time when you're using trading platform software, where the Fibonacci levels are going to automatically calculate and need an overload on top of that. So if we simply looked at just a little bit of this here, you can see as we looked at that top, where it's at 100 there, that's telling us that's really at a high Fibonacci level, that we're probably not going to go above 100. That's really a very, very strong indicator, and that we might want to sell at that period. By the same token, as we come off that level, and now we're in this more of this trading range up and down, but as we approach that 61.8, that's kind of a support level that's going to support and say, no, we're going to rebound off the bottom of that. And what might then start off the chart as far as what happens over the next days in the future, we're thinking, okay, it's kind of gone a little bit below. As you can see, the little tick mark below 61.8. Now we want to watch to see if it really is more of a support and really tries to go back up, or if it's going to break through that and keep going down as far as that. So you can see there's a couple times when it approaches the support line, that kind of bluish line there at 61.8, where we would be buying, right? It's approaching it and I buy, and I'm not selling because it's still in between, but then it comes down again, there's maybe another buying opportunity. And so we're watching the Fibonacci levels, looking for it to break through and pass through those levels, or bounce off those levels. Basically, we're watching for it to bounce off those levels. Now, if you look at the 15 going to the right, you should see and say, oh, wait a minute here, it's actually gone through those levels. It started at 15, kind of bounced along the bottom along that zero range level, that 0%, but then started going up, and it went up to that 23.6, that yellow line, and just burst right through there. They didn't care at all. And then kept going up, went up to 38.2 and burst through that. It looks like 50% there in purple, and then well past the 61.8. And it just like burst through all those things, broke through all of those. So you can see that the strong trend is going to blow through these resistance levels, these things that resist going through them. And then it gets up to that resistance level of 100 eventually, and then starts coming back down. And then we're looking at the bottom would be support levels. But you can see that when you're watching with Fibonacci, you want to be watching, is it truly going to break through that level, or is it going to come back down off it? And we might use our trading based around that, whether we're putting in a stop loss or we're putting in different types of market trading mechanisms we'll look at. But you can see that's just an example of how that would happen. And one way you can look at that too is the deeper the move, the stronger the Fibonacci indicator. So if we looked at that and we said, okay, 23.6 is not as deep a move, right? It's not as strong a move as, let's say, 38.2 or certainly 61.8 or 100. So there's a better chance that it's going to break through a 23.6 level going upwards than it would, let's say, through a 61.8. By the same token, if it's coming down, like off that top near that 100, and it's coming down to that 61.8, there's a better chance it's going to break through 61.8% going downward versus, let's say, going on down to 38.2. So you can kind of use that as a gauge in terms of strength of what might be happening with this Fibonacci sequence and using this Fibonacci indicator. And so that's why it's best to use Fibonacci, I believe, as a confirming tool with another indicator, right? Now, some people just trade Fibonacci levels, and they just truly believe in it, and that's okay. Trading with something is better than nothing, at least something more proven like Fibonacci, but I think it's just best to use Fibonacci with another thing to help confirm it. And then again, you set the time frame, and then you overlay the Fibonacci on the chart, right? So you're the one deciding how many days we're looking back at, and it's going to change your chart and what you might trade based on how many days you look back. So let's look at that with a live, real example here. So if we look at this as a real security here, and I've set the look back period over for 45 days. I know this is periods. I happen to choose days. If you're a day trader, you might choose this as 45 minutes for your Fibonacci level. It would actually come up with this kind of the same thing if this was within, let's say, a day time frame. But I'm choosing 45 days. And you can see where the blue lines, that's when the 45 days look back goes. I had it set to start right at the kind of the peak there of that of the highest peak. If we were to go back, we could go back another 45 days or go back 90 days or 180 days. Then I'd be capturing more of this longer chart. But with my Fibonacci setting it at 45 days, you can see I'm really starting at that peak, and I'm looking at that to see if I've got a resistance level at 100% and seeing what happens from there, and seeing what what has transpired before. The current day price would be on the far right there. You see where it says 64.83. So that's what I'm trading at right now, or what I could buy in, let's say, at right now. But you can kind of see how it bounced off that 100% level and then it started going through more levels. You see we've got long red candlesticks, so that means it's closing lower than the opening. A little bit of, and then towards the bottom, we have a little bit of a trading range in there between 0 and about 38.2%, but now we've gone lower too. So if I was to look at this, interpret this, I'd say, okay, I'm pretty down low, close to my 0 now, at 64.8. It might be, a better chance for an upward move, and I can see even the whole range of that would be up to 75 units or $75. Let's use dollars. As far as that's the number to the right. The first number is 100%, 61.8%, but you can see at the top where it's 100%, that's where we're at about 75.10. So this is looking back over 45 days, and I can base that saying, okay, I can see I've got more upside opportunity maybe than downside opportunity, but I would want to use maybe other indicators to confirm that. But let's say I changed that and I said, I don't want to look all the way back to 45 days. That seems like ancient history now. We're definitely in this more narrow trading range. Let's look back less time. So now I'm going back to more of that trading range, a more narrower range, looking back over 26 days. Because this is really kind of more the range I'm in kind of right now. It had that high, which is a good, $75 might give me an idea of potential. But right now we seem to be stuck more in this range between like $67 and $63. So if I look at it that way, you can see now, and it's a little hard to see when you overlay these sometimes with the volume bars and stuff, but you can see I'm right near that, that 38.2% would be the second line, blue line from the bottom is 38.2. Then it's a 50%, and then you can probably see the 61.8 pretty good, then certainly the 100%. So at 64.83, I'm just right around that 38.2%. Not much more to go break through those other levels, the 50 and the 61.8%. So that would get me up to 60, around $66. It looks like the 66.49, or excuse me, no, it's not that. It's like 65.49. Excuse me. So that's where it can get a little harder to read. But you can see I don't have much to go to break through those upper levels. But I could see all my potential might get me really more towards the 67 if I was looking at this. But the same idea that I'm more towards the bottom part of my Fibonacci, more to the bottom part of these levels. But if I look at it here, I've got more ways to go from the 38.2 to 0 percentages than when I was looking at over 45 days. So that's where the key part with Fibonacci comes in, is setting your time frames, and where you'd want to learn even more about it is around setting time frames. And you can see the concept I'm using here is trying to look at more of a true range over the more recent time versus looking back over the entire chart, or certainly at the peak, and how that changes my Fibonacci levels. And so if we look at both charts side by side and say, well, I want to make a buying decision at the 61.8 level. Let's say once I go above, once I'm below, and I go, I've decided my rule is I want to buy when it hits 61.8 and breaks through that's resistance level, then I'm buying. That's what I'm buying in. Let's say that's what I want to do. I don't want to buy 38.2 because that's not as strong. I want to really have a stronger indicator, so I want to buy at 61.8. So if you look at the longer time frame, the 45-day time frame on the left, and we have the 26-day time frame on the right, you can see that I would be buying at 61.8 once it got up to $70.53, up from 64.83 right now. If I look on the right, I'm still buying at a 61.8 level. It's just I changed my time frame. I'd be buying at $65.49. So what does this say? Is one better than the other? No, it's just different time frames. But you can see that if I'm using these Fibonacci levels, if I have a longer time frame, I'm going to establish more deeper resistance levels, or I'm going to have to prove that price is going to have to prove itself to break through these levels more. And so I'd be buying in later at 70.53. You can see I gave up $5 worth of gains per share of the security by waiting till that. But I would feel more, if you're a more, let's say, a little more conservative investor, you'd say, yeah, that's fine. I just want to use this with other confirming indicators and really have this be really clear to me. So I'm going to use a little longer time frame that it's really proven the breakthrough that, whereas I might be looking at a shorter time frame at the 64.83. And if we were to talk a little bit more about Fibonacci as in terms of trading indicators, those time frames are real important. And this is this is just some general terms you could use for a trader's name, a scalper all the way up to a carry trader. There's different ways you can do an active trader or whatever. This came from a nice source that I would point you to under tradingfibonacci.com. I have no investment in them or any connection to them other than I think they're a good site about learning more about trading Fibonacci and really getting into Fibonacci. Now, if you go to that site, understand they're focused on Forex, so they focus a lot on Forex, but they also work in stocks and cryptocurrency too a little bit, but their basis is around Forex. Again, when you're using technical analysis, you can use these tools, Fibonacci, whether you're trading Forex or cryptocurrency like Bitcoin or stock. Those things will all apply. And so when you're setting your time frame, you can see the different time frames. Scalpers looking at seconds and minutes. They're just trying to make really a lot of trades real quick. Day trader minutes to hours, and they'll close out at the end of the period, and so on up to carry trader might be looking over 1 to 12 months, right? So you would be setting your Fibonacci levels to kind of match up with maybe those time frames or with those time frames. If I'm a day trader, for example, I'm not going to look over weeks and months. I'm going to look at minutes and hours when I'm looking at my Fibonacci levels. So Fibonacci as a trading indicator, passionate debate for sure. Supporters say it really works and they believe in it and they embrace it, and a lot of them just use only that, and I caution on that, but they do. And so the supporters really believe it and love it and use it. Detractors say, come on, it's just a sequence of numbers done by some old mathematician guy. It's not some mystical trading indicator. In addition, then they do make a point, it can be hard to draw the lines on there, hard to see and interpret them, and understanding what days, your length, your time frame can be a little bit more tricky or advanced. So there is a point there, but that doesn't mean it's not a good, that doesn't work. It just means you have to be a little more practiced with it. So, and sometimes you have things in technical analysis, I think Fibonacci is one, where it can be kind of a self-fulfilling prophecy, right? Where it works because enough traders are using it and they believe in it and act on it. So when a Fibonacci level is being approached or being broken through, there are a lot of people who believe in Fibonacci who see that and are doing things based on that. So when that happens, that means they're buying or they're selling based on that, and that's going to actually almost prove the indicator that the indicator is going to work because people are using it. I mean, if we said that every day is a sunny day and stocks or securities or cryptocurrency always rises on sunny days, well, heck, if it was a sunny day, then everybody'd be buying, right? Cloudy days, I guess we'd sell. So that's a little bit unfair to Fibonacci, by the way. It's a lot more detailed than sunny and cloudy days. But you get the idea where it can be a little bit of a self-fulfilling prophecy. And if it is, that's okay. That means we can use it as a real trading tool. And the reality of all this is that any indicator can work some of the time, right? But not all of the time. There's no foolproof indicators. And that's why it's good to pair with another indicator for confirmation. I just really strong on that, especially with Fibonacci. I really believe that. Just using another indicator and then confirm with Fibonacci, whether it's moving averages, candlestick charts, whatever, candlestick price patterns, whatever it might be, just using more than one indicator can be real helpful, particularly with Fibonacci. But if you like to trade Fibonacci, that's fine too. That's where back testing and paper trading can really help to see how your success is. If you're trading only Fibonacci and it's not working out, well, then you just need to change your plan and maybe add a second confirmation thing would be maybe a good thing or a good idea to try. Now that you understand how to use a lot of these different types of tools or indicators, this is an extremely important lesson. Sometimes it's this type of lesson that separates those who are going to succeed from those who might not succeed as much. And really what you want to be looking at is how do we combine the tools for better returns, right? Which combinations or how many should we be using is really the question we're going to ask here in this lesson for you to take away and think about how you want to build up your strategy as far as being an investor and a trader. So first off, think about using more than one tool instead of depending on one tool. Using one tool is better than no tools, right? It's better than guessing, or I like the color of their logo. One of the ways people invest. Using one tool is better than no tools for sure. A sweet spot seems to be when you start using at least two tools. Two tools is better than one. You really, what we're thinking about here is having like a primary tool that you really use all the time to kind of identify, buy, and sell opportunities, and then using another one to kind of confirm that. So they kind of match up that way. And we'll get in a little more detail on that in the next couple of lessons here. But that's the idea, is I'm using one really to determine things as a primary, and then I use another one for confirmation. I could go up to 3 to 4, maybe that's okay too. It's even more confirmation around that. those we see there's a little bit of element of diminishing returns, but you need to know more indicators very well inside and out. But you can go 3 to 4. But you start using 5 or more, that's a little too unwieldy. You can be aware of all the stuff, like we've learned a lot of different tools in the course, and so you can be aware, like, oh, I see something, maybe I should look closer at it, but it wouldn't be necessarily a primary tool for you. And should you use all the tools and all the other tools in the wider indicator universe out there? Well, no, that's just crazy talk. So let's talk a little bit more about that as far as how many tools to use. One reason you want to combine these tools for better returns, and it's really a core concept of technical trading actually, is the primary on its own, while better than none, can be wrong. As we know, you can have false signals, you have noise out there, you have whipsaws, you have all sorts of things. And so nothing's foolproof, so it can be wrong. And so a real good way to do it is having a primary indicator that you primarily use, and then having a confirming secondary indicator in using them together to confirm that primary one is much less likely for a false signal. You're not getting a false signal on one, you'd have to be getting a false signal on two, for it to be kind of not as strong an indicator. If you add a third or fourth indicator, that starts to add some complexity and possibly some diminishing returns. Not impossible, you can do it. I would say starting off, if you're newer to this, certainly start with 1 and 2, use a primary and a secondary. But if you start adding some of the simpler third or fourth indicators, you can do that, but there might be some diminishing returns. And the reason for that is you start now, maybe using various inputs or time frames, and that can always be tricky as far as different time frames that work better with different types of indicators. There's various trading rules that you establish, as far as when you're buying, when you're selling, and adding more complexity to it would be, adding a third and fourth indicator. It's hard to become really rock solid and really knowledgeable with so many tools, trying to use them all the time, every day, or every time you're trading. Great to be aware of it, very important to be aware of it. There's unexpected opportunities that come up with, so you might see something rare like an island reversal, as we learned in our gap trading section here, but you're not going to be necessarily using that as a primary indicator, for example. If you are, that's great, just find a secondary one, but to confirm it. But it's hard to be an expert when you have too many tools, so you don't have to worry about that. And you can experiment with the different tools you're learning in this course, with your paper trading or back testing, and see how you want to use that. And then indicators can be in conflict. A lot of times they don't confirm each other, but they might be actually opposite, and that can happen. So that can confuse this thing too. And as you add more indicators, that's more likely. So I would say a primary and a secondary is really core. A third is fine. A third can be okay, especially if you're feeling real comfortable with all three. That's great. Fourth, you're really going to be extra level. That's okay. But you understand you might be experiencing some diminishing returns if you start seeing your performance go down as you start adding an indicator. Then you might want to back off and go to 1 or 2 or possibly 3. And then 5 or more, no, that's really not advised. I mean, again, being aware is very important, and being aware of things like different chart patterns or candlestick patterns or whatever it is. Being aware is good, but using it as your really primary way of trading and trying to, every day is like a whole new day as far as using the indicators, that's not really advised, and that's not going to help you to be successful. And you might be thinking, well, is there one dominant strategy? Is there one, like, tell me, should I use this with this candlestick, with this moving crossover, price crossover of a moving average, or something like that? Is there one dominant strategy? No. If there was, then everybody would be using it. So there is no dominant strategy. Plus, this would be a real short course. It'd be like 3 minutes. Just use this, right? So there's no one dominant strategy. Now, there are some classic examples that are more proven. For sure, that is true. In some ways that they work better together, and we have upcoming lessons on that. It's going to look at these classic examples, but also how to kind of put it together too. When, let's say, if we're creating your own type of, kind of combining of the tools. And I think that's a good way to do it, actually. You can start with some classic ones, or you can look at classic combinations, but then think about what you learned in the course and really kind of gravitate and create your own. What lessons really sung out to you? What really did you really grasp quickly or feel real comfortable with? That's a good indication that might be a good indicator for you. Remember, all the indicators are good. There's no bad indicators, just some might be better than others in different situations, and as we'll learn later lessons, that some are better as far as being complementary to one another. So that's coming up. What are you comfortable with? What are you excited about? What you might have an indicator like, I love this, I want to use this every day, and then it makes sense to you. If you're using an indicator because you feel forced to use it because somebody on YouTube or somebody on a forum said you got to do it this way, and it doesn't really make sense to you, or you don't really buy into it as much, then skip over it. Pick a different indicator. Everybody has their favorites, and more importantly, things that work well for them. And that's how you can really test to see what's working well for you. Where we talked in the earlier lesson about back testing and paper trading. Just a reminder around that, back testing is for free. Most platforms offer that for free. Almost all of them do, or they have some sort of that. If they don't, you might want to look at a different platform, I suppose. But where you can back test things, where you can look at the indicators that are of interest to you, pick a primary and a secondary, maybe a third or fourth, and then you can back test that over historical data, real historical data, to see how that would have worked out. And you can start seeing if it's working for you as far as the actual performance by back testing it over historical data, real historical data. And then paper trading is basically trading with fake money, right? You're not investing your own money. So you're paper trading with this kind of fake account and fake money that you can set up with. It's called a paper trading account. So there's another way for you to try out, different indicators and what's working for you, what you feel comfortable with. Once you start really looking at charts and applying these indicators, you're going to see some that are going to just really make sense and really, you're going to gravitate to. So use paper trading to kind of practice with that as well. So figure out and create your own is good. I'll show you some classic combinations upcoming, but really think about back testing and paper trading can be very, very powerful as far as, doing what you love to do. Remember, in the end of the day, you've got to be two things. You've got to be successful as far as with your trading. You want to be successful with your trading. That's most important, or very important. If you're not successful, then that's going to cost you a lot of money. And so you want to be successful, but you want to enjoy what you're doing too. Don't feel forced into something. You want to have it make sense, that you enjoy it, that you're having success, and having that great attitude towards your trading, and that you're having financial success with it too. And that's the real whole key to this too as well, as opposed to, let's say, finding a magic indicator or being forced down a certain path. So combining indicators, very important. Certainly you have a primary, and very good to have a secondary. 3 or 4 okay too. Get more than that, that might be aware, but that might be a little bit more of a caution sign. So how can we apply this concept of combining different types of indicators? And that's where we call the term validator indicators are. You're validating something. So kind of how it works is you choose a primary. This is your ruling concept. This is the thing you're really searching for when you're out there evaluating securities. And so you have this primary indicator that you use all the time. And then you have a secondary indicator that comes into play once your primary has maybe found an opportunity, and your secondary is going to be kind of the confirming or say, yes, that looks good to me, the secondary indicator, so it's a go or maybe a no-go as far as investing in that security. So for example, you might use a simple moving average, crossover rule as the primary. Real easy, right? You see the price curve above the line, below the line, as we learned in that indicator. So you're using that as your primary, and you're really out there looking for those types of situations, and you're watching for those. So that's your primary. And then you might use, let's say, for example, a momentum indicator like the RSI to confirm what you're seeing with that simple moving average. So your RSI is saying, yes, this is a buy or a sell opportunity, and then it's kind of confirming what you're seeing with the other one. So that's 2 indicators working together. You can add a third or fourth too, but it's to start with like 2 indicators together. And then you take action like buying or selling, or sometimes, very often actually, do nothing until the situation lines up where your primary indicator is strong and your confirming secondary indicator is confirming that primary. It's validating, it's a validator indicator, and confirming that, that indicator, and then you're making a stronger choice with that. And then around validator indicators, it's important to choose them ahead of time, right? You're not doing this on the fly. You're not doing that simple moving average and say, oh, today sounds like a momentum day, or I feel like a volatility measure today, and what about those Bollinger Bands? You're going to choose them ahead of time because it's part of your overall strategy. It's part of your overall setup as far as trading. So those secondary ones, you're going to choose ahead of time, and you're going to decide how much emphasis you're going to put on that secondary indicator. How much of a validator is that for your primary? And you could put a strength measure behind that secondary indicator. Like here's a simple one. Like if the validator indicator says yes, the same thing, it confirms it fully, it's a go, take action. Or it could be a hard stop. Like if it says no, the confirmation's not approved, I'm not trading at all because I need to have that confirmation. A yellow might be a warning sign as far as, am I going to take action or not? It might be close but not fully, as far as maybe that secondary indicator. Maybe it's giving some signals, let's say as a buy signal, but it's not fully you're still not fully comfortable with it. The key in this, again, is the choosing ahead of time, that what is your secondary indicator and what are you going to do when you get that measure? Are you going to make it be real strong, as in a go or no go, green or red, stop, go or stop? Or will you give a little bit more flexibility around that secondary indicator in terms of your primary? And that's a key thing with validator indicators is once you've established your plan, be disciplined and follow the plan. One of the keys to success in trading is discipline. The whole idea of trading with technical indicators, or technical analysis and indicators and other tools, is that you're taking emotion out of it. You're following a plan, you're following mathematics, you're following things like market sentiment and herd mentality, all these things we learned about. So if you don't be disciplined, then you're kind of wasting a little bit of it. So be disciplined and follow the plan. And one thing that a lot of people trip up on, and as a warning, is once you establish your rules, don't change them to make something fit. Sometimes you might see this great strong primary indicator, say, oh, this looks like a buy, I can't wait to buy, it's so good. Let's see what the secondary says, and all of a sudden it's like, wah, wah, wah. Your secondary doesn't validate it. It doesn't confirm it. And you're like, oh, but I really want to. Maybe if I just change the time frame on the secondary, or I change a parameter on it somehow, then I can kind of make it fit. All right, well, if you're doing that, you're not being disciplined. You're basically now adjusting your rules to fit a certain situation because you've maybe been caught up in emotion, or maybe you've been caught up in like a fear of missing out. There might be something more going on there. So just be aware when that happens, that don't change your rules to try to make something fit. Now, what's different than that is you can adjust your plan anytime. You can adjust your plan later, but understand that would be a new plan, right? And you'd be having a new thing. You wouldn't be continually, trying to make things fit. You'd be like, okay, I'm using whatever, this candlestick pattern as my primary. I'm using a simple moving average over 20 days as a confirming. Now maybe you say, I like that moving average confirming, but I'm going to still use my candlestick, but instead I'm going to use an exponential moving average, and instead of being 10 days, I'm going to move that out to 20 days and see how that goes for a little bit, and then I'm going to test that out and all that. So that's it, and that'll be now my new plan that I'm going to follow. That'll be the discipline that I'll follow then. So it's difference between trying to make things fit and trying to, and then later just making your plan better as you go along, because you'll continually keep updating or maybe refining your plan, possibly. Or some folks, they find a great plan after a while or very quickly, and then they're like, this is how I trade, and then they just look for those opportunities, and that's great to be in that situation. Sometimes what happens is you have great unexpected opportunities, and that can be a real good thing. Opportunities are good things, yes? So here we're going to talk a little bit about unexpected opportunities and how to approach them while still being maybe disciplined in your validator indicators. It's so important as far as that discipline. And let's say, for example, and we'll use an example to kind of walk through this concept here for you. So let's say, as an example, you're using a simple moving average, the crossover rule, as your primary. You buy and you sell based on when the prices are crossing above or below the moving average line. And then you're using the RSI to confirm what you're seeing with the SMA. So the simple moving average says buy. I look at my RSI, that says buy. Boom, that's a confirming. I'm going to now make a buy. And then later we'll learn about how to place actual orders and how to budget our money and all those types of things. That's coming up. But basically right now to know is that would be your buy signal, and you're great with that because that's your plan you've got together. And you fully understand things like candlesticks and patterns and all that because you're smart and you took the course. And so you know these different things, but you know that this primary indicator and confirmer has maybe served you well. And so you're watching and waiting for these different trading opportunities using that primary and secondary indicator. And days, the charts go by like gentle waves on a stream, so to speak, or waves on the ocean. And you're looking at your chart today, and the candlesticks are gently moving across. And then all of a sudden, you see this. So you see this, and you're like, oh wait, that's something. I know that's something. That was in the course. That's something. That's a gap thing. That's a gap. What kind of gap was that? Oh my gosh. It's a gap up. It could be a breakaway gap. Something could be happening. I need to, and what you do is you say, well, I need to wait for the trend to develop. The price might drop and fill that gap, or it could go sideways. Or this could be a true price trend up. So I know I have my primary and my secondary. I'm not trading on gaps, but geez, a gap I know is a big opportunity. So maybe I need to watch that, right? So you're watching that. And then what happens the next trading period could be a day, or if you're a day trader, it could be the next hour or whatever your time frame is. And then you see this, and you're looking at that like, okay, there's now another candle that's going upward. Oh, that's a strong indicator, an upward trend. And oh my gosh, I think it looks like a rising window. We have a breakaway gap followed by a rising window possibly. Well, what do? You want to be disciplined, because Steve said you should be, and you just and should you just follow your primary and secondary. But you know what? It's okay when opportunity knocks, go ahead and buy. When there's something this strong, showing out there, I mean, still you're looking at all other things. This is just an example, so you might be looking at other things. In fact, this would be another way to look at your primary and secondary along on top of this as well as almost a third and fourth indicator. But you're seeing this great opportunity. And looking at another indicator, one that's a little bit different than what your primaries are, is not a bad idea either. So you see this gap, you see this rising window, you've got your original primary and secondary, might be a great opportunity, and maybe you put a little bit of money towards that, maybe you put a little bit more. Either way, I want you to still be disciplined, but if an opportunity really comes up, then it's okay to take advantage of an unusual opportunity like that, where it just kind of hits you in the face. And that's one of the benefits of taking a complete course like this, is you are aware of such things, so if it does happen, you can take advantage of it. And the other thing too is if it's clear, clearly like what we see here with a gap and possibly a rising window, others will see that as well and act on it. So that's kind of that self-fulfilling prophecy where other people might be using gap trading as their primary, or other people are seeing this and they're getting in on this too. So that's helping drive the prices up as well. If it's unclear what you're seeing of anything, then stay disciplined. Don't trade it. Stay with your primary and your secondary. Or if you have a third and fourth, stay with that. But if something really kind of hits you in the face, it's okay, to take advantage. You want to be careful you don't start seeing things that can be a mirage or a false signal that can lead to poor trading decisions. Like now everything looks like a rising window or three soldiers or whatever it might be, or gap up and a runaway gap, and an island reversal too. You just kind of understand that too as well. So discipline will serve you well, but it's okay to take advantage of these extra opportunities. So that doesn't mean you have carte blanche to just go like, okay, forget all those previous lessons. No, you just really develop that plan. Be disciplined. When in doubt, be disciplined, but also be aware of opportunities, because when an opportunity knocks, it's good to good to answer that, right? The other thing too, when you have an opportunity like that, if you're measuring your results, and later we'll talk about how to actually measure your results effectively, separate that out. If it's an unusual kind of one-off opportunity, separate that out when you're doing your actual, looking at your results for your primary and secondary and third and fourths. Separate that out as this unusual opportunity, and then just be aware of what happened. And maybe you start seeing your success on these unusual opportunities that occasionally pop up. You're not having success with it. Well, that might tell you that, maybe I need to kind of be more wary when I might be seeing an opportunity. But if you're having success with it, especially if there's some real classic strong patterns, yeah, take advantage of it. That's okay. Just make sure that you're really sticking to your disciplined plan, and that's more of an exception as opposed to your everyday trading behavior. One thing that may seem very obvious, but is actually very important and part of your continuing education after the course, is to become an expert in the indicators that you choose, right? You might have a small universe of indicators that you're really trading on a lot, and really know that deeply. Really, it's a really good idea to do that, to really know those indicators inside and out, really identify with those particular indicators that are in your main toolbox as far as trading. Hug them, love them, really understand to them. And be wary too, if and don't listen to others who say like, well, that's not the best indicator, you should use this. You can see, like in the course where I talk about that all indicators are good, and maybe in certain situations some are better than others, or certain time frames or whatever it might be, and those are all contained in the indicator or tool lessons. But if you're seeing somebody coming out strong on something, just be wary that maybe it's working for them, or the way that they trade, or the time frame they trade, or the types of securities they trade. It might work for them, but it doesn't necessarily mean it's going to work well for you. So you want to be an expert in the indicators that work for you. And even with that let's say primary indicator, that is your primary one that you love and you really know it well, always good to have a confirming indicator, something different to help confirm it too. So you're kind of an expert maybe in more than one type of indicator. Also, some indicators can reflect how frequently you trade. For example, some might be more obvious, or some might be a better type of choice there in terms of ones that reflect how you want to trade, but also what you might want to be learning at as far as becoming an expert in an indicator. Let's look at a couple of examples of that to kind of reinforce that. So as you remember from the lesson on gaps, we have breakaway gaps, pullbacks, runaway gaps. We have all sorts of good stuff in the gap lesson. And some people just trade just on gaps. Now, the thing with trading on gaps is gaps are rare. So that would equal less trading. So if you want to be a more frequent trader, or really trade a more narrow, a smaller group of, let's say, securities, as opposed to a larger group, you might not see the opportunities as much to actually do trading. Though when you do see them, they're great opportunities. Just that gaps by their nature are rare. And as you add more candlestick patterns, for example, then that might equal some more trading opportunities. So maybe I really trade gaps, and that's what I am, but I might look at 1 or 2 or 3 candlestick patterns that I really know inside and out real well. And so if I see a rising window or I see something, then I know how I want to act. For example, here, do you see these candlestick patterns? Do you remember which ones are which? It's okay, you don't have to remember the names. You just kind of have to understand the concept at this point as far as what's happening with them, with whether they're trending up or trending down, or there might be a change in the trend. We'll put the labels on here. We've got the hammer, the hanging man, and the harami. Remember, harami was the pregnant one. So as you learn those, that's where you're going to be more of an expert and really see these happening, let's say on your chart, if you chose to be an expert on candlestick trading, candlestick patterns. And you would see, for example, more candlestick patterns would be more common than, let's say, than gaps. But just understand that might impact how much you're trading. Another thing that can impact how frequently you're trading is the types of security can impact the frequency of trading. Example, things like Bollinger Bands, which is a volatility indicator. The more volatile your security, the more trading opportunities there are, because there's that always going up and down, going up and walking up a band, walking down a band, all that stuff. And that's why things like Bollinger Bands are popular with securities such as technology stocks, and cryptocurrency is popular with those. Same with Fibonacci are popular because of the volatility. It gives them more opportunities for trading than if something is not volatile at all, a utility stock possibly or something like that. It's not going to have as many times or maybe as long a length as far as walking up the band versus something like you're seeing an example here as far as something more volatile, where there's lots of opportunities to trade on that. So understand that if you I like this one type of trading indicator or tool, sometimes that can impact how much you frequently want to trade. Now, if you're not a very active trader, you trade maybe once a week or once a month or whatever it might be, Bollinger Bands might be perfect. And if you're volatile, looking at volatile securities, they're great, they're terrific. But if I'm trading, something that's a less volatile securities, and I'm only looking at a small number of those, and I'm looking, once or twice a month, maybe for an opportunity, because that's the amount of time I have, you might not see as many opportunities, where you might see more opportunities with, again, something like a chart pattern or a candlestick pattern, something that's more common. Let's talk about putting together how to put together your indicator combination. Again, it's not my combination, it's your combination that you feel strong about, comfortable with, and really can know it inside out, right? So let's talk about how to put that together. So step one, you want to pick a primary, right? And again, you can back test this, you can paper trade it, you'll have all sorts of opportunity to practice with it, but start thinking about a primary indicator that you're going to start using. You may have one already that jumps out in your mind. And then you want to pick a confirming secondary, right? So this is all kind of stuff we've learned a little bit before. You pick your primary, pick your secondary. But here's the key part of this lesson, so to speak, as far as putting together your indicator combination, is it's important to have them measure different things. They both are going to be indicating whether it's a trend maybe, or a continuation, or a reversal, whatever it might be. And it's, ultimately you're going to get a signal whether you should buy or sell or do nothing, for sure. But the purpose of the indicators, what their philosophy behind it and their technique behind it is they should measure and do different things. For example, you don't want to have your primary be an RSI and your secondary be a stochastic oscillator. You probably can figure out why that is, and that is, why? Because both are momentum indicators. You're not getting a really true, fair look at it. They're different as far as momentum indicators, and they have their strengths and weaknesses compared to each other. I have a whole lesson on that with those two, for example. But it'd be even better if you had something outside the momentum indicator family to use as either the primary or the confirming. So you have kind of almost that real, two different eyes in effect, but they're indicators, they're not real things, but they're two different ways of looking at it. And if you get that, then you're less likely to have a false signal or something, because not only is my primary showing something, but something that's different family of indicators is also confirming the same thing, that maybe, let's say, for example, this is a buying opportunity. And that makes it a and then you'll feel much stronger in your trades and more confident in that, because you have these two different looks at it. So here's a classic error around that. If you think about kind of similar to those momentum ones, was, a lot of folks will say, well, I love that moving average crossover indicator. And so I'll use the shorter time frame as my primary, the blue line in this example, and I'll use the longer time frame, the pink line, as my secondary, as my confirming one. Now, do you see the error in that? It's a pretty classic error, right? Because if you're using where we're not talking about actually using them to cross over prices, we're talking about crossing over each other. And as we remember from previous lesson, well, the moving average crossover indicator, when they cross over each other and you're using that as your buy and sell, together they are in effect one indicator, right? So I'm not looking at when the prices go above or below the blue line, or above and below the pink line. You could not even have prices on the chart at all. I'm looking at the two lines crossing each other, and that is in effect one indicator. So you'd want to confirm that with another indicator, like the MACD, for example, moving average convergence divergence, or some other indicator to kind of confirm that. So just be aware that indicators are using maybe multiple parts of a chart pattern or candlesticks or whatever. Understand, like this is a good classic example, where you have to use them both together to be the real indicator, and then you need a secondary to cover that. So just be aware of that. All right, as we just learned, we know that having a primary indicator and a secondary that complement each other is always a good, strong move. But there's ways to make that even better, and that's what we're going to talk about in this lesson. So we're going to look through an example of that to kind of confirm or really show how that would work. So let's say you're choosing the moving average crossover as your primary, right? So that's a time you're going to need to choose within that. You're going to need to choose time frames, because that's how crossover moving averages work. And you're going to need to choose the type of crossover or the type of moving average line you want to use, whether it's a simple moving average, an exponential moving average, or something like a Kaufman moving average, just things that we learned about, right? So we have some decisions around that moving average crossover. Now, how you can think about, well, now the question is, well, what's a good secondary? And we know coming from a different family of indicators is a good first step. Could we make it even a little bit better? How can we make this even a little stronger? So think through the indicators a little bit. Go through, if you got one that you really like, walk through those lessons again, think about their strengths and weaknesses. So for example, you know that the moving average crossover is a lagging indicator. It's looking at previous prices. It's a lagging indicator. And we know from lagging indicators that might mean you come in later into, let's say, a buy situation, because it's a little bit lagging behind. You're waiting for that to develop, and then so you're waiting for that situation, that indicator to happen. So it might result in a later entry, which could mean lower profits, right? We like the idea of, like, I love the moving average crossover, let's say, but I'd like to get in a little sooner so I can capture a little bit more profits than, let's say, kind of lagging in there a little bit. And that's how you can kind of start building these things and think about that, right? So let's say if you're looking in this example as a secondary confirmation or secondaries confirmation, let's say you want to enter earlier, so then you'd look at, let's say, indicators where they're more about things that might be a little bit more about entering earlier, such as the momentum indicators or an RSI stochastic oscillator, as part of that, indicators. So that's going to help you enter earlier, choosing one of those as a secondary. But let's say you also want to add a third indicator, and not only do you want to enter early, but you'd like to exit out a little bit closer to the high too, just squeeze a little bit more out of that. So maybe you want to add a third one that you're using to observe and watch through this whole process, where you want to squeeze out a little bit more profit. So that's where you might be looking at some type of indicator that's showing an overbought situation, right? We bought in, hopefully low, we bought in low, we bought in maybe a little bit sooner because we used that earlier entry thing. So we're using our primary, an early entry with, let's say, an RSI or a stochastic oscillator. But now we want to exit a little bit closer to the high. And so we might want to use another indicator for that portion of it, looking at something that might be approaching being overbought. And so that's where we might want to look at a volatility or a sentiment type indicator. For example, Bollinger Bands, are we walking up the band, that kind of stuff. And when it's to come off the band, that might be an indicator that we've reached our peak and now we need to sell out of there. And a lot of these indicators do similar things, but you can see how we're pulling from different families to kind of build up a logical type of primary and secondary indicator around that. In addition, you can sound real smart at parties. You can say stuff like this: when I trade, I like to use an exponential moving average but then I confirm it with both a stochastic oscillator and Bollinger Bands just to be sure. Okay, well, I don't know if you sound smart or boorish or boring, but you can say it. You can say, yeah, that's what I do. And in the end, that's what it's all kind of about, right? You can pull from the different indicators in the course, the various sections, what really speaks to you, and build your own combination. Practice with it with paper trading, back test it to see what it looks like on historical data, and really start to learn it and really apply it as far as doing that. Now, there are some classic ones you can use too, and just some different ways to look at, and we've got a lesson on that coming up next. So take a look at that to kind of help get you started a little bit too. Personally, I think the best way is to really kind of take any of these indicators and start creating your own combination, things that you really enjoy and really want to start with, because you can always test it. That's the idea. You can test it to see how it works for you. But there's some classic indicator combinations too, so let's talk about that to give you some ideas and maybe how some thoughts thinking about how you might want to use those or put others together in your own, of your very own that you've learned in the course. So let's say you've got something, maybe if you're using something like moving averages, and there's a lot of different choices of moving averages we learned, and then you combine that with an RSI and MACD, the very common type thing, almost defaults on a lot of chart patterns. So when you go look at defaults, they'll set up that way, or certainly with candlestick patterns or candlestick things on a chart with an RSI maybe above the chart and an MACD below the chart, and you'll kind of see those all together. And you can make any one of them the primary. You would see more candlestick patterns, for example, but maybe RSI, because it's easy to read, you'd see that as a primary. But you can, kind of make either one the primary or secondary, and really any of these typically. Maybe like moving average crossovers, when they're crossing over each other, for example, and so you want to add some. Another way you can impact the overall effectiveness of your trading and profitability, which is what we're really looking at here, is building on this concept of indicators and primary and secondary indicators. And that's with selective trading timing is a great concept you can use with that. So think of it as selective trading timing we're going to learn about, and then combining with these confirmations. So maybe you like the idea, I hope you do, of having a primary and a secondary. That's a real core concept of technical analysis. And maybe you might add a third, or maybe a fourth, and maybe a fifth. It's up to you as you develop your skills. But let's start with a primary and a secondary. And then you can add to the trade as indicators are met. So maybe you want a primary, a secondary, you're good with a third, but then you maybe add a little bit more with your fourth and fifth indicators come in. So if you want to approach it that way, that can be a great approach too, and use more indicators. So how does it work? So let's say you take a certain amount that you've designated for a trade, for a particular individual trade of an individual security, you're going to commit a certain amount of money. Let's pretend and say it's $500. Students from all over the world, over 200 countries, so please just submit in that idea of rupees or euros or pounds or whatever yen, whatever you use. But let's say, for example, I have 500 units or $500. So maybe what I do is I break that up. Instead of putting it all in, I break it up depending on when these different indicators are met. So let's say if indicator 1 and 2 are met, my primary and my secondary, my most confident things, I put in $200. And then if I see, or either right away or if it progresses, a third indicator is met, a third different indicator is met, well, then I'll put in another $100 and another 100 for number 4 and another 100 for number 5. And the idea is that you're kind of, instead of putting it all in right away, you're kind of building in as indicators are met. And you can change these amounts. Let's say you really only want to use 3 indicators or 4 indicators. Well, you could use $300 for 1 and 2, and then $100 for 3 and 4, and that gets you to your $500. Again, the amounts you use is completely up to you, of course, just the concept of breaking it up and putting a little bit more on your primary and secondary, and then your third and fourth, so you put a little bit less, and you kind of work your way into those. And now when you get an indication that things are changing, like the trend is ending, and you might not have been putting in all your fourth and fifth, maybe they never were met. Maybe you've got only $300 in at this case. Either way, whether you have only, your smallest amount to fully in, once you see that there's a change or the trend is ending, you exit all at once. So you don't exit like in kind of reverse order or anything like that, or slowly exit. Once you see a definite sell signal, you want to get out and you want to exit and book your profits. Otherwise, you'll just as you built up your profits going up, you don't want to erode your profits going down. You want to build them up slowly and then protect them and then get out and do another trade. As far as doing it all over again is the idea. So that's the idea of how that selected trading timing works. Is I'm using these indicators, but I'm using the indicators as far as when certain milestones are met with this particular security that I'm trading. So it's a great way to kind of, add a little bit more safety without having to go all in on and trying to, feel like you have to really know that fifth indicator well. You could put a little less risk on, let's say, that last fourth or fifth indicator, as an example. Another way you can manage your trading is what's called using setup trading or setup trades. You're basically looking for a certain setup and you're striking and you're acting fast, you're acting quickly once you see a certain indicator setup happening is the idea behind it. And setup trading, as we'll learn the mechanics of it here, but just understand that setup trading is real popular with like day and swing traders, people who trade very quickly. Certainly folks that might be called arbitrage or scalping, where they're making quick moves in and out. Real popular with that. It's also very popular with very, very volatile securities. Things like penny stocks, these low-priced, not well-known companies that, that might be trading for, 50 cents and it goes up a little bit. All of a sudden, it's a big move, right? So very volatile securities like penny stocks and altcoins or alternate coins in the cryptocurrency world, for example. Less so, it can be, but less so with like, let's say Bitcoin, very established, but more of a newer, let's say, alternate coin. And so the idea behind why it's popular with these types of folks who trade these types of securities or this types of methods is the frequently buying and selling aspect of a setup trade. You're frequently buying and selling. So if you think about that, you can probably already get an idea that you might need to be comfortable with risk and uncertainty. But if you follow a plan, you're taking a lot of the risk out. And as you learn and develop your plan, your ideas around setup trading, you're actually going to pull risk out. But it is something that is a little bit more for the, if you're the individual who loves to trade and go fast and get lots of little profits all along the way and build that up to big profits, well, this lesson might be for you, right? This might sound very interesting. So let's look up setup trading in a little bit more detail now. So how it works, kind of, you identify a specific, price bar common configuration. You're looking for something you see. Once this happens, then that's an indicator for me, and I'm going to take action. Let's say off of candlesticks, for example. You might be looking at a good candlestick combination within short time frames, maybe minutes, maybe hours, but probably even short, like more like minutes. And you're looking for that certain setup, that certain situation. And you can still have a confirming indicator, possibly as for something else confirming it, RSI, whatever it might be, something else confirming it. Fibonacci might be a good one, to help, in this case, to help confirm. And you're looking for that setup. And once you see that setup, and the whole idea is you want to see the setup, and the sooner you can see the setup and become an expert in your primary, you're going to be an expert in that. Once you're an expert in your setup and you see it happen, boom, then you take action. And let's say you buy it, you buy it then. And then once things change quickly, you sell it fast too. And this is all happening within minutes or certainly by the end of the day is the idea. That's why, of course, it's popular with people who trade frequently, like scalpers, arbitrage, or certainly day traders that will close all their positions. Classically, day trader close all their positions by the end of the day. So you're looking for the pattern and you're getting in fast, and then you'll actually get out fast. So if we look a little closer at that, let's say, for example, you've identified a candlestick setup, whatever you decide. Look at the lessons around candlesticks, for example, and you say you're really looking for certain setups. And then what happens is other people will see these setups too, right? You're not the only trader out there who knows how to trade. You're better because you took the course, but you're not the only one out there, and that's a good thing. Because what will happen is once the setup happens, once the pattern happens, let's say with these candlesticks, there'll be a big move in the first few minutes, right? People are buying in. They see it happen, and they're acting, and they're buying in early. And then what happens, or we hope to happen, not everything's perfect, of course, but it's followed by additional move in the same direction, at least a short-term trend there that will be occurring. And others are coming in, and that keeps the demand keeps rising, right? Because they're starting to see the pattern too, but they might not see it as fast as you because that's not their expertise, or they haven't moved as quick as you. So you're moving fast, you see the setup fast, you move fast, the price keeps rising even though you bought in early, so you're seeing your profit now rise because others are following in. And instead of waiting for other types of signals or waiting for other things to happen, you're selling fast, right? You're getting in early and you're getting out early. That's the key. You're in early and you're out early. And you do that over and over again to basically, build a profitable strategy around this. Again, you got to like that fast trading, maybe a little bit risk. Sometimes it doesn't go the direction you hoped it would or thought it would, but the idea is it should because you're seeing the setup. And your indicator is going to work for you more times than not, for sure. So getting in early, So the whole key, identify setup fast, buy early, wait for others to join, drive the price up, get out early. Do it over and over. Now, one thing you want to do along that too is you want to have these predetermined trading rules, because you don't want to do a lot of thinking. You want to do a lot of fast acting, right? So you want to ahead of time establish, whatever rules you might have around that. Some classic ways you can look at is you would buy, let's say, once established price range, in the first X minutes of trading, right? So you're looking at a price range and you're seeing it in that price range, let's say in this case, $100 to $105. So there's an established price range happening, and you get in when you're above that range at a predetermined target. So let's say you don't do any trading for the first, let's say, hour of the day. It was a classic way to do it. You see the security is trading between 100 and 105. You're looking at a target that once it hits 107, or there might be a certain, let's say candlestick setup, that happens, then you buy. And then you sell right away as it goes up, right? You may not get a sell signal at all. This might be a start of a longer trend. When you're doing this type of setup trading, you don't care. You're trying to get out and maximize the profit that way. And so you may not get a sell signal, and you may stay in it for a few minutes to a few hours, or maybe to the end of the day. And where you want to kind of set that up is with maybe you have a predetermined profit amount, right? So let's say I want to make 5% per trade or 10% or whatever the number is. You would then just figure out what your exit price is too. And then you might have some stop loss and things to protect your downside as well. But the whole idea is that you're seeing something that's got some momentum behind it. You're seeing the prices rise. You've gotten above the trading range. This is real small looks at individual candles. You're getting above the trading range. So let's say in this example to 107. You're buying. You're watching it go up a little bit further, a predetermined amount. You sell. You take your profit. You get up. So setup trading. Not for everybody, and there are some definite downsides to setup trading too. So setups may not appear every day or every month as for some of the downsides. It's something you're watching for, that kind of more perfect setup. You might need to follow more securities as part of that too, because they don't appear as often. And you want to really kind of learn more setup conditions to recognize. The more you recognize, the more opportunities you'll have. So you need to become a little bit more of an expert in these setups, in these different types of setup conditions, setup situations, compared to more common primary indicators, that you could be waiting for, like moving average crossovers and things like that. You're looking for these price setups. And it does take a good amount of concentration during the trading day. It's a little harder for a part-time trader, because remember, you're really watching or moving quickly. You can do some automated things with the orders you place, of course, with like stop loss, targeting certain buy levels, so you can kind of automate that more. And when we get into the how to place your orders part, we'll actually talk about how to automate that more. But either way, it's still going to take a little bit more intense concentration in the trading day. Again, that's harder for a part-time trader, possibly, but for those who want to trade more frequently or in certain sessions, when they're in session, trading a session, they're going to really concentrate and do that, and they're going to enjoy it, and they love it. So one other aspect of that too is you'll never really maximize the profit on one trade, since you're getting out and in and out so fast. But you're protecting your downside too by getting in and out fast as well. And the whole goal of setup trading in this manner is that you're going to have these many small little profits add up to some big overall profits. That's the big idea behind it. So setup trading, again, you might, as you watch this lesson, some people are saying, that sounds like me, I want to do that. And other people are like, oh, that's not for me at all. Okay, that's fine. But now you at least understand how it works, and you can do that, but you absolutely don't have to do it. That becomes a little more of trading style. And if you really want to do setup trading, like get real crazy with it, then you can do guerrilla trading, which is in the next lesson. So if you thought setup trading was fun and exciting, then you might really love guerrilla setup trading, or it's commonly known as guerrilla setup trading. There's other names too. So think of guerrilla setup trading as more intense setup trading, guerrilla trading more intense, if you can be that way. Looking at very, very short trades, term trades, you're buying and selling in minutes, for sure. Buying and selling in minutes, and you're targeting only a little profit per trade. You're doing that over and over again. And so you do a lot of trading over the course of a session, right? You're minutes, right? And you don't care about trends and other indicators, which makes me sad a little bit. But hey, we're not here to just love indicators. They're perfect, great things, but you can use this type of trading to make profits as well too. And that's ultimately what we're here for, is to make some profits on our trading. So how does guerrilla trading work? So first off, How it works is you kind of follow a news announcement that people are going to react to, right? You kind of anticipate things coming, like an earnings announcement. Companies will, for example, in the stock world, they're going to have earnings announcements, or maybe there's some government policy announcements, something around. If you're in the cryptocurrency world, there might be something about legalization or more regulation around cryptocurrencies or currency trading like forex, whatever it is, whatever type of security you're trading. You're looking for news around that, particularly if there's news that you know is coming. That's really what you're looking for, is you're really looking at the calendar and you're watching for news to come. And you might see some rumors coming and you're watching for that news to come. Once the news comes, now you watch what the market response is. And your only indicator is price. How is the market responding? The news comes out, and if the news seems favorable, people are going to start buying, right? So they're going to buy. So if with that, you want to immediately pounce, right? That's like a gorilla on a nice leafy branch or a banana, right? You're going to immediately pounce is the idea. You have to get in fast, and then you have to get out fast in a few minutes is the idea behind it. But the whole key on there is getting in fast, that immediate pounce part, because if you come in too late, you've already missed a lot of that good initial price run up, and it might have a pullback later in the next minutes or later in the session. So the idea is you immediately pounce, and you get out in a few minutes. And sometimes you can do this multiple times on the same announcement as the market processes the news, right? So a great news comes out, the market reacts, the price goes up, you've pounced early, it's gone up a little bit, you set maybe a predetermined target of like 2% return or whatever your number is, you set a predetermined amount, and then you get out. And then the market processes it and might come back down a little bit, and then you pounce again. And you can keep doing that on the same announcement if you feel, and once you see these prices going back up again. So as far as trading goes, it's less about indicators and more about behavior in that case. So if you like setup trading, you might love guerrilla trading. An important success factor is managing your trades. Sometimes the biggest success factor or big success factor may not be an indicator at all. Because there is no one perfect indicator, as we learned, and there's no one perfect system. There's things that work better than others, of course. But in fact, not only do you need to know these different types of indicators, how to apply them, how to use them and all that, but you also need to know how to manage your trades. If you take a course in technical analysis and they don't include this part or something, that's a little bit of a miss there, because it's managing your trades is that important. It's very, very important. So we're going to talk about in these upcoming lessons about managing trades. And if you think about it, an indicator is a tool, right? So it's a tool to help you make decisions around. And you have many tools in your toolbox, right? You have all these different indicators that you can use, and you have primary indicators and secondary indicators and third and fourth, and you have a plan around that. But how you use those tools, that's trade management. So think about the tool. The objective is to hit like a hammer, is to hit the nail on the head, right? That's how you use the tool. But sometimes it's subjective, like how many nails should I use? Or to let's say affix this board to this other, to the side of the house or whatever it might be. So you're thinking about how do I use my tools and how do I manage the use of the tools? And that's when you get into, into trade management. So the big themes in this section is developing trading rules that reflect your risk appetite, how much risk you want to take on and how to kind of build that all together. And then understanding some important trading mechanisms too, such as stop loss and scaling and some things that we're going to learn about to use these trading mechanisms to help you not only understand how to use the indicators, but in addition to that is how to use trading mechanisms for success. And that's what we're going to be learning coming up. So I hope you'll like this theme here coming up here. When you're trading securities, you want to have a plan, right? And part of your plan is having rules, having rules and guidelines around your plan. So let's talk about trading rules. So first off, well, what do we mean by trading rules? And really a trading rule is the action you're going to take, buy or sell, for example, you take when certain conditions, and that's your indicators, are met. It's part of your overall trading plan. So these trading rules can be very simple or very complex. Like for example here, let's say we're going to buy when the price moves above the 20-day simple moving average line, right? It's an easy indicator to understand. It's a simple rule. You buy when this happens. Or it could be like sell half of my holdings when the price crosses below the 10-day simple moving average, and the other half when it crosses below the 20-day simple moving average. See how we've added some rules as far as how we'll adjust our behavior, buying and selling, but it's a little bit more complex in bullet point 2 versus bullet point 1. And they can involve one indicator or a primary and second confirming indicator, which is good, or multiple indicators. The idea is you're building out your plan and building out rules that support your plan. And so when you think of that, you're looking at two really big things. You're looking at the indicators you'd use, your tools, but you're also looking at your risk profile, how much risk and how much profits you want to take or how much loss you want to avoid, right? And when you look at those together, your indicators and your risk profile, that's what's going to help you develop your trading rules around that. And again, you can paper trade this and back test it to help develop comfort levels around that too as well. Paper trading, of course, with fake money to basically practice. But the big idea here is I'm looking at my indicators and they're not in a vacuum. I'm also have to understand myself as a trader and in my own risk profile as far as how do I react when there's sometimes losses, for example. Now, when you're building these trading rules, sometimes you might be like, well, I just know my risk profile. If we're talking about risk profile here, for example, well, I know I'm a wild-eyed, crazy, I'll take any risk trader, or I might know I'm a little bit more cautious type of trader. So you might just know, and a better way to do is maybe you do like an online survey, right? You can just kind of do like, put in a search engine trading risk profile or whatever, and you usually come up with these online surveys, and you answer some questions, and multiple choice questions, and it'll spit back and say, you're this type of risk profile, and you can kind of interpret that and maybe confirm what you might feel in your gut that you just know. Another good way, and actually a better way, is actually when you get to that point is actually paper trade and start seeing what the losses would be like, but also what the gains would be like. How successful is your system, or how you put together your trading rules and your indicators, putting it all together, and that you're feeling comfortable doing all this. That's where paper trading is so important, to get comfortable before you actually do real live trading. And that's really the last step here, where you really determine your risk profiles when you're trading real money, your money. When you're trading real money, that's when you really get a feel for your risk profile. It's easier to be risky when it's not your money. It's just fake money. It's on a computer screen. It's another thing when it's your own real money. So as you build up these trading rules, again, you're looking at your indicators and your risk profile, and both of those will develop over time and with practice, and that's all okay. I'd also caution you to be wary of people trying to sell trading systems. It's less about them, sharing a trading system, maybe more about them, making some money. So if they're asking you to give them money, that probably tells you there might be something to be wary of. Usually how you can kind of spot these types of things is, and how to be wary of them, is they won't show you anything, or they'll show you very little until you buy, until you give them some money. Probably not even refundable either, right? And there's no proven track record out there. And the other thing with a trading system, even if it's a good trading system, it does not consider your risk profile. Remember, if we developed our trading rules, we had to look at your own risk profile, but also the indicators you wanted to use. So with a trading system, they don't consider either of that. So it doesn't consider your risk profile, indicators you like, doesn't consider your preferred trading rules either. It's like you're buying this package off the shelf. And again, they make money selling their trading system, not trading themselves, right? So that's how they're making their money. Now, you have there can be some exceptions, of course. Experts disclosing, where you have experts that are disclose all their indicators and they have a long track record around it. Then you can take that and maybe adapt it to your risk profile and philosophy. We talked earlier about, the conquistador kind of trading idea. So if you internet search conquistador or Bruce Babcock, Babcock, you'll find all sorts of stuff about conquistador that he's written on and his firm has written on, and they'll have all sorts of how to implement it, and then they have a ton of statistics around it too on why they think it's a good trading system or trading rules. So that's different and that's all free, right? So there's nobody trying to sell you something there. I think later they might try to sell you some other stuff or they're getting advertising on their webpage, but either way, it's not some kind of like, hey, just trust me type of thing. And by nature, technical traders really like to share ideas. Maybe sometimes they share too much in forums. You'll see that as you get around in different trading platforms, and if they have a forum, everybody's like, here's an ascending triangle, for sure it's happening, buy now, that kind of stuff. And they're not really selling you a system, they're just, saying, hey, look at this, I think I see this. And they're participating in a social aspect. So, how you can really spot a fraud, just think about it as, do they have they'll say things like they have the secret to riches, right? And they have a foolproof system anyone can use. In fact, their system is why they're so wealthy now, because they got such a great system. And they usually have a picture of themselves standing in front of a luxury car, maybe a pool, but a lot of times a luxury car or a big house. But luxury cars are popular, especially fast ones. They want to share the system with you, but they'll share it for only, a certain dollar amount, $1,349 or whatever. But wait, if you buy today, you can get the system for only $9.99, right? So it sounds very salesy, right? So that's usually how you can tell of a fraud. I think if I would never do this, but if I was to create a trading system, I think I'd create one that was a fraud. If I was a bad guy, I'm not, but if I was, I'd create a trading system. I call it the full moon trading system. And I would call it the werewolf. Oh my gosh, it'd be so awesome. What great marketing, right? It's the werewolf system. And here's how it would work. The trading day falls on a full moon. That's important. It has to be on a full moon, the trading day. You buy a security with the word wolf in it, like for a stock, like Silver Wolf Exploration Company, actually a real company. So you buy a security with the word wolf in it, and then you have to sell the next day. You buy on a full moon, but then you sell on the next day. And then after that, you go and buy a luxury car because you've made so much money. Okay, so you probably see my werewolf system is just ridiculous and stupid, because it is. And that's something just to be aware of and wary of with these other systems too. They'll make it sound good, and there might be some basis in there too, but with using some technical indicator or something. But again, if it's more about selling the system versus educating or proving something, statistically or educational, then something maybe stay away from. So they don't give them a lot of money. So let's talk more about how to create your own trading plan. Your overall plan, that's your strategy. That's going to be your guide that's going to help you when it's time to execute. And they're actually not too hard to build, actually pretty easy to build as far as, the core components, the core 5 steps that you would use to build out your trading plan. We'll walk through that here. And once your trading plan is in place, then you're set, right? And then you can follow that framework, and then you can adjust or build on it, but you've got your trading framework set, your trading plan set, and then you just keep improving as you become more experienced and as you want to keep changing, adjusting to keep improving your trading results. So let's show you the 5 steps on how to basically create your own trading plan. Step 1, as far as the steps kind of on this is, first thing you're going to do is you're going to determine if a trend exists, right? That's where your indicators come in. It's obvious that trend following indicators fail if there's no trend, right? I mean, the idea, if you're trying to use an indicator that's going to try to show a trend, and if there's a trend, we can kind of predict what's going to happen going up or down in that trend. And if a trend if there's no trend, then your indicators are not going to be successful, right? So, the key of that whole trend is your friend is so important. So keep that there when you're looking at these indicators. You're looking for these trends as part of a 5-step plan. Number 2, have a rule for opening a position, basically your buying position. What are you going to do? What are the criteria that will be? What are primary, secondary indicators telling you whatever that says, I'm going to open a position when this happens? For example, it might be like, I will buy when the 20-day simple moving average crosses the 200-day simple moving average. And I confirm that with the MACD, moving average convergence and divergence, right? So that's the rule, right? It have to meet these things in order to buy, right? So that's part of my plan. I'm going to look at indicators, I'm going to look at trends, and then number 2, I'm going to buy or open a position. That's the key part. When am I going to open or buy once these indicators kind of line up? And this is an example of that. Number 3, you're going to manage your money at risk by scaling up or down, and how much you scale up or down, or even at all. But that's a great way to build into an overall trading plan. Now it's looking at more managing your money versus, let's say, a trading indicator. And so you'll increase your funds in the current winning trades and withdraw from poorer performers, the idea of scaling money up and down based on a trade. So for example, we talked about an example a little earlier too, if you put $500 that you've dedicated for each trade, and then you have $200 or what you're going to put in when number 1 and number 2 are met as far as primary and secondary indicators, and then you'll keep adding to that trade for profitability as numbers 3, 4, and 5 are met. By the same token, once it certainly reaches all five, or it might not get to all five, you're going to sell right away once you get a sell indicator, right? That's the idea, is you sell everything right away when there's a sell indicator. But as far as adjusting how much money you have at risk by scaling that up or down, you can kind of take it a little bit easier, or adjust how much you want to put at risk. If you say, okay, if I see my number one and number two, I'm going to put all in, that's fine too. Just understand you're taking on more trading risk than if you spread that out a little bit too. Neither way is right or wrong, just it's a little bit more conservative and a little bit more risk adverse to spread that trading money by scaling that money up or down. For closing a position, we have, the second one is establishing when to buy. Well, it's also important to know when to sell, right? And that's very important, because that's going to help control your losses. You want to control your losses, and you want to lock in profits and control your losses, and have increased profitability, of course. Now, active traders are not buy and hold forever type investors, right? They're not going to buy something and then hold it for 5 years or 10 years or forever. They're looking at targets and stops when they want to lock in those profits, and that's when we look about some other things around trading, around targets and stops, and how to set that from an order standpoint. But the idea is that you're looking at a target you're going to want your security to try to get to. It may not get all the way there, but that's the target you're looking at, and once it hits that, you're going to sell to lock in that profit. Another thing is using stops, where it might go up a little bit, but it might start going down. There's a stop limit, or a stop, where it's a trading mechanism to help you automatically basically sell and protect your downside. So for example, you might say that you're, as part of your plan, that you're going to sell everything when the price crosses below the 20-day moving average. Once that happens, you're selling. You're not debating. You're not having a whole big discussion about it. It's like, no, this is the rule. This is part of my trading plan. This is my rule for closing a position. And of course, you can have whatever indicator and rules you want. You'll be developing that on your own, of course. But the fourth part of this is establishing a rule for closing a position. And then lastly, number 5 is doing it again, right? Doing it over and over again. It might be with a new security that you're now looking at for the same types of indicator situations, a primary, secondary, whatever it might be. Or sometimes it's a re-entry into the same security as the price waxes and wanes over a period of time. You might have a smaller watch list of securities that you really like to trade in, and you're always watching those, of course, and then you're doing these same 5 steps as far as your trading plan. So for example, a swing trader may trade several times in and out on a security with a longer overall predominant trend. That's the whole idea, that swinging, the price swinging up and down, but they're watching this overall trend, but they're kind of getting in and out more frequently than somebody who might ride that trend almost the whole way and then get out all at once. Either way works, it's just a matter how frequently you're trading and your trading style, for example. Or for example, you want to walk up the Bollinger Band, and then once it's off the band, then you sell, and then you get back again when that security gets back on a band, walking up. So you're really using that maybe as a primary indicator, something else confirming it. So when it's on the band, you're walking up the band. Look at that lesson again. If this sounds a little unfamiliar, but look at that lesson if you need to. But you're walking up the band, you're going to keep riding it. Once it's off the band, you sell, and it's back on, you're buying again, right? So you're kind of doing that with maybe a smaller universe of securities. Either way, how you do that, you're trying to set up that whole trading plan of doing it again and how many securities you might be looking at. So if you think about it, kind of the steps around there, you have your tools, your indicators, and you have these rules, you have these ideas of how you would use all that. And then the 5 steps is determining if the trend exists. That's your indicator, is going to help you with that. What's your rule for opening a position? That's where your discipline is going to help you with that, and establishing that all ahead of time. Managing your money is an important part, and you can manage that risk by scaling your money, as far as how much you want to put in at a time. Establish a rule certainly for closing the position, so you need to know when to buy. But number 4, you need to know how to sell, and then doing it again and how you want to approach that. And again, that discipline will serve you well. You follow your plan here. As you deviate from any of these 5 points in the plan, then it gets a little bit more less efficient and maybe less profits for you. So follow these guidelines, and then you can build on this framework as far as creating your own type of plan. And then that's kind of the last thought there, is keep that framework, but adapt your rules as you evolve. Because you will evolve as a trader, especially if you're a little bit newer to this and you took the course because you're a little bit newer, maybe you're brand new to this, you will evolve. So for example, as you do more trades, you're going to become more comfortable and you're going to become more confident, which means your risk profile is going to change. You might have started, let's say, trading and be a little bit nervous and all, and that's perfectly okay. Everybody is. But as you do more trades, you see some success, you're going to take on maybe a little bit more risk, possibly, because you're more confident and you're more experienced and you're better at just trading in general. And the amount of time that is available for you to trade could change too. Maybe you've got a full-time job, it's just crazy, it's busy, everything's just crazy, so you just trade a little bit. But maybe now you've reached a point where you have more time freed up and you're more confident, you want to trade a little bit more. Well, then you can adjust your framework for how you might want to be a more active trader than somebody who's a little less active trader. The other one's right or wrong again, it's just that you can adjust your framework as these things happen. Particularly with risk profile, you might be adjusting your framework to be matching up with your risk a little bit more. Again, you take on a little bit more risk. The idea is you're going to get a little more reward as part of that too. So more risk, more reward. And so that's where that confidence and that knowledge as you keep going is going to serve you well. And I hope this course has helped you with that, to give you that confidence and that framework to then build your own success. That's the whole idea here of helping you be successful. A couple of last thoughts around your trading plan and all that. In thinking about technical traders, technical people who trade, active traders, and using technical analysis, and maybe like traditional long-term investors, like buy and hold type investors. If you think about a technical trader, in their plan has, like we walked through these kind of 5 steps, but the plan has rules from entry to exit, right? When you're going to buy something, you've got rules that help you with that and indicators you're going to use. And when you exit or sell, you've got rules and things that are conditions that need to be met to do that as well. So you have a definite plan around entry and exit. And you'll use things like stop losses and targeting, profit levels and all that. And so you're coupling that loss reduction and avoidance with profit, right? So you're actively trying to manage through that and using that in a real technical way, in a real dispassionate, unemotional way, certainly. And you're looking at what the charts and what the indicators tell you, and then you're reacting accordingly. If we think about a lot of traditional, quote unquote, traditional investors, many might have no plan, but hopefully have a plan, or they may have a rule for entry, right? So they might, enter into something based on something. Maybe it's some type of fundamental, whether it's a price to earnings or a value type of ratio or profit to growth, earnings to growth, PEG ratios. There's different types of things you could use as a traditional investor for entry, but there's no specific plan for exit. There's really more of an indefinite period for exit when things start changing around maybe that particular security or in the wider world or wider market around there. So a technical trader is looking at enter and exit, and they have a plan that covers everything. A traditional investor is looking at entry, and then they might even let that ride further. Like a buy and hold investor might let that ride for a very long time, years or more, or maybe forever. And the thing with that is, if executed correctly, either one can be successful. Either one can be successful. And so you want to think about, and you can have a combination. You might have your core part of your portfolio where it's mutual funds and exchange traded funds, for example, that are core, and you buy them and you hold them and you let them go for long periods of time. And then you might have another part of your portfolio where you're using that technical trading to get a better return on top of that buy and hold by having those entry and exit points as a technical analysis trader. And that can take many forms depending on your time frame, from day trading to more active trading to swing trading to whatever it might be. So that's kind of the difference between those. And as far as some of those final thoughts. And lastly, as we saw earlier, your trading rules, which is all part of your trading plan, and overall think of this is really going to come around the indicators you use, coupling with the risk profile that you have, how much time you have available for trading, and putting this all together as far as understanding how you're going to execute and look at as far as what's enjoyable for you in terms of your overall trading plan and the plan you're going to follow. So again, keep that in back of the mind, the indicators that you've learned that you want to use, understanding a little bit more about your own risk. Starting slowly is perfectly good. Certainly using things like paper trading, back testing to get you comfortable. Those are good ways to get going. And then as you keep developing, then you'll adapt from there as you become more experienced and more successful. Well, let's say you've made a good decision, right? You've used your indicators, and you made a good buy decision. You've bought a security, right? And now how do we maximize the profit out of that, buy that we just made? We want to make profit on this. How do we maximize that? And that's a key part of managing your overall trades and your trade rules and all that, along with reducing losses, is looking at targets of when we want to sell. Because it kind of answers that whole age-old question, when do we cash in? How do we know enough is enough that we need to sell and book our profits and then move on to another security, or wait for another opportunity, maybe with that same security, to buy in again, right? But at some point, it doesn't go up forever. At some point you're going to sell and then maybe later get back in if conditions change. But when you do that, when do you cash in? I mean, sometimes you can go by feel. It's cloudy out today, so I think I'm going to sell a lot of stocks. I mean, I just feel like it. That doesn't sound very technical analysis like, right? Or sounds very emotional, actually. So that's not necessarily the best way. There's actually better ways that you can do this, and we're going to talk about that in this lesson. Several ways that you can build some trading rules around when to maximize your profit and really how to set up price targets. That's the idea of this lesson, is when to cash in and book those profits. Now, one of the common ways that you can do it is you rely on your indicators, right? You relied on your indicators to buy into a security. Rely on your indicators to sell out of that security, right? So if they tell you when to buy, they'll also give you sell signals, as we learned in all these different indicators and tools we learn about. And the benefit of using indicators is that it gives you the ability to maximize gains, right? You're using your indicator to tell you, what is the right decision making. Now, the challenge with that, of course, is sometimes indicators are not foolproof. They can give false signals. So you might sell before you really should have, or maybe you think you should hold a little bit more, but really you should have sold right away, right? So nothing's perfect in that, but using your indicator will help more maximize gains, more so than maybe some other ideas that we're going to learn about. That also requires a challenge. It requires more market monitoring time, right? Because you've got to be a little bit more watching and watching for these sell signals to happen. So you're going to have to watch your securities a little closer that you have an investment in it. Now, we're going to learn about things like setting up stop loss orders and things to help automate that. So don't worry about that. But even still, you want to start monitoring that a little bit more. But there are other ways you can do it besides relying on indicators. For example, you could establish a profit percentage target, right? And you could say, okay, I bought into something and my target is a 10% return or profit on a trade. So if I bought at, let's say, 40 units, $40, my profit target is $4. What's my total profit I want to make? So I would sell at $44, right? So I say, okay, I bought in at this, I want to make 10%, this is when I'm going to sell it. So that's simple, right? That's the benefit of it. It's simple to execute, and it enforces discipline. Did I hit my 10% or did I not hit my 10%? Once I hit my 10%, I'm selling. I'm not waiting till 12 or 13 or 14%. I'm waiting for 10%. Now, it could be 2%. It could be 1%. It depends on how active a trader you want to be. But in this example, you get the idea that I'm selling once I reach that percentage of profit target. Now, the challenge of that is you could miss out on extra profit if the security keeps rising. Let's say you're on a strong uptrend and you've made your 10%, but let's say this thing kept going and you're going to make 12, 13, 14, 15, 20. You missed out on all that because you sold right away because you're good and disciplined and you had set a profit percentage target too. The other thing too you want to be aware of is, let's say you don't ever get to the profit percentage and never gets up to 10%. Then are you kind of stuck in a little bit of a sideways move and it's just kind of stuck there? Or is it now starting to reverse and go downward, but you haven't reached your 10% yet? How do you get out from that? So those are some things to consider if you're establishing a profit as a percentage target. So one way to counteract that is to set a percentage of the range target. So you could look at and figure out the average high to low range, high price to low price range, over a certain number of trading periods. It could be days, minutes, hours, whatever your trading range is. And then you use indicators, assuming you're trying to buy in or you're at or near the low end of the range, right? That's the whole idea of using an indicator. You're probably not buying at the high end of the range. Sometimes you can with momentum and all that. But let's say your style is you're buying more towards the low, and your idea is that it should rise towards the middle or towards the upper part of this natural range. Especially your indicators are telling you it's a buy signal. So you determine the percentage of the range you want to capture the profit of. Let's say 50% of the range, could be any number. Since you're buying at the low end, there should be more upside, right? So 50% seems pretty aggressive, but you're buying in and you're exiting at the end of the range, not 50% profit. You're looking at the range there. So this will make a little more sense if we look at it as an example right here. So let's look at a percentage of the range target, a target sell time based on this example. So let's say you're over 20 periods, the high for something is 150 and the low is 130, right? So that's the high and low over 20 periods. So the range is 20, right? 150 minus 130, the difference between the high and low. And then the 50% of that range, simple to calculate, what's half of 20, basically would be 10, right? So you figure out that's your target. So if your target's at 50%. So you would sell at 140, right? So I'm buying in maybe near the bottom of the range. Maybe I'm at 130, but maybe I'm buying in at 135 because I'm not at the absolute low of the range, but I know my range is this. So once I get to 140, then I know I've reached my profit. If I bought at the absolute low, like in this example in the fourth bullet point, I'd be 130 plus $10 would be 140 I'm selling at, and I would have made $10 of profit. But if I bought at 135, I made $5 of profit. The benefit of this is you have a clear sell target, right? You have an actual real number that you're going to look at. That once it hits that real number, you're selling, right? So you've built in that profit. And 50% is just an example. That's for many, you might want to look at 10% of the range or 25% of the range. How wide the range can impact that too. A wider range is going to have a higher, absolute number target than a smaller range. So in this case, the example, the range was 20. What if the range was 80, right? Now you have a wider range, and that can make a difference. So the benefit is you do have that clear sell target. You don't have to think much. It's like, once I hit that number, I'm selling. The challenge is the range can widen during that whole period. You aim to be on the low end of the range, but maybe that range has now started a period where it's now widening out or possibly narrowing out too, and that changes your basic number. If you aim too low, that might be a little bit higher number to reach that you might not ever get to. And if it's too narrow of a range, your target might be too ambitious, or in some cases less ambitious, actually, is another way to look at it too. Either way, your range can change over time too. So the more established the range, the better this percentage of the range works. Also, it's very common to have temporary pullbacks. And that might mean a stop loss that does not cause a stop loss to occur. Then it can make your range goal harder to hit. So let's say we bought at 135 in this example. We're looking to get 140, but all of a sudden we get up to 132 and there's a pullback back down to 128. Now I've got further to go to get to my 140, so I might end up holding the security longer or may never get there to really realize my true profit on it. So there's, it's a nice clear sell target, but there's also some challenges to it as well. Another way you can use is look at measured move patterns. And this is kind of related to indicators, depending on the indicator you're using, but some indicator patterns have built-in forecasting, like ascending triangle or support resistance lines, like we see an example here. And so when you buy in, you're setting your price based on the pattern continuation. So if I was looking at that support line, let's say I'm buying near the bottom, I want to buy near the bottom, near the support line, I know that it's going to rise up hopefully to this resistance line and follow the pattern. And as I get up to that resistance line, okay, now I'm going to sell again, right? So that's my target, is if I get closer, I'm picking a real number, a whole number, or a number, an amount that's close to that actual resistance line. And once I hit that number that's near the resistance line, I'm going to sell. I'm going to watch the pattern continue, and if it doesn't break through that resistance line, it's going to come back down. And if it bounces back up off that support line, I'm buying in again. And then I do the same thing again where I'm waiting for the pattern to continue, and I'm going to go up to that resistance line. Again, I would get out of this completely, or maybe look at something different if it broke through either the resistance or the support line. That showed that the trend here, which this is a pattern continuation trend in a narrow channel, basically, I would change from that. But I'm setting my pricing, my buy and sell based on following the trend. So the benefit of this is it's indicator driven, which is a good thing, right? It's driven when we buy and it's driven when we sell. So it's indicator driven. The challenge of that is you're limited to your trades to those patterns, right? So you might have different, less opportunities for trading because you're looking for that perfect kind of pattern or certain situation to occur. When they do, they can be very rewarding. And if you're not as frequent a trader and you're really looking for more of a perfect situation or a better situation to be more confident in your trades, trading over a measured move or over a measured move pattern can be the answer for you. But if you would like to make more trades and more profits, less profit per trade, but do a lot of them, then this might be, be limited to those patterns and see less opportunity. So everything has its strengths and weaknesses. So these are some examples of ways that you can set up a rule or ideas behind when to sell or when to get out too as well. So not only is it important as far as when you buy in and use your indicators when to get in, it's also important when to get out. And you can use indicators to help you with that, or you can use some of these different profit measures we used in order to bank and book your profits and then keep doing it again and again to keep having more and more profits. That's the name of the game, right? The unfortunate reality is that not all trades work out. Sometimes we have losses. I know, sad, right? Wish we didn't. It'd be great if we didn't, but that's the whole part of the trading game. You have hopefully many, many wins, but occasionally you have some losses as well. And a lot of it's just things that are out of our control, and sometimes it's in our control. I mean, not every indicator works perfectly every single time, of course. Not every trader is a perfect trader, and there's things like false signals that we learned about that can happen. And sometimes there's something that you think is an event, something major, but it really isn't. It's just some rumor, some noise, or some just temporary movement, maybe a retracement, whatever it might be. And so then we might experience a loss from that. Or there's unexpected events outside in the wider world. I mean, you think about during 2020 and the early days of the pandemic of COVID-19 and all that, how that was a dramatic impact across all different types of securities. And if we look at, let's say the stock market, for example, where you have CEOs of companies as opposed to currencies or cryptocurrency, if the CEO all of a sudden dies, that's, unexpectedly, that's going to send a tremendous impact on your trading of that particular security. So there are things that we can control, things that we can't control. But a couple of things we have to do is be comfortable that there will be losses at times, and that's okay. And all successful traders reflect this, by the way. They're all very comfortable with having sometimes losing positions. The end of the day, we want to have more profit, more success than losses, and that's the whole point of the course, of course. But there is some action that we can actually take to limit our losses, some ways of placing orders correctly, and that's what stop losses is an order type that will really help us. It's really important in terms of technical trading and being an active trader that you use this to help minimize your losses. Because if you're minimizing your losses, you've got good targets set up, you're using your indicators well, then you're going to have some profitability. So let's talk about stop losses a little bit here. And one thing to also consider too, as part of this too, is when a trade doesn't work out for you, being comfortable with these losses, you feel bad, right? You lose money, you feel bad, you might even question your ability, and don't. It's okay, it's normal. So don't be that. Don't question your ability. Maybe adjust your strategy if you feel you need to, but you're learning. It's all right. And you can always use paper trading and all that to test out your ideas, and back testing as well. And you may experience the denial. I won't sell at a loss because I know it's coming back. If you ever see yourself saying that, then you're not so much technical trading, you're more hoping at that point. Remember, your indicators will tell you when to buy, but they'll also tell you when to sell as well, as far as when the trend, let's say, has stopped or slowed down or reversed. And many times we just get frustrated, right? It's a perfectly natural human being emotion, so understand that when you're experiencing that, that you're just really experiencing some frustration, and that there are some tactics we can do to minimize that frustration. And one thing to think of too, if you think about salespeople, right? I know, like, what? We're going to think about salespeople? But think about salespeople. They face rejection every day. Lots of people telling them no. All day long, they got people saying, no, I don't want the order. They won't take their phone calls. No, no, no. But successful salespeople know this, K-N-O-W know this, and are actually taught that each no is part of a path that leads to a yes. And so if you get a yes, that's a sale, which equals commission, which equals money. So every time you experience maybe a slight loss, that's on your path to that greater yes, that greater profitability. And a stop loss is basically an order type that's going to limit your losses. It helps overcome things like that. No indicator is perfect, that there's false signals, big market events out of your control, and we have an automatic mechanism that we can kind of place ahead of time that if something happens, it'll limit your losses. So you're doing this ahead of time and automating things, and it's all part of the plan. Again, we have an overall plan. And if you think about, just in general about the plan and where a stop loss might fit in your overall plan, you have indicators that help you select securities, right? You're looking for trends, you're looking for opportunities. So the indicator is helping you make decisions on buying and selling. And then you have trading rules around that provide the discipline that we learned earlier in the course, as far as, actually taking action, that you're going to have some discipline around that. maximizing our target profit maximization, or picking targets to maximize your profit, is all about maximizing profits. And then another way you can maximize your profits actually is minimizing your losses, and that's where the stop loss and that type of techniques help as far as minimizing losses. All right, so enough build up as far as what stop loss and kind of where it fits, but it's so important that you really need to do it all the time. So let's talk about now in the next lesson as far as what is this stop loss thing and how do I actually use it? So stop loss, just in the name, sounds good, doesn't it? It's going to hopefully reduce our stop losses, which we want, right? So let's figure out, well, what is this really all about and how do we use it? So a stop loss is actually a trading order, an order that you place. So really the definition of it is an order you put in place with your broker, your online broker typically, to automatically exit a trade if it goes against you by a certain amount. So let's think through that a little bit here. So you've bought something, and at the same time you're going to put in a stop loss that at a certain level, if the trade goes against you, it starts going down in price, you'll automatically sell at that point. And you can determine, how far down you want to do that. And we have a lesson on that as far as how to actually set these things. But basically you're thinking about, it's an automatic exit of a trade that you're setting up ahead of time. So the stop loss you input is an amount below the current market price, what people are buying at, what you might be buying at, especially if you're putting in a market order where you're buying at market price, for example. And you place at the same time you place your buy order. So at the same time you're buying, you're putting in a stop loss that only gets executed and automatically if certain conditions are met. And why are you doing this? It's part of the overall plan, right? It's part of the plan to minimize losses, is what it is. Because sometimes these things can turn on you quickly, and so you want to have something that's automated that can help you with that and really lock in either profits, if you've got a lot of profit off a trade and you want to kind of lock those in a little bit with a stop loss order, or to minimize losses right off the get-go, but you're placing at the same time that you place your buy order. So if we look at this graphic here, it's from Financial Express, kind of a nice graphic. You can see where the person's watching a trend on the left there that's going downward, but then it turns around and he's looking at a place where he's first pointing like, okay, that's where I want to really kind of make sure, I think that's going to settle, and I want to stop my losses there. And then he buys, right? So he waits for the trend to develop, and that's a good thing, waiting for the security and the trend. The trend is your friend to develop, and is buying there. And then is placing a stop loss order at that point just below the buy order. So the idea is if he buys there and it goes down pretty quickly, he's going to minimize the losses by having that stop loss order in. As it turns out in this graphic, the order keeps going up, the security keeps going up in the green there. And then if he leaves that stop loss order in place, it would come back down. And let's say if the person hasn't sold by the time on the far right there, then the stop loss order would be automatically executed. And you'd still have a loss in this example. So really what you'd want to do, and you can do, is you can actually move your stop losses as you make more profits. Or as you have other rules and things around that, once you reach your certain targets as far as profit maximization target, you might have sold before your stop loss order is executed. Or you adjust your stop loss order upwards, which you can do. We'll talk about that a little bit later, but you can adjust that upwards so that your stop loss moves kind of with as your security moves up in price too. So you're locking in some profits that way. And when we get into the market order type section, well, there's another thing called a stop limit order, very similar to stop loss, and we'll get into that at that point here later. We have a whole section just on how to trade securities on the different types of orders, from market orders to short to stop loss, stop limit, all that kind of stuff. So we'll be learning about that. But the key thing you want to take away from here now is that I'm able to minimize my losses at the front end, but I can also adjust it to maximize my profits on the back end by adjusting the stop loss order up. So you might have some questions. There are some frequently asked questions or FAQs around stop loss orders. So first, a common question is, how often should I use a stop loss? You should really use it every time. I mean, every time. The whole idea of trading is you're trying to make profits and all that, and you don't want to have your losses go down on something unexpected happen, have your losses all of a sudden go way through the floor right after you buy something. So putting in a stop loss, even if it's never executed, is always a good idea. You should really use it every time. The exception on that might be a buy and hold, or a long time hold investor. Somebody's holding for a year or more, then they might want to, the whole idea is that they're going to go through long down periods, and have that security come back up is the idea by basically using time on their side. But if we're actively trading, we don't have that kind of time. We don't want to hold something for 2-3 years if you're an active trader. But a buy and hold person could get away with not using a stop loss. But if you're an active trader, no, use it every time. Do I have to use it? Can I just sell when I feel like it? Just have a feeling, or use something like an indicator and just feel like it, and have it not be automatic. And the answer is yes, you have to use it. You have to use it every time, and yes, you have to use it. And the reason for that is the stop loss, putting that in place, takes emotion out of it. Sometimes we get attached to a security, we're in denial, we think it's going to come back, and it doesn't, and then we sell at a deeper loss than we maybe wanted to or intended to. And then we figure out that even though we've had some profitable trades, we've had some real bad stinker trades because we didn't put a stop loss in place. It takes timing out of it, right? It's time to always, it takes the timing as far as time you spend always watching it. Because it's automated, you don't have to be watching your security constantly all day long during a trading day. You can just put the stop loss in there, and then you can adjust it later as, let's say, if hopefully you're riding the trend and you're banking in some big profits, you can adjust upwards at that point. And it helps you to exit out fast out of fast big drops, right? Where something unexpected happens and all of a sudden the security is really dropping in price. You're not watching it constantly. It's hard to do that. So so the stop loss will just automatically take care of that order and sell and either minimize your losses or lock in a gain. And again, it's all part of your plan, right? It's all part of the plan, the trading plan that you have. And lastly, a frequently asked question is, I'm worried that my stops will keep getting exercised all the time, particularly in a volatile market where there might be whipsaws and things where it's up and down, and they're always being executed. And my trade never really has much time to really develop. And that's okay. That can happen. Just adjust your stop levels to account for that. Maybe you need to set a deeper loss level and be comfortable with that in a trading a very volatile security. If you find you're not comfortable with that, then you might want to look at securities that are less volatile in terms of going up and down, and maybe take a look at that trading indicator section around volatility. Again, this would be a good time to review that if you're still wondering about where you might fit with that. Well, we know we need to use stop losses. Now, let's talk about the different ways you can kind of set them up, the different types, and there might be a certain type that maybe calls to you or say, oh, that makes sense to me. That's how I want to use my stop loss order. So there's different approaches to how to execute it. And they're all really related as far as, again, trying to minimize losses and maybe even maximize profits would be the alternate way of looking at that. And so they're related. So you could be using setting your stop losses based off indicators about the money you have invested for a particular trade, or the timing. You might want to set a time frame as far as when the stop loss gets executed. And the thing is, though, they're related. They don't always match up, right? They all serve their own individual purposes. And so you want to choose an approach that works for you. And if you find one approach isn't working, or it's not working as well as you want it to, just adjust it, within that, type of stop loss. Just adjust maybe, how, let's say if you're looking at time, maybe you're adjusting your time periods longer or shorter, for example, or try one of the other approaches that we're going to learn about here. So you can always make adjustments to it, but you'll want to start thinking about it and start picking about one type of stop loss that seems interesting to you. They're all very valid, they all are used, and they're all, very good in their own ways. So let's take a look at these. A famous stop loss rule is the 2% stop loss rule, and it was popularized in the book The Way of the Turtle by Curtis Faith. Looked at taking amateurs and teaching them how to trade and using some rules around that. So if you're interested in that, Way of the Turtle is a very interesting book. And the idea of the 2% rule is you set a stop loss, or you stop a loss when it reaches 2% of your starting equity. Think of your equity as your money. What do you have totally available to trade, right? So it could also be termed like your trading equity or your investment capital. Basically, it's the amount of money in total that you've set aside for trading into a whole bunch of different trades. So for example, let's say you have 10,000 units. It could be dollars, rupees, whatever your currency is. You have 10,000 starting equity. So 2% of that would be 200. So that's saying under the 2% stop loss rule, you can afford to lose. You can afford to lose, and would set your stop loss at 200 on each trade. Right? So it's a 2% rule around that as far as your total equity. Now you might say to yourself, well, 200 out of 10,000 doesn't sound like much. Well, that also depends on how frequently you're trading, right? So it doesn't sound like much, but if you're trading many securities over short time frames, it can really add up fast, right? I mean, so it's a real fast way that you can really kind of go through your equity if you don't, put in some stop losses around it. And so that's where this 2% stop loss rule came from, the book The Way of the Turtle. And you can probably see that this is a money stop, right? So I'm using my stop based not on an indicator or anything. I'm just using like, hey, if I make a trade, I'm willing to lose 200. That's it. After that, I'm out no matter what. Another type of money stop is what's called a risk-reward ratio. And it's really the relationship of your expected gain versus your expected loss. So the higher the risk-reward ratio, the more desirable the trade is, right? So that's the idea about that. And then you can use your stop losses around how risky, let's say, a particular risk-reward ratio might be. So let's look at this as an example. So for example, let's say you have a security that's at 50, right? So you have a security that's at 50, and the indicators say the potential gain is to a price of 75, right? You're looking at your indicators, you're looking at where it might go. Indicators are saying, okay, or you feel you might make 75, or get to the price will get to 75, so you'd make 25, right? So you'd make 25. So you'd set your stop at a percentage below that initial price. So let's say you're willing to lose 20%, right? So you're willing to lose 20% on each individual security trade, which would be, in this case, so you're not looking at overall equity, you're looking at individual trade, which maybe have different amounts. So in this one, it'd be, I'm willing to lose $10 or 10 units, right? So I'm looking at that, buying a security at 50, 20% of 50 is 10, right? So that's where I'm setting my stop below that. So if I'm buying at 50, my stop loss would be set at 40, right? 50 minus 10, the amount I'm willing to lose. It's a percentage of the initial price. In essence, I'm willing to lose 10 in order to make 25, right? You see that, how I'm thinking I'm going to get up to 25. My indicators are showing that. Maybe there's a trading range that's kind of established that might show that, and I'm at the bottom of the range or near the bottom. And I'm saying, okay, I'm willing to invest 10 to lose 25. So the ratio in a risk-reward ratio is thus for a $25 or 25 unit reward for $10 at risk, or 2.5 to 1, right? So if it was at, let's say, $40 in reward to $10 in risk, that would be 4 to 1, right? All right, so now you actually, now if you look closely, you might be saying, wait, that's actually backwards. It should be called the reward risk ratio, right? Because the first number is your reward number. I think because terms of risk reward is used in many areas outside of trading as well. That's why they use risk reward. But technically, you're correct. It should really be called the risk reward risk ratio. Nobody calls it that. They all call it the risk reward. So with this type of ratio, you want to be conservative a little bit in using this type of ratio and emphasize, the downside risk more, right? If anything, you might want to say, okay, I'm not as willing to lose as much, especially getting started with it. So you might want to, make those numbers a little bit, play around with them. There's different things. You could go higher, you could go lower than 20%. That's a big drop. Maybe 5% would be the right number. Those are all okay. Or you kind of use it around the way of the turtle a little bit. You're looking at 2% equity. And the thing you can see from this, it can be a little complex to calculate, right? So you have to kind of factor that in. But if my risk to reward ratio, or reward to risk, is a higher number, that means I've got higher potential gain. So maybe I'm willing to take a little bigger loss because the rewards are much higher, or maybe I'm willing to invest a little bit more money because the rewards are higher too in comparison to the risk. So this is a way you're setting in a stop. You're still buying with the whole idea you want to hit that target profit. You still want to, every trade to be profitable, of course. This is just a way to minimize downside risk, and how much you want to have for that downside risk, you set as far as a percentage they'll fall below that initial buying price. Maximum adverse excursion, or MAE, is a timing stop. You think about timing. And a lot of times trading software will just kind of show you a graphic like the one we have below, where it kind of shows you where these MAEs are. And basically, it's what it is, it's a worst case loss that can occur over a trade's time frame. That's why it's a timing stop. So the software or the platform will do the calculation, but the idea is you're calculating the biggest change in the high-low range over a fixed period. Let's say like 20 days. It could be 20 minutes if you're a day trader, whatever your time frame is. that matches, the idea is you want it to be a fixed period that matches your typical holding period. So you get results back from, this is where back testing can really help on your trading platform to try these different time frames and see how that would work for you, and using the provided indicators of this MAE. And you use a percentage or fixed amount to set the stop loss around that when you're playing around with the platform again. And the opposite of that, by the way, is a maximum favorable excursion, or MFE, which you can actually use for profit-taking targets, right? So when you'll see a graphic, let's say on the platform, you'll see a graph like this where it's going to kind of show these ranges, and you can see that the lowest of this time frame, whatever that time frame is, that's your total time frame you're seeing as an image. The lowest low of that's your MAE, and the highest high would be the MFE. And so if you look at that lowest low, you could use a percentage of loss, like we were talking about, like these other ones, 2%, 20%, whatever it is, or a fixed amount, whether it was $200 or 200 units, whatever, and you can set it based around that. And you'd look at that kind of that center line. You'd look at when you're buying, and then you would set based on this kind of indicator or this tool that your trading platform will provide you with it. So look for, if you're interested in that type of timing thing, look under your trading platform for more details on how it. And the main thing is you want to establish the range you want to look at and have the range match up. If your range doesn't match up, then you might be a little bit too aggressive or not aggressive enough, depending on your time frames. So you want to look at that as far as the time frames that you've been trading on and that you're comfortable with. Another type of money stop that's really, really popular and really used, a lot more, I think, than MAE, is trailing stops. And this is a great idea. I mean, the idea is that you raise the stop loss price as you make profits, right? So you have your initial stop loss when you first buy because you always are going to set a stop loss. But then as it starts to rise, it's working out, your analysis has worked, and the price is rising, and the trend is established, and it's going up, you're going to start a stop loss along the way. So basically what you're doing is you can do it on a percentage basis or a fixed amount, percent or a dollar or rupee or whatever type of currency amount. How frequently you're updated, that's up to you. It could be daily, it could be more frequently, it could be less frequently. But the idea is that you're updating your stop loss to capture some profit. And let's say you want to set it as a percentage. Like maybe you say, well, I want to keep raising my stop loss to cover 80% of the previous day's gain, right? So it's going up, and now each day that it goes up and you're in a nice upward trend, maybe I'm adjusting my stop loss upward, so I'm always capturing at least 80% of the previous day. And if it goes like that over several days, you can see how I'm really capturing a lot of profit all along the way while still giving me the safety net of a stop loss. But I don't have my stop loss all the way to the bottom when my initial thing, waiting for it to go all the way back down. I want to capture some of that profit. And that's where a trailing stop helps you. The key is to keep the stops updated to protect those gains and guard against losses at the same time. So that's why it's nice. It's kind of works in concert with targets as well. So the benefit of all that is it's highly protective, right? You're not waiting for it to go all the way up and all the way down. You're going along with it as it goes up, so it's highly protective, and you're locking in those gains. The downside is there's some frequent updating might take time. It depends on how often you're trading, how many securities you're trading. If you're trading in lots of securities and you have many of them in play all at the same time, it takes time to check them and update them. And also some random noise activity can activate your stop and get you out before you want. So if you're capturing, let's say 80% of the previous day's gain, that's pretty good, because that would be a 20% downward move. You've already locked in a lot of gain, but maybe you want to make that a little bit less of that. But let's say I'm setting my stop limits at, let's say 2%, a 2% drop. Well, 2% or 98% of the gain. Well, then I'm looking at maybe where it might drop 2.5%, 3%, and my stop loss is activated, as in I sell the security automatically and locking in those gains, which is a good thing. But then the downside of that is, maybe that wasn't really an event, and maybe I missed out because now it went back up as far as the profit. So you can adjust that as far as covering those, putting those trailing stops in, and then just adjusting it either on a percentage basis or a fixed amount. The last 3-day rule is an indicator-based stop, right? So we're going to use our tools here. So it's very basic, but it really works. I mean, it follows along the lines of your indicators and market sentiment as well. And so the idea that if your analysis works, right, you've done all this hard work to identify a trend, you should start seeing some profit right away, right? It might go down a little bit, and things move a little bit, but the idea is you're identifying a great opportunity to buy in as far as on this trend. And if you're wrong, let's say it's not the great time, or it just doesn't work out, then you have time to get out quickly too. So you could set something like a round indicator that's also around a little bit timing too. Is you could say something like you would exit if the price passes the lowest low of the last 3 days, right? So an uptrend would be a series of higher highs and higher lows. And if that doesn't seem to be happening and it really starts kind of turning the other way, you can get out real quick in a 3-day rule or whatever your time period is, but typically it's a 3-day rule, that if it passes the lowest low of the last 3 days, that's the time to get out. Not just because it went down a little bit, but it's past the lowest low of the 3 days, and that's constantly kind of moving forward along that. So you're looking at your indicators as far as highs and lows, and you're using 3 days, so it's a little bit of a combination with a timing indicator as well. Another indicator, another stop that's out there, as far as the last one to really kind of look at here, is a pattern stop. And this is an indicator-based stop. And this is where you're trading off of your indicators. You're trading off indicator patterns. So some patterns will tell you where to put your stops, right? You're approaching either a support or resistance line, and you're looking for that, and you're seeing if it's breaking through. Let's say like a support line as an example, and it's going to keep going downward, not bouncing off that support line and go back up. So it's like using, and you can use it for profit targets. We talked a little bit about that too, but it's really just the opposite. So you'd really be looking at, like where you have a channel of some sort at those support lines. If you bought something and you're going to set a stop loss maybe at or maybe a little bit below the support line. That way, if at some point, if something happens that breaks through the support line, you're selling, then locking in some profits. Or you could do it, where you get more towards a resistance line, and maybe halfway through you just want to get out because you don't even want to approach. You think it's hit the support line too many times. Maybe you want to put it in more towards the middle and get out a little bit sooner. So this is an idea where you're using your indicator to kind of tell you where to put your stop loss and really buying your, and making your trading decisions. So let's say in the example, let's say you look in the far left there, let's say you buy near a support level and you're anticipating a price rise. Let's say we're at the far left of this example chart here. And you would put a stop loss below the support price. You bought at support, maybe a little bit higher than that, and at the support level, so you put your stop loss below the support price line. In case there's a downward trend, all of a sudden breaks through that level. Something happens, there's a big event, something unexpected, and it breaks through that level. So there you've protected yourself against those losses. And then as it rises up, then maybe you want to, sell as it approaches the resistance level, and then repeat it over and over again. But you can see this one, this is an example where it goes up to a nice resistance level, but then comes down, but doesn't get all the way to the support level at first. It does after a second trend or a second rise up, kind of where that middle arrow is. And so you're kind of watching that as far as maybe I would raise up my stop loss and make it more of a limit where I might go a little bit higher above the support level, or maybe I go a little higher than that even to lock in profits. So you have to kind of look at that as far as how you want to do it. But the idea is that you're using an indicator of some sort that's going to tell you that when this indicator condition happens, that's a sell signal, and I'm going to sell on that. And you need to kind of watch for that as far as when you establish your trades. But you're already kind of have that in there, and you've set a stop loss based on that indicator at the time of buying. That's the key. Again, you're always doing it at the time of buying to minimize those losses and hopefully maximize those profits. So stop losses, very, very important. Do it. It's going to really help you become a more successful trader for sure. Because really where people get in trouble with trading is if they don't have stop losses, all of a sudden something happens and it drops real dramatically in price, 10% down, 15% down in a very short period of time, within minutes or hours sometimes. And all of a sudden, boy, now you've set yourself up for a losing proposition. And that's where if a stop loss on place, where a lot of traders will be like in denial, like, oh gosh, you went down so far, 15%, it's got to come up some. And maybe it does, maybe it doesn't, maybe it trades sideways for quite a time. Either way, you're more like locking in losses at that point. As opposed to profits, you're locking in a loss. So having a stop loss, kind of takes you out of those trades that maybe just don't work out. So when you have your great trades that are going to hit these target prices and really have these nice profit runs, you're going to do great with those and minimize losses on the ones that maybe don't work out as perfectly as you would have hoped. Let's say you bought a security and it's, and you're looking at it and something's happening and you want to adjust your position. You want to either put more in on that same security or maybe take some of your profits out, for example, or take some money out. And that's what we're going to talk about as far as adjusting positions. It's really changing the amount that's invested in an existing position. So this is not buying a new security. This is a security you're already in. Maybe it's going up, maybe it's going down, but you're already in the security and you want to adjust how much money you've invested in that, either up or down. And there's phrases for that. One is called scaling in, right? And that's basically simply I'm adding to my position, right? I'm putting more money in. That's going to increase my risk because now I put more money in and potentially my reward because I put more money in too. So that's the idea of scaling in. I have a feeling that things are going to go well, and it's maybe already going well right now. So I'm going to put a little bit more in to try to, capture even more profit and have more profit because I'm putting more in. I'm going to put more risk, but I want to get more reward. So that's putting money in is scaling in. Scaling out is taking money out, right? That's reducing a position. And the idea is I'm trying to reduce my risk. I'm trying to reduce my exposure. I might miss out. Maybe I've invested in it. Maybe it's gone well. I've got some profits, but now I want to take some profits out of there by not selling the entire position, but now I want to adjust my position and scale a bit of it out, scale out and take some of those profits out and leave some in to ride up a little bit higher maybe too. So scaling in or scaling out is, again, adjusting your position within something you've already invested in. So the most important question, and the first question to ask yourself when you're looking at adjusting a position, is to really, truthfully, honestly ask yourself, why? Why am I doing this, right? Why do you want to adjust your position? Is it just a feeling? Maybe you feel good because the security's been good, so it's been a gut feeling, like I just kind of feel good about it. Well, that's not a great reason from a technical analysis standpoint. You have to go with your gut. Somebody said something on TV. That's a common one too. Like, oh, my investment's done well. Oh, somebody said some good stuff on my TV, so now I'm going to put more money in. Again, not true technical analysis. I would be cautious on that too. Sometimes you just come into some more money, right? You got a bonus at work or inheritance or something, or you decided you want to take some of your savings and put a little bit more into your trading account because you're feeling more comfortable, you're seeing some results, you're seeing some profits. So now that you've added more money to your trading account, you can start using that to either create some new positions, or maybe you have a good position you want to scale into, you can add some more money into that as well. Or maybe you're seeing other opportunities out there where you're scaling out, where I want to take some money out of a profitable position, and maybe I'm looking, that might be starting to run its course, but I'm not fully out of it yet. I want to let it run it a little bit more. I want to take a little money out because I see another security I want to invest in. So, so that's more around money management. That's not a bad idea as far as adjusting your position around money management. Just so you're not doing it on a gut feeling. And really, what really we want to drive this all around is technical analysis, right? This whole idea of trading and buying and selling. So your indicators are telling you something that might, say to yourself, why am I doing this? Well, because my indicator is saying something to either buy or sell, or buy as in a scale up, or sell, scale down, based on what the indicator is telling me. And that's always a good reason as far as, making a trading decision and adjusting your position. So if we think about that scaling in and scaling out, scaling in, increasing our position, maybe something's changed with you where your risk appetite's changed, right? As you learn and as you apply your trading knowledge, you might be more comfortable taking on more risk. And so maybe we start with smaller amounts of money. It's not a bad idea. First paper trade, but after that, with fake money. But after that, maybe you want to put in smaller amounts. But now you're like, you know what, I'm feeling more comfortable, I can put in a little bit more, and I like this existing position, so I'm going to put a little bit more into that one, because I'm willing to take on a little more risk to get that reward. And there's another thing where you might scale in and use a technique called pyramiding, kind of like a pyramid, right? And the idea is you have some built-in profits already. You're kind of playing with house money. You've had a nice trend up, and you've got some profits, right? And then you're adding funds, and then you're going to adjust your stop loss to protect those gains, right? So kind of that pyramid, that trend is like a pyramid where it's kind of going up, or the whole thing's going up. So it's gone up. Now I'm like, okay, I'm going to adjust my stop loss up to protect those gains, and I'm going to put a little bit more in because I've raised my stop loss up, that even if with the new money, if it goes back down, I've got my stop loss to stop me here and lock in the previous gains and minimize my losses, maybe if I put something new in. And if it keeps going up, then I can adjust my stop loss to follow along with it. So that's the idea of pyramiding. You're kind of playing with house money. You've had some profit. you're locking in that profit with your stop loss, and then you're putting more in to scale in because you feel good because your indicators are telling you it's still good to keep investing in it, but you're adjusting your stop loss to protect those gains, and you're protecting the new money at the same time from a significant loss. Scaling out, some ideas around that as far as reducing your position. Again, that's all about money management. We're looking at money management, and we're trying to reduce our exposure. Maybe there's some big news that's coming up, right? There's something going on where there's a big news event, something is going to come coming up that's on the calendar. It might be a government type thing that they're talking about with currency, or if you're looking at securities, that might be stock-based securities. You're looking at a company event. Something's happening that you know is going to be coming. There's going to be an announcement. Maybe it's a presidential election. You're not sure which way it's going to go. There's something coming. So you might want to scale out or take some of the money out prior to that news event if you're really kind of concerned about which way that news event might go, especially if you think it goes not in your favor, then you might be able to drop real quickly. Again, that's where stop losses will help protect you a little bit too. Or you want to scale out, I mentioned a little bit before, where you want to use that money for a more attractive trade. Maybe you've invested and something's gone up real nicely and you feel real good about it, but it's starting to lose steam. Your indicators saying it's starting to kind of peak out. You might see some exhaustion coming there. You're like, well, let me take some of those profits out and put it over here because I got a great trading opportunity over here based on my indicators. So I have less money risk there that I've already locked in those gains by taking it out, and now I'm putting it in another trade. So that's scaling out as far as reducing your position. And so you see a lot of things around scaling in and scaling out. You're going to combine your indicators, to help you understand logically what to do. But then you're using things like money management and risk appetite and things like that to kind of look at overall from a more holistic standpoint as far as adjusting your positions in there. And again, not gut, don't have a gut feeling on it. Use your indicators. And lastly, always ask yourself, why? Really be critical to yourself on that question of why. Why am I doing this? And if it makes sense to you, do it. If it doesn't, well then don't do it. It should be a real clear that you should be able to clearly explain the why behind that you want to do this. So good luck with scaling in and out. It's a great way to kind of adjust and manage your money. Successful traders track the results. Tracking results is very important. It's your scorecard. It tells whether you're winning or losing. Otherwise, you're just doing lots of orders and all that. That's fine, but you really want to know, am I succeeding or not succeeding, right? So tracking results is your scorecard. Are you winning more trades or losing more trades? What's your win percentage? What are your profitable trade percentage versus, let's say, the losses you have? What's your loss percentage? And looking at actual money amounts, because in the end, it's what we take home as far as our profits that really matters. So you want to look at your actual money amounts. And one thing when you're tracking results, and we're going to share some ideas around this, is to give enough time for the number of trades to be valid. Think about it like statistical validity around that. And there's no hard rule number about that. You'll kind of get a feel after you do some trades as far as, okay, I've done 30 trades like this and I've lost every one. Well, then you might want to change that concept that you're using, for example. That's really extreme. That wouldn't happen. But you don't want to trade something twice and find out it didn't work and say, oh, I'm just going to have to change my whole approach. Give it enough time that you feel comfortable that you've given it a fair shot as far as a trading idea or strategy or the combination of indicators you're using, your primary and your secondary and a third one, and how you're using them. Give enough time to show that there's some validity around that. Now, what you want to do is you do want to track every trade, right? That's what gives you data, right? Some of the most successful companies, what they're good at is managing data, big data. We've heard about big data, for example. So you want to have small data, I guess, or big data to you as far as knowing your data, knowing your results. So you want to track every trade. It can be simply just on a spreadsheet or whatever. So you want to track every trade. You do want to, if you have an outlier trade, something that's outside of your normal trading norm, right? So maybe you have a primary and a secondary that you use as far as your indicators and tools, and maybe there's a third one you use to in some way, that's or fourth or whatever it might be. But let's say sometimes there's an unexpected opportunity where you want to try something that's outside of your norm and to see how that goes and all that. That's fine. Just track that separately because that should not impact your normal trading pattern when you have an outlier out there that you're experimenting with or trying, or you just think you just see this tremendous opportunity. And what this will all lead to is a calculation where you can kind of measure your performance. And that's what we talk about in the next lesson around the expectancy ratio. How much can you expect to make per trade? So when you track your results, you've got all this data, as far as your trades, and can we use that in a way to kind of give ourselves like a grade, right? Or or a measurable number that we can look at to see if we're improving or how well we're doing and how much we can expect to make on each trade. And you can, it's a very important measure, simple to calculate, called the expectancy ratio, and that's what we're going to talk about here. And your expectancy ratio is based on the set of indicators you're using. I mean, that's your trading indicator plan, so you're using that with your plan. And the whole goal of the expectancy ratio is you want to see how much you can expect to make on each trade. You know, if you do 50 trades, you would know how much you would make on average on each of those 50 trades. Some of those trades are winners, some of those trades might not have worked out as well. Either way, you're going to have, they'll go into a calculation, the expectancy ratio, so you can kind of get a feel for, you know, how well you're doing. And the expectancy ratio is simply looking at your average profit, you know, how much you make per winning trade, you know, times your winning trade percentage, right? How much percent of the time are you winning or profitable? And then you subtract out of that the average loss per losing trade. That's where your stop loss orders can help minimize that, times your losing trade percentage, right? So a pretty simple calculation. So if we looked at, let's say you're using an indicator as an example, we'll call it indicator set 1 here. So this is your indicator you're using. It could be whatever combination of indicators. We're just going to call it your primary and secondary. Let's say there's a third as well. But that's your indicator set 1 that you're using and that you're really committed to. And let's say, again, whatever currency you use to submit different numbers. I'm using dollars here, but let's say that your average profit per winning trade is $800. That's pretty good. That's okay. Times 35%. Your winning trade percentage is 35%. Well, that's not great, you know, so you would love to be above 50%. So you can already see this might not be so good for us, but if we can minimize our losses, maybe it won't be so bad. And we do. Our losses are only $400. So our wins are $800, our losses are $400. So that's a good sign. Though we do have more losses in this indicator set we're using. 65%, again, it's going to add up to 100%. 65% is our losses. So you do the math and you see 280 minus 260 and you get $20. So what you can expect to make per trade is 20 units or $20. And you may say to yourself, well, that's not that great. I could do better. You know, maybe you're looking at that. So this is where you want to adjust your indicators, track those results, and then try a different set of indicators on that. So let's say we did that, and we now have indicator set number 2. We're not using number 1 anymore. We're trying a different set of indicators, and we're tracking it separately to see how well we're doing. We want to get to that expectancy ratio. How much can we expect to make per trade? So let's say in this case, we're using a different set of indicators. Maybe we're being a little more conservative on the profit side. And so we're making less profit per trade. We're making only $600 instead of that $800. But you see our winning percentage in this example went up significantly. Now we're at 55%. You know, that's not knocking it out of the park, but that's pretty good. So we're above 50% at least. And then we're still minimizing our losses. In fact, we actually reduced our losses a little bit to $300 per trade, and our percentage is down there too. So then you do the math, you can see 330 minus 135, and we come up to expectancy ratio of 195. Much, much better, right? Now we're making 195 per trade, and you can keep adjusting your indicator sets or keep tweaking this a little bit until you can get to, you know, expectancy ratio that's working for you, and you can kind of repeat this over and over as the idea. But right now, let's say we're at 195. Thus, if I was to make 100 trades over, you know, however time period, a month or 2 months, however often you trade, maybe a day if you're, you know, fast doing lots of trades, you can expect to make, you know, 19,500, right? So that's 100 times your expectancy ratio of 195, 19,500. Thus, when I get to 300 trades, I'm going to be at 58,500. You know, so again, you're going to have some wins and you're going to have some losses, but when you look at the difference between them in calculating your expectancy ratio, you know, then you can kind of see what your your potential profits would be and see if you're doing that. Now, you can make that number even better, of course. I mean, if you increase your win percentage, right, and you're winning more trades, or the amount per trade that you're putting in, especially on those winning trades, is higher, you know, you can increase those amounts. You know, note, you know, it goes the opposite way. If your loss percentage increases, or you decrease the amount committed per trade, then it would, you know, it's all mathematical at this point as far as your expectancy ratio. And again, a reminder too, that if you like that and you say, I could do even better, and you change to a third indicator set, well, then everything changes. Now you need to start tracking separately under indicator set number 3. And let's say your indicator set number 3 does great. It does 250 expectancy ratio. Well, now you've got a new indicator set. But if you do your indicator set and you give enough time to show whether it's working or not, and it's doing less than that 195, well, then the smart move would be to go back to that indicator set number 2, as far as, certainly maximizing your profits around that. So hopefully you can see here how powerful it is to know your expectancy ratio. You know your wins, your losses, you know your scorecard, and you know that every time you make a trade, even if you're not so sure about a trade, you can say, well, I expect to make this much per trade. I know I'll lose some. I know I'll win some that'll go well above, let's say, the 195 in our example. But in the end, I know, in using this example again, I know that if I use this indicators that I put together, my primary, my secondary, maybe some other ones with it, and I can expect to make, as an example, 195 per trade. Well, that's a powerful kind of confidence boost, but also it's a great money management way to say, am I on track or off track? Or if I start changing my indicators, what impact is that? So understanding your expectancy ratio, tracking your results, calculating expectancy ratio can be very, very powerful, and I would certainly encourage you to do it. Another key aspect of your overall approach to investing and trading in securities is actually how you place your orders. There's different types of ways you can buy and sell a security, and different types of strategies you can use with your online broker, your broker, as far as the type of order you want to place. So this section is very important as far as the different types of orders that are out there, their strengths and weaknesses, because each order has a different type of strength and weakness, and more importantly, each one has a different purpose on it. So these different order types serve different purposes and can be part of your overall plan. So we're going to look at the most common types of orders here that you're probably going to use 98% of the time or whatever. So, and you won't even use all of these order types because we're going to give you a full, complete aspect of the most common order types. But understand that sometimes in success in trading also involves, applying and using the right order type as far as when you actually place your buy or sell order. The simplest and most common type of order is a market order. In fact, when most people think of I bought a security, or I sold a security, really what they're talking about is they placed a market order is what they're doing. And market orders indicate that you're willing to take whatever price is presented to you, when the order is executed. You could say, well, that's the market price as an example. Now, it's not a locked-in market price. You might see it on your screen and place the order, but by the time the order is executed, it might be slightly higher or lower than expected. So it won't necessarily be the exact price that you're seeing once, because it all depends on the timing of the order execution. Securities that are frequently traded will execute faster, heavy volume type things, but some things like some securities that don't trade as often and have very low volume, it might take a little while for that order to be processed to match a buyer and a seller. So a market order, very simply, I'm buying or selling at the market price. And then there's another thing called a limit order where you can kind of adjust that. And a limit order basically allows you to limit either the maximum price you will pay or the minimum price you're willing to accept when buying or selling a security. I'll place a limit order and say I want to buy, but I don't want to pay more than this, or if I'm selling, I don't want to sell for less than that, is the idea. And that's the primary difference between a market order and a limit order, is that a limit order may not be executed if the target limit price is never reached. So let's say the market price is at 70 and if you put in a market order, it would be executed. But if you, let's say, said, oh, I don't want to do that, I want to, I don't want to pay 70, I'm willing to pay 68, well, then it might not ever be executed. So limit orders are executed in the order in which they are received as far as from the online broker. So, possibly an order is not executed if a price hits the limit target and then moves below it real quickly before the order is executed. So even if you see it kind of flash like, oh, it should be getting executed, because there might be even more, a little bit more delay there, that might happen as well. So let's look at an example of that, of both of these. So let's say you have the security here, and you've done your trend lines, and you can see, oh, look at this nice trend here on the image on the right here, and you say you want to buy on the second touch, or near that trend line. All right, so you see that. Let's say it's on a daily time frame, and so you're going to buy on the second day. You've seen the second touch as far as the close. Now you're buying on the second day, and as you can see on that second day, there's the last candlestick in our image here. You can see there's a wide range of prices from high to low. I mean, it tops around 73, and then goes down as far as the range down to about 71. So if you place the market order, depending where you're buying in the day, it could end up at any of those prices. And let's say you're looking at it, it's around 72.75 or 72.80. You place a market order, and it gets executed. It ends up being executed at 72.75. So let's say that's what you're looking at in this particular example. But let's say you're looking at 72.75 and you say, Well, I don't want to pay that. I want to put a limit order in. I want to pay less than that. This is a buying situation. So if you put in a limit order for 71.50, let's say, well, that would be executed. You could see, depending on how it all flows during the day, but as you can see, at some point, there's more likely a chance it's going to hit at that 71.50 in that range throughout the day, as it would have turned out. You don't know ahead of time. That's how it would have turned out. But let's say in this day, and you're liking this trend, you say, well, I don't want to pay more than 70.50 or 70.50. Well, then you can see it never really got that low as far as in the trading range. So your order never would have been executed. Then you would have to wait till the next day and place a different type of order, or cancel that order and place a different type of, either a market order or raise your limit order up. So that's the thing with market orders. You're going to be able to buy or sell right away. And then with a limit order, you're setting some guidelines around that in terms of buying or selling. And just understand that depending on what guidelines you put, your order might not be executed at all. And don't be disappointed in that. That's just all part of the strategy of using limit orders to limit, how high you'll buy and how low you would be willing to sell, to give you a little more protection around that. An all or none order, performs a certain purpose. So let's say you want to purchase a substantial amount of a security. You're buying many units or shares of a security. And it may take a while for the order to be completely filled, because you might not have somebody on the other side, let's say, selling that security. So they're buying it from several different sellers, many different sellers, to get you to your total amount, because you're buying a large number of units or shares of the security. So it may take a while for the order to be fully completed, and so you might end up paying different prices for different parts of the order, right? So because you're in effect buying from different people, different other traders. Let's say if you're doing, let's say, a market order, for example. But you can place an all or none order, which requires that the security be purchased in a single transaction or not at all. That's the key. I'm going to buy it all the substantial amount all at once, or not, or the order is not going to be executed. And that's what can be the downside of it. However, that also means your order may not be executed at all if there are not enough shares available to fulfill it in that all or one, purpose, so to speak, or all in one time. So your order will stay open until it's canceled or it's executed. That's one thing too with all or none orders. Typically, again, your broker will have different terms around it, but typically that's the idea of an all or none order, is it's out there and waiting to be fulfilled, which also gives you a little less control if it's taking a long time to be fulfilled. Another way you could approach it is with a fill or kill order. A fill or kill order means it must be filled immediately in its entirety, or it is automatically killed, or in effect canceled. Thus, a fill or kill order may never be partially executed either, right? We're going to fill this immediately, or the entire order is canceled, or there's a certain period of time, maybe by the end of the trading day, where if it's not filled, it's killed at the end of a trading day. You also have the immediate or cancel as another type of order type, and that's similar to fill or kill, but the difference between this kind of trade order and fill or kill is that this order allows partial amounts of the order to be completed. So when shares are no longer available at the limit or a better price, buying or selling immediately ends and the order is canceled, right? So you're buying at a limit price, you're buying these shares, you're buying partial amounts, but if there's no longer immediate shares or things available, then the rest of that is immediately canceled. So fill or kill is like, basically I'm going to fill everything in its entirety, or it's not going to be executed. Immediate or cancel means we're going to fill this immediately, and we're going to allow partial amounts to happen. But if it doesn't happen within a certain time period, in terms of what is determined to be immediate, then the order is canceled, or the remaining order is canceled. And a lot of orders are under day orders, and that's where they're good until the end of the regular trading day, at which point they're canceled if they're not filled. That's a real typical way all these are kind of worked. And all market orders, for example, are placed as day orders. If your order isn't placed by the end of the trading day, then it's not filled. So if you're trying to get a last trade in the last minute of the day, maybe it doesn't get filled and your market order doesn't get executed. In terms of that too, you also have what's called a good till canceled order. Is a good till cancel order remains open until one of three things occur, right? So one of three things is going to occur. Either your order is completely filled, which is kind of what you want, like I place an order and my order is filled. Or I cancel the order. At any time you can cancel an order, so you can cancel it. So it's good, the order is good till canceled. Or a certain time period that's determined by your broker, your online broker, has passed. So it's not necessarily a day order. You might have terms around, let's say, a good till cancel order that's good for 2 days or 3 days, however, the time frame. So you could say, okay, I want my order to be completely filled. Don't cancel it by the end of the day. I'm the only one who can cancel it. But if it doesn't get filled by a certain time period, then it's going to be canceled as well. It just won't be canceled by the end of the day. So as far as risk with good till canceled orders is you may forget you placed the order and then it's sitting out there for a longer period of time, and you might not want that trade to be executed over at that later period of time. So if you play the other thing too is if you place a large trade with a good till cancel order status, you may pay, depending on your broker, a commission each day your order is partially filled. So let's say they partially fill today, they fill a little bit more tomorrow, they fill a little bit more the next day because that's just what becomes available. Then you're paying commissions or a fee on that because your order is being filled by multiple transactions over several days. Typically, if your order is filled by multiple transactions in a single day, your broker should really be charging you only a single commission is typically how it works. Again, each broker has its own fee schedule and how to look at it, so look closely at that, particularly with things like good till cancel orders or orders where there might be partial filling of it to make sure you're only getting charged one fee and you're not just getting overly crushed for fees. So look at that fee schedule from your broker on that. But understand the good till cancel orders are out there until you cancel them. So just be aware that you might be putting yourself a little more exposure on that. A short sell order is related to shorting a security. And that's a whole big practice around shorting and how to identify short selling and all this kind of stuff. But let's walk through how the actual order works and what's going on with a short sell order. So selling short or shorting a security is a practice that enables you to profit if you correctly predict that the price of a security you don't own will fall. So that's the idea. You don't own the security yet, you think it's going to fall, and you're going to place a short sell order that's an order that kind of lets you take advantage of that situation. So let's walk through an example to make that a little bit easier to understand how it actually works. So let's say you think a security is overvalued, and we're going to use dollars again in this example, again, use your currency. But let's say the price is at $12.50. You say, that's way too high, that's going to go down. So what you do is you're then going to sell borrowed shares, let's say at $12.40, the price you believe to be, at $12.50, that is the price that you believe to be inflated. So you're going to sell these shares, you don't own them, you're borrowing them, and you're going to sell them at that. And then you enter a short sale order for 1,000 shares, for example, borrowing the $12,500 worth of shares, 1,000 times $12.50 each, selling them on the open market and collecting the cash, right? So I'm borrowing shares, I'm selling them for $12.50, I'm collecting the cash, and then if the security price does indeed fall, you can use the next type of order to complete your short sale and make a profit. That's the idea behind it. It's a two-step process. Thus, the next step in the process is a buy to cover order. This is where they work together with short sellers. So a buy to cover order is, let's say the security did as you predicted, and it did go down. It fell down to 10.50, right? So let's say it went down. You would place what's known as a buy to cover order to complete the short sale. Your buy to cover order would repurchase the 1,000 shares for $10,500 and return the borrowed shares to your online broker. That's kind of how it works, is you're returning these borrowed shares. And so you're purchasing them at 1,000, and because you bought the shares for $2,000 less than you sold them for, then you made a $2,000 gain, is the idea of using these numbers here as far as this example. So you're borrowing shares and you're selling shares, and you're doing in two steps as far as a short sell order and then a buy to cover order. And again, the whole point of short selling is you're looking at things that you think are going to go down in price. That's the whole idea, is it's a downward movement. So this is where your downward trend lines and things where indicators are showing a downward price move is where it's going to come into play if you want to sell short. Okay, some very important considerations with short selling. In order to sell short, you have to have what's called margin privileges in your brokerage account. That means you can trade with more money than you actually have in the account if you wish. This is the borrowing part. It might also be known as, it also is known as buying on margin, is the idea. And in fact, you're borrowing, right? So you're basically, using more money than you have in your account. You must maintain, though, enough purchasing power in your account to carry out a buy to cover the order on your short sale. So if I'm short selling something like for that $12,500, I need that amount to cover that. And that way, if the and where the margin part comes in, if the price of your short stock actually increases, remember you're doing this thinking it's going to decrease. You're really betting hard on that. But let's say it actually increases, doing the opposite of what you thought, and you don't have enough money in your account to buy the shares back at the higher price, in effect taking a loss, you will face what's called a margin call. Basically, it's a common thing. It's a demand by your broker to put more cash or securities in your account to be able to cover the trade. So borrowing money on margin, or leverage is another way of saying what you're leveraging your money, can really either accelerate gains or accelerate losses. So if you want to get involved in like short selling, it's something to be very, really develop your education around that even further, to get really in depth around short selling. The technical tools that we're learning here will help you use the indicators to identify short, downward trends and opportunities, but there's a lot of this, ordering part that can be a big part of that as well. And so it can be a challenge. So for example, in the year 2020, many people thought that Tesla, as far as a stock, is a security, as a stock, so for example, was overpriced, was way overpriced, so they shorted the stock. This is way too overpriced, we're going to short it. But in 2020, ended up what happening was Tesla rose about 700%, just a huge amount of rise in that. And it led to headlines like this, like Tesla short sellers have lost more than $39 billion betting against the stock in 2020. Because again, they're saying it's going to go down, and when it goes up and it goes the opposite direction, that's how they incur their losses. It's in effect the opposite of more traditional buying of securities, where I'm going to buy low, I'm going to let it go up high, I'm going to follow my upward trends, I'm going to sell at a profit. In this case, you're doing the exact opposite. You're betting it's going to go low. So just like if you buy and you think it's going to go higher and it doesn't, it goes the opposite way, you're going to lose money, is the same thing as selling short, just the opposite. I think it's going to go down. Boy, it didn't go down. It went up. I'm losing money. In fact, if it goes way up, I'm losing a lot of money. And if I'm buying on margin and doing those things too, which is part of short selling, and some complexity to it, then it becomes even more of a challenge. So again, short selling, is something to be a little bit more aware of as far as some expertise around there. Whenever you trade a security, if you're an active trader, you want to put in stops at the same time if you're putting in, let's say, a buy order to help minimize your losses on the downside, because, of course, nothing's perfect. So you want to help minimize those losses, and in fact, that's also maximizing your gains by minimizing your losses. So we're going to talk about this important aspect, and we're going to look at 3 ways of doing a stop loss, a stop limit, and an interesting one called a trailing stop order. So we're going to cover those 3 here in this lesson. And you'll want to be familiar with all 3 because you can use them in different situations. So a stop loss is the real key one, kind of like a market order is it's used all the time for buying and selling. A stop loss is used all the time as well. And really what it does, it's a stop order that automatically converts into a market order, in effect a sell market order, when you reach a predetermined price. That's the stop price is reached. So if the security falls and the price falls to a certain point, it hits my stop loss, the order is going to be automatically executed at a market order. And at that point, the ordinary rules of market orders apply. So the order is guaranteed to be executed. They're going to execute it, but you don't know the final exact price. I mean, if things are moving quickly, you might see a little bit more, loss from that. It's going to be executed at the market price and executed quickly. Now, a stop limit gives you a little more protection around that. In contrast, a stop limit order automatically converts into a limit order when the stop price is reached. Remember that lesson around buy and sell limit orders. So the minimum price you are willing to accept, so this would be a stop limit, would be the minimum price you're willing to accept when selling a security. So as with other limit orders, your stop limit order may not be executed depending on the price movement of the security. So let's take a look at an example of both of these so it kind of brings that home. So let's say you want to buy a security here. Here we're looking at that upward trend line here, and we are going to buy on that day that we've got highlighted. And let's say you end up placing a market order and it's executed for 72.75. So that actually happened. So let's say that happened. At the same time, or that's the order you placed, that is. And you could or should place a stop loss or a stop limit at some point as part of this. And let's say you place a stop loss at 70. So if the price was to fall down to 70 at some point, either now or into the future, could be days from now, weeks, months, years, whatever. If sometime in the future it falls down to 7, 70 and hit 70, and then it's automatically going to execute your stop loss order and turn it into a market sell order and execute that at 70. You could also place, or alternatively, you could place a stop limit. You place a stop limit, there's two pieces you put in. One is the price as far as the stop loss being active. Let's say in this case you like that 70, so you're going to put that in. But it puts a limit on what you would sell it at. So you'd say, okay, I want to put my limit at 69, which basically means you're not going to sell or tell the online broker, and it's all automated, don't sell below this price. So two things have to happen. Let's say I bought at 72.75, I put in a stop limit, I say, okay, my stop loss will become active at 70, in a stop limit order. And then if it hits 70, it's going to try to execute that. But let's say things fall quickly, and it reaches 69 or 68 or 67. Once it hits that 69, then nothing's going to happen. Your order won't be executed. So as you can see here, the idea is it's protecting you from something where it's going way down in price, and you're like, well, if it goes way down in price, maybe I think it'll come bouncing back up again. Or I know my security, if it goes down far in one day, it tends to rebound back the next day. So I don't want to sell at that point. I want to just have a stop limit at 70, but if it starts going below 69, I'm okay. Now, obviously, as you can see, there's no end in sight, so you want to be able to watch that, and you might need to cancel that order and just place a sell order, a market sell order, for example, if it starts going to 65, 64, 50, whatever it might be. So that's understanding how you might use those two orders. The most common, of course, is just using just a stop loss order. So once it hits it, it's executed, you're out. The third type that's very interesting is a trailing stop order. And it's one way to help protect gains and limit losses automatically is by placing this trailing stop order. And with this kind of order, you set a stop price as either a fixed amount or a percentage of the current market price as the price, let's say, hopefully goes up. So you can choose that that you'll be entering in there. So let's say, for example, you bought something at 72.75, right? Let's go back to our example here. And it's executed at 72.75. You could place a trailing stop order of, let's say, 3. So that would be basically, if it goes below, as it drops below 3, whatever the current market price is, then the sell order would be executed. So in this example, I would say we bought it, ended up being bought at 72.75. Then at 69.75, a sell order would be executed if it ever dropped down that, because you set your trailing stop order in effect at 3. You could set that at whatever. You could set it at 1 or 2 or 50. You could set whatever you want it to be at. But the idea behind this is the trailing stop, the beauty of that is it's going to follow behind that market price. So if the market price, let's say, went up to, let's say, 80, your trailing stop order would be at 77. So you see how it's kind of locking in the profits as it goes up. So if we look at our example a little bit further, and now we can see what later happened, let's say, and this was a real security, so this is what really did happen. It's following it as the price went up, and the price peaked at, you see in the range of prices there, at the very peak, that top long upper shadow, about 74.50, let's call it 74.50. So then your stop loss, or your trailing stop order would be executed at 71.50. So you'd be locking in some of those gains, right? Because you bought it, or actually you wouldn't be, because if you bought it at 72.75, if you let it go down to 71.50 as far as a trailing stop, then it would execute and you'd actually lose a little bit on this. So this is where you might want to be, adjusting your stop orders as you go to as well. Or just, your security, if it has a good trend, it's going to keep up going further. And if it doesn't, fine, you want to get out. But the idea is, let's say that did go up to 80. Now your stop limit would be, your trailing stop order, that is, would be now at 77, and you would have locked in a nice profit. So that's the idea of trailing stop orders, is that they basically follow behind as your price goes up and then are executed there. And by the same token, when you first place your order, if the current price drops right away and never does go up, it's going to execute once it drops, let's say in this example, once it goes down 3. So basically, stop loss, most common, just to kind of minimize your losses there, most commonly used. Stop limit, you can have a little bit of extra control on it, is what it does. And the trailing stop order is nice, especially as you start seeing things walk up in terms of gains, that you can kind of lock in those gains by adjusting your stop levels as well. And with all these, you can cancel and change your orders as things change in your current trade. Bracketed orders are very interesting because they allow you to get kind of the best of both worlds, where you have a target price, let's say, for profit maximization, and a stop type of order to limit your downside losses. And so it basically goes one step further than a trailing stop order, for example. So just like that type of order, with a bracketed order, you set a trailing stop as either a percentage or a fixed amount, below the security price. So you bought a security, maybe as a market order, and now you're going to put in your trailing stop is how you do it. But with a bracket order, you're setting that, but you also, in addition to setting your trailing stop, you're in effect also at the same time establishing an upper limit that when reached will result in the security being sold. So kind of like a target. So in effect, you're setting a profit target and downside loss protection at the same time, all in one order. So that's very nice. Well, I don't want to say most, but not all, let me put it this way, not all online brokerages offer bracketed orders, by the way, so don't be surprised if you don't see it offered there. You would just have to basically, use your stops and other types of orders to kind of, in effect, make that happen. But bracket orders are nice and convenient that way. So let's look at an example. So let's say, here we are, we have this nice uptrend. You'd say you bought you could buy at a market, or you did buy at a market order for $72.75. That's what was executed. It was at $72.75. Then you're placing a bracketed order to kind of, go around that market order. You're bracketing that market order. And so let's say you have an upper limit of, you decide this, so you decide to set an upper limit of 74. That's your target. So you say, well, I want to have an upper target of this, and so I'm going to set at 74 to automatically execute at that if it reaches that upper target. But at the same time, in your bracket, you're setting a trailing stop of whatever percentage or amount. Let's say it was 3, just to use an example. So you'd be setting a 3. So at the current price, it would go, let's say, up to, it would be at $69.75, because you'd immediately put in that trailing stop of 3 if it fell down to that. But let's say it went up to 73. Your upper limit wouldn't have been reached. So the sell order to, basically book in your profit would not have been reached, but also your trailing stop now would have changed to 70, because it now went up to 73. 3 minus 73. 73 minus 3 is 70. So it would still stay active, basically, in that example. But let's say what happens is this is what really happened in this particular security. And as you can see, it went up, and the result of this example is you would have sold at 74, right? You set your upper limit at 74. As it turned out, on that long top upper shadow there, it did get to 74, and at that point, boom, it turns into a market order, and you're selling at the 74. Note that if let's say you had set your upper level was 76, then nothing would have been executed, because you had never reached that upper target, and the trade still would have been active until, in this example, it would have come back down and then been executed at 71.5, right? So because you still have that trailing number there. And again, if you didn't want to have a target or upper order, bracket, then you wouldn't place a bracket order. You would just place a stop order to minimize your downside, and then you wouldn't have to worry about having a target hit, maybe before you wanted it to be hit. But the idea is, if you're trading a security and kind of the range of that security, and you're comfortable with that, maybe it's in like some type of chart pattern, like a rectangle or something, you can put that upper and that lower limits by putting in a bracketed order. So just a couple of brief thoughts around order types to wrap that up. And some order types are pretty easy to get, like a market order and all that, as far as understanding it. And some order types are much more complex. So it's okay, to kind of review some of those lessons, or, try different things to try getting an idea of the order types. And that's another area where, like paper trading, practicing with fake money, basically, and with your online broker that has a paper trading account, you can not only practice using your indicators and your buying and your selling and all that, all for free, typically, all for free, and for, as practice, you can practice with different types of order types too, and start comparing, what's working well for you, what types of orders do you like, and what might be part of your overall plan. And also helps you understand the order types a little bit better too, because you can actually see them when they execute or don't execute, depending on the situation. So paper trading can be very helpful for that, in addition to reviewing the lessons. And understand, lastly, that order types are all part of your overall trading plan, right? So as we build out through the course here, you can kind of see we're developing an overall plan that's going to be your plan. I mean, it's your plan. It's not my plan. It's your plan. You're going to use these things you're learning and then start building it together in your plan. And part of your plan is going to be, what order types do you really understand well, that you like, that you can execute well. And you don't have to use all the order types. You just, want to make sure that you're aware of them. and then just use the order types that you feel the most comfortable with and are working for you. And then from that, that's just another part of your overall plan as far as trading, as on your way to success with trading, is executing an overall plan from selection with indicators all the way down to using the appropriate order types for you. This is going to be a real fun section because we're going to actually use real stocks and do some real trading, and you can kind of see how some of these concepts are applied. So looking forward to this section here, and you can watch as much as you want of this section or as little as you want. It's really kind of a good overview and application, and there's a lot of good learning that'll go on here. A couple thoughts before we get started in the section though. One is I'm going to use TradingView as far as the trading platform to demonstrate these different concepts. And really the only reason I'm using TradingView is for a couple really good reasons. One, they have a free version. So if you wanted to play around it with yourself or whatever, you don't have to pay any money. You can use the free version. It's free with ads. So there's a lot of ads that are going to pop up, but you can play around with it. You can play around with it today, in fact, if you want. It's actually very, very fully featured, in fact. And so it allows you to draw trend lines and do all sorts of our indicators we've used, from moving averages to Bollinger Bands to RSI to all that stuff. You can see all that in there. So it's a nice demonstration tool for that. And this is also very important for me and for you, for many of you, is it's worldwide. It really is on every exchange, or it actually taps into every exchange. And I have students from India, United States, UK, Asia, South America, Africa, you name it. I think I have one student in Greenland, so we're all over, right? So it's important that I use an exchange that, or a demonstration platform that can use lots of different exchanges. So if you want to practice on your own, you can use the stocks that you're familiar with. And then also it includes free paper trading as well. Paper trading is very important because that's what allows us to practice and do some different things. And when I'm doing the demonstrations, I'll actually be paper trading. So don't worry, I'm not, investing my own money or losing my own money. Hopefully I'm making some money. The idea is I want to show the concepts and really want to demonstrate that. So I'm using a paper trading account. And that's the thing you want to do too after the course. You want to use a paper trading account to start applying some of these things, start learning, start to see patterns, all that good stuff. So paper trading is great. So that's why I'm using TradingView, but there's a lot of other good ones out there. Stockcharts.com is one that's got some free stuff. And there's some in different countries that are good too. So you don't have to use the TradingView, but it might be a good place to start as far as something free. Also, if you've got an online broker, they might already have a lot of this built in. Some are very fully featured, like TD Ameritrade is very featured with their Think and Swim product, and others are a little bit less so, like some of the mobile type brokers, like Robinhood or eToro or Interactive Brokers are all very good in their own way, but maybe a lot of people like to use TradingView to kind of analyze and identify the trade, and then they actually use their online platform to do that, because TradingView doesn't have the money. They tie into some actual trading platforms, but like TradeStation, but it's a good platform to use to kind of apply and use some of your concepts. Also, when I'll be in the live trading section, the real key on this is not so much the stocks that I'm talking about or why I picked them or anything like that. Really, it was kind of random, actually. Really, the thing you want to see is as I'm going through, I'm sharing my thought process. That's what you want to watch for, really, is I'm kind of speaking my mind as I'm going through analyzing stuff, putting on trend lines on the chart, looking at relative strength indicators, looking at moving averages, changing the dates on the moving averages, a simple moving average, a weighted moving average, all these different things. And I'm going to kind of speak my mind as we go through it so you can kind of see how I'm thinking about how I'm approaching this. And that's really critical and really important. So you'll really mostly be watching that thought process. And then I'll be showing some of the indicators too. I won't show all of them necessarily, certainly not in every live demo. We're going to show some of the indicators and that you can kind of start playing around with on your own. And again, you can watch some of these or you can watch all of them. It's totally up to you as far as how much you want to invest or get out of this section. Maybe watch a couple, you get the idea, and then you move on. That's perfectly fine. However you want to learn is totally up to you. All right, so let's get started and let's go trade some stocks. Okay, I'm over here at tradingview.com. If you're using a different platform, that's perfectly fine. I just want to use this one because it's easy to use, relatively easy to use, and it's got a free version too. If you go to the free version, this homepage might look a little different, but there'll always be a spot where you can put in a ticker symbol right in the top here. So let's go look at some vaccine, COVID-19 vaccine companies, Johnson & Johnson, Pfizer, and Moderna, and see if there's some buying and some trading opportunities out there. And really the whole purpose is to demonstrate the concept. So that's the idea. We're going to demonstrate some of the concepts here. So you can just type in the full name, like Johnson & Johnson, if you're not sure of the ticker symbol, and it'll start coming up with different things. But let's say I'm just, if I know the ticker, I'll just go J&J. We'll start with them. You can see also that J&J is listed on a lot of different stock exchanges, so that allows you people in these areas to trade right directly with it. Otherwise, there's things you can do with a broker as far as your broker might support trading with it too. But we're going to use, of course, USC here where I'm at, and we'll see. All right, so here we are. We got Johnson & Johnson. This is their current trading price. And really what you want to get to, and there's always lots of information, by the way, on TradingView, but what you want to get to is on the full featured chart. They might show you like a little mini chart here, but you want to get to the full featured chart. If you're using the free version, you just look for something that's going to look like this little square here. If you're happen to be using TradingView. But the whole idea here is not to teach you TradingView this lesson, it's to demonstrate some of the things here that we're learning. So let's take a look at that. So it shows the long kind of history of it. Along the bottom, we've got E for earnings, D for dividends. This is a dividend paying stock, so it'll pay you income if you hold it for like more than a quarter. Usually it pays out it pays out a dividend quarterly, so there's some earnings and some quarters there. And you can kind of scroll by and move it around, whatever. I just use the mouse to move it down. So let's take a look here. All right, so this was the trading day is live, so we are open. You can see up at the top here what an open, high, low, close was on a particular day. So it opened at 165, highs at 165.31. So it opened at a high, but it's now dropped a little bit. It's it's dropping down here now. So this is you can see why this is red. But I was looking at this one. One interesting thing from a trading aspect is you can see they had a nice run up here. You could really look at it and say, oh, okay, it looks like they had a really nice kind of uptrend here too. I mean, you could go all the way back here as far as an uptrend and see, oh, okay, this is a really good uptrend here. Or even if we were to look at it more from, let's say, from a shorter type view, you can see there was a nice uptrend, kind of even coming from here. If we looked at that where there was a little bit of a pullback, and you can see that we've got an uptrend there. So with that, they really dropped here on this particular day because they had an announcement, right? This is an event. We talk about events, and for them, their event was they had an announcement that their shot for their vaccine is good, but it's only 66% effective, which in the history of vaccines, as my understanding, is actually really, really good. The problem is their competitors, like Pfizer and Moderna, we'll look at in a moment, they're running about 95% effectiveness. So if you're going to take a vaccine, you want to take the more effective vaccine, right? So that's why they dropped. Also, they weren't as effective in trials that they're showing against a South African strain of COVID. So you can see that's why they had this drop here, and what made them very interesting, we had a gap down, right? So you see the gap down, so we're moving in terms of a gap down. And then the question is, are we starting a new trend? Are we going down or whatever? So you can see they really, closed down. So this is the day because the red candle it closed down. This is the current trading day, and right now we're lower than the close. So this is all happening, but this candle could change by the end of the day. So we will take a look at that in a moment too. Now, one thing with Johnson & Johnson, let's say I'm a long view trader. So I'm not trading a short-term pattern. This is, by the way, based on days. I could change up here to, hours, minutes, whatever I want to do, weeks or whatever. We'll leave it at days here. And, but let's say I'm a long-time believer in Johnson & Johnson. As a person, you want to trade on a long view. So maybe I'm starting my trend line way back here because I'm doing a long view. And I draw a trend line all the way out to here, right? Because we're going to extend it all the way. And we can see, like from here, you can adjust these a little bit. You can see I have 1 touch, 2 touch, 3 touch, 4, broke through, but still closed above or right by there. So that's 5, 6 touches. So a nice, strong trend going. We had the event. It dropped to the trend line, actually went below the trend line as far as the wick or in the closes or the current prices are getting real close to breaking through that. You can see also, you see how this high volume spike here, that was trading on that bad news of the volume spike. But if I'm a long-term trader, I might say, you know what, that's okay. I'm going to buy on the pullback. And maybe that's something we'll do here is we're going to buy on the pullback. But let's look at some other information. Let's say that we want to look at a moving average, right? Maybe we want to look at a moving average and see how that's going as far as something a little bit more current on there. So this is our long-term trend line, but now we're going to put a moving average over the top of it is what we're going to do. So let's do that. So we're going here. We'll find, let's let's put just a regular old moving average, right? Well, actually, let's put a weighted moving average on there. So we're going to go find moving average. You can type it in the search too. And let's see here, moving average, there's exponential and weighted. Let's just use a regular old moving average, nothing fancy here. And I'm going to make that color, you can change the style here to make it a little bit more so it distincts out. So let's say let's do orange, and we're going to make this a little bit, brighter or deeper so you can kind of see. So as we see here, this is our current trading day. We've crossed below the moving average line, and this is a 9-day moving average. They default to that. You can change the defaults, but it was a default to that. So we've crossed that 9-day moving average. So that was a sell signal, right? So this is a sell signal that we're seeing here. But let's say, and again, we're not trying to make it fit, but I'm saying I'm going long on this, so maybe 9 days is too short. Maybe I want to change that input from 9 days. I want to change that to a 20-day moving average. What would that look like if we did a 20-day moving average? Well, it would show that we've approached our long-term trend line. This is a long-term line again, and that we broke through it here on the bottom wick, but we're still above it as far as a 20-day moving average. So, that would be an indicator that maybe we're still above, that we're maybe strong here on this. Another thing we could do is, let's say we did it instead of 20, we did 60, right? So let's see if we did 60 on that. 60-day moving average, you can see we're well above on a 60-day moving average. So the takeaway from that in trend demonstrate is how if you change your moving averages, that's going to change, what you're seeing there. And again, hopefully you heard me talking through it as far as if this might be a play to buy a dividend-paying stock. If you're going to hold it for more than a quarter, you might get a dividend. If you're going to hold it for a year or forever, this might be a great time to buy on a nice little pullback on some bad news regarding the vaccine. Remember, Johnson & Johnson, they do a lot of other stuff in addition to vaccines. They do Band-Aids, is what they're famous for, and they do a lot of other surgical type of support and equipment, and they do a lot of other pharmaceutical drugs other than vaccines. The other thing, too, with Johnson & Johnson, if we look at it from a long view, you could say, well, they're a one-shot vaccine, where Pfizer and Moderna are a two-shot, and they don't need any special refrigeration or anything like that, too. So at some point, as vaccines roll out, let's say, to more developing countries that don't have that specialized equipment, they might, and it's also less expensive, the vaccine for Johnson & Johnson, in addition to being one shot, each dose is less expensive. They might choose, okay, we're going to go with a 60%, 66% effectiveness, because it's going to be so much less expensive, and we can get it out distributed to our citizens, especially in rural areas or in areas that might be more developing. So that's a way you can think through in a long-term view. Short-term view, you'd say, well, look at that. It had a big drop. We're seeing some indicators there. If we go back to our 9-day, we can, or let's say a 5-day, let's go 5-day. You can see, we're definitely below, right? So we've crossed the line, we should be selling. So you can look at it different ways, but a long view person might look at this and say, okay, this is an opportunity to buy in here. Let's look at and try some other things. We're gonna put some other things around here too. Let's look at Pfizer here. All right, so I happen to know that Pfizer is PFE. Otherwise, you could just type it in. We'll go to Pfizer. It's kept our 5-day moving average, so you can see that Pfizer's been kind of bouncing around here, and you can see they had some early good stuff from the trials and things. And this is back when they got it released, so you had this real big, being first in the market. They had a big run up here, and you can see their 5-day moving average line here, and it kind of runs along with it. But we're definitely in a downtrend here, right? You can certainly see that in long-term wise, we're definitely in a downtrend. If we look at this peak and we go down here, I mean, if we ignore that little outlier, you can see we're definitely in a downtrend, and we would want it to cross above that. It's not too far from it, but we would definitely want it to do that, for example. But let's say we're looking more of a short-term trade on this. Let's say, okay, are we still in a downtrend? How's that looking? Well, okay, same deal. We could go up here, and we could see that we've got multiple touches here on our downtrend. 1, 2 touch. These are close. Volume staying pretty steady. It looks like it's crossing above the moving average line. These are down days, but at some point during the day, they're crossing above. So I might monitor this stock a little bit to see, okay, do I wait for it to cross above that moving average? What if I change that moving average from 5, which is a pretty tight one? Let's go to 10. Let's say that's a 10-day moving average. This simple moving average. You can see how things change. Our trend lines are going to stay the same, but now you can see we've changed a little bit as far as along how the line looks. But let's say we also wanted to look at something like Relative strength index, for example, is always a good one. And we're looking to see, is this oversold? Is, maybe this has gotten really sold down and maybe it's oversold. So let's take a look at that as far as another indicator. So we could type in RSI and find relative strength index. And as you recall from the lessons on relative strength index, you want to buy if it's crossing below the 30% line. All right, so here's 30%. And you want to sell if it's above 70% in a typical buy and sell situation. So you can see it's definitely not near the 70%. In fact, it's below the 50%. If we're looking at this line here, approximately. It's definitely below that. It's not reached 30%, but it doesn't have to be perfect. But we could say, okay, well, this is still low. This is like a 37. So we might be watching for a buying opportunity here. So also, what do we see here? An earnings announcement is coming up the next day. So you might say, okay, what I think I might trade on this, and you can see right now we've got a very narrow trading range. This is the current day here. See how that almost looks is like a doji, a very, very low trading range here, and pretty low. So everybody's kind of waiting for that earnings announcement. So recommendation here might be, let's see what happens in the earnings announcement unless we feel we're pretty good on it. And then if that earnings announcement comes up good and it crosses over our moving average line, and if our RSI is going to look good anyways, but it crosses that moving average line, then we might put a buy in here with a nice stop too. Especially if it breaks through this downward trend line. If it goes through both, if it goes through a moving average and the trend line, downward trend line here, those could be good situations for Pfizer. Let's look at, so we might be hold off on that. Again, traders look at things different ways, right? So another trader would look at this completely different, and that's fine, or use different measures. To keep it consistent, let's leave our same measures on there. So we've got our moving average at a 10-day moving average. You can see the current day, we're getting a little less volume, but a little bit more wide, or definitely a wider range. You can see Moderna has had this really nice kind of trend up here. Look at that, 1, 2, 3, 4, 5, 6, 7. There was like 7 out of 8 days in a row just in here where it closed upwards, and then we even had closes here. So they've been on a nice little run here. Have a little outlier here, not a full gap up, but it had certainly a nice peak in the range, and then came down, and then we had a closing day. We might look at this and say maybe this is the start of some profit taking, right? So they had a nice run up. They had a big rise up here the day before. The seller said, no, that's getting too high. Let's bring this down. In fact, let's go. We opened the day here, but we're going to close the day here. That's why it's a red candle, right? That's where it's opening and closing. Open, close on that red candle. So they closed here, and then the open and close is right around the same part, and now it's still trading in the day, but it's trading in this broader range here. So right now, you can see as far as where that is, and we're definitely above our moving average but look at our RSI. See how it's different than Pfizer? So this might be showing more of an overbought condition. So why? Because we had this big run up here. So if I was looking at this just on these indicators, and I'm not looking, you can look at other indicators too, but let's say you were trading and your primary indicator was a moving average line. Let's say it's a 10-day moving average, simple moving average. And then you were confirming that with your RSI to see if that's a good position to buy if it's approaching near the 30%. So we look at this and say, okay, right here, or actually right here, all the way back here, we crossed above the moving average line. Our RSI was down way, looking back here around 46, so it was kind of middle of the road. It wasn't 30, but we did cross above that, and we stayed above a little bit, and then we had a nice run up here, and you can see the RSI followed with that. But right now, if we're looking at it from a buy standpoint, we would say, okay, this is above the moving average line. That's good. We've already crossed it a while back before. We've had a nice trend up. That's good too. But right now, maybe we're getting ready to start a trend down because this might be overbought, according to our RSI. So that's another way you can think of it. Now, we don't have a trend yet because we just don't have enough touches, right? We could say, oh, okay, well, let's say, look at this, Steve. We got a downtrend here. If we're looking at days here, if this closed again, touching this line or below this line, and you started seeing more of that, then we might be definitely in a downtrend. But right now, I don't think there's enough information to tell us that we're in a downtrend. Also, we're not seeing spikes in volume. All I would say from this is right now, if I was trading this and I was looking to buy it, I might be cautious because of this RSI. That would be the thing to say, and be watching for this downtrend in terms of that, if this starts to form or develop. So there you have it with some vaccine stocks. And so you can kind of look at them and say, oh, okay, this is different ways you could trade on these different vaccine stocks. In fact, let's bring up Johnson & Johnson while we're talking here. And you can say whether I'm doing a short-term trade or a long-term trade. You see, well, now that we have the RSI up here, we can see here's Johnson & Johnson, middle of the road on the RSI. So here you can see you've got now maybe using those same things together. In fact, if we were trading, let's say maybe this is our best trade opportunity, bad news that came down, close to the moving average line. If we trade on that indicator, maybe we're going to wait for it to go above that moving average line. That would be the rule around that for the crossover. And we're middle of the road as far as the RSI, but we're not at all this peaky stuff. But it would be better if this was down a little bit further here, especially if it's crossing below 30, is what would be more ideal. All right, so there you have it. Again, long-term versus short-term, and how you can kind of look at competitors in this lesson. Okay, for fun, let's say I'm looking at this and I want to buy. Let's say I'm going to take a little bit of risk on this. I'm got my long uptrend line, but I'm going to buy on this day here. And we're going to do it as a paper trade, so we're all having fun anyway, so that's good. There won't be any money at risk. But let's say we're doing this long trend line, gap down. We're going to put a buy order in here, but and maybe we'll let it ride a little bit, or maybe we'll have it set to sell pretty quickly. So if we wanted to, let's say, buy this in a paper trading thing, you well, first off on the bottom here where it says like paper trading in trading view, you can set that up and you can set up paper trading. We've got that already set up. But let's say I want to buy, right? So the red here would be sell, and I don't want to sell. I want to buy. So I'm going to click on buy, and then I got my different types of ways I can buy, like a market order, limit order, and let's do a market order. We'll just take whatever the market gives us here, right? And let's say, because this is all fun, this is all mythical. Let's say I want to do 100. I want to do 100 of this at 160. Let's see, what is that? We'll see what it ends up being. But right now we're looking about 163.59. Now what I could do is, instead of, let's say 100, let's say I'm really not sure of it, I could do 50, and then if I could then buy back in. If it goes down, I might have another spot where I buy in, or if my things are looking good, I might buy in with the other 50 and keep running up an uptrend. In fact, let's do that. Let's just do 50. So let's just do 50 and see what that is. Now take profit and stop loss. Take profit, I can basically click that and I can set a price as far as, if I wanted to have, let's say, an upper level target. Maybe I say up here I want to take profit at 173 or something. But let's say I'm looking at this long term and I want to let that ride up. So I might not put a take profit target in there. By the way, the price, usually I would input the price as far as what I want to buy or sell at. Pips is basically just the distance away from the current range. So I'm not sure anybody really does pips. Some people do, but I like to put in the price. But one thing we definitely want to do is we want to put in a stop loss. So we're going to take profit off, but we're going to put a stop loss at the same time. So let's say right now we're at 163, 58 something. It's defaulting to this, but that's way too low. So let's say I'm looking at my chart and I say, well, I want a stop loss. You could do something like 2% below the current trading price, like the kind of the way of the turtle way, as far as different things you'd learn in the stop loss lesson. Or maybe I want to look at the last significant low, which would be either right here, last time we hit that trend line as far as the significant low, or maybe because I'm looking at long term, maybe I want to go right here, right? Maybe that's what I want to do. I want to go as far as right in this trend line here, and at this price, which is what is that, about 157.11. So let's say, whoops, what did I do here? Oh, I'm moving my thing around. Sorry about that. So let's say I want to sell. If it breaks through this line, then I want to sell at that point. That's a pretty significant, 163 to 157, about $6. So it's about a little less than 5%. So let's do that. Let's do that. Let's say we're going to put it at 157. In fact, let's go a little bit lower than that as our last significant low. Let's go to 155, because this might be more of a support line. We don't really know that yet at this point. We're just having some fun here. But let's say we're going to put it at 155. So that's my stop loss to make sure I'm not having some big disaster. So I'm just going to put it at 155, 00, is what I'm going to do. So right now I'm putting a quantity buy order of 50 in there. And it shows the percent of the total you might have in your whole equity thing. This is paper trading, so you can see it's a very small amount. They give you like 100,000 or something like that for paper trade for fun. But right now I'm going to buy a quantity of 50 in there is what I'm looking to do. 50 units or 50 shares. Look like we're right around this, 163.58 in that range. And we're going to put on our stop loss at 151. So we're just going to, for fun here, click this. Oh, you can see my trade value here. So this trade's going to be about around $8,176, depending on when I click the button, because these things are always changing. And I'm going to click, and I'm going to buy it, and then we'll see what ends up happening. You can see on the side here, you can see that the orders are placed, and you can see it was bought, sell, that there's all these different types of orders are executed, modified. See, there's a stop there and a market order. And so that would be executed. In the real world, this is all executed very quickly because it's paper trading. It's no real money at risk. Something like a Johnson & Johnson would trade probably that quickly because it's a heavily traded security. If you're looking at, like, say, a penny stock or something that's not traded as frequently, that may take longer to execute. Or if I put in a quantity of, let's say, 1 million, that's going to take a while and maybe fill through multiple orders. So take a look at the order section as around that. But right now we've got our order in. And we'll see how that does. We'll go under paper trading here, and you can see about Johnson & Johnson, the New York Stock Exchange. I have a buy there. This was the average price, was 163.52 is the average I got. I got a stop loss at 155, and last price 163. So no profit yet, or there would have been a little cost to maybe to putting the order in. So no profit yet, but we're still early, right? So very early, especially since we're considering this to be a long trade. So we might not look at this for a while, but we'll take a look and see how it does maybe over the next couple days. So either way, that's how you do it pretty simply. And you can see it shows on the screen. You can either have that on or off too. And we could buy or sell some more or go on to the next security. And we'll see how we do. Oh, by the way, I hope you really caught the whole thinking part through this. So if it doesn't work out the way I want and it goes down and goes below this, I can be okay with it because I thought this through and I have my stop loss in there, so I don't have to beat myself up. It just didn't work out as a trade, but I had thought it through. And I knew this was a little risky because it wasn't as firm as far as a long-term trend line is good, but the short-term trend hasn't developed yet, and we have a gap down. So I'm trading on the long term, but you can see how I'm thinking through this. And if it goes up from here, I'm going to feel real good. I'm going to think I'm real smart with my logic. But if it doesn't, that's okay too. I'll lose some money. I'll make money on the next trade. And just to have that positive attitude of like, yes, but I'm thinking through this. I'm not just trading to trade. I'm trading with a plan around that. And that's where the stop loss is one part of the plan. Okay, I'm over here at tradingview.com, and we're going to look at some India stocks today as far as the demonstration here, as far as what that might look like. I have many students from India. Hello to my friends in Delhi or Mumbai or Chennai or wherever you might be in the great country of India. And you can trade exchange-traded funds as well, where you've got a whole basket of, let's say, stocks in one fund versus, let's say, trading one individual stock. So we're going to look at a couple different ways to trade here in India. And one good way is to trade the Nifty 50. And you can see here's India Trust India 50 ETF. That's an exchange traded fund on the NASDAQ, and it's also listed here over there as well. I'm in the US, so I'm going to choose that. Again, your country might be different as far as which funds are available to you. But the idea is the Nifty 50 is basically the largest 50 stocks by market cap in India. So it's a great way to trade, more established, larger companies in India. If you're at the regular home page without an account yet, you want to look for something that says full featured chart. If you're trying to follow along or want to use this, or use your own trading platform, whichever one is fine, you'll want to look for something that says full featured chart. So I'm just going to click on full featured chart, and this is the Nifty 50. All right, so I had some from a previous thing, I had some stuff on there. So let me just take this off real quick. Okay, so you can see we're open on this trading day here, and this is the current trading day, and this is an actual live day. And here is some of the back days for source of trend. We are trading on a day here. We could change this. Let's say you prefer to trade on weeks, or maybe you want to trade more in hours. You can do that, and you can see how that changes my view here. So, but let's say we're trading on days, just to keep it simple, because that makes it easier to learn too from the whole open and close thing, because that's our candles are going to be from a trading point of view. So if we look at this here, and we say, okay, what's going on here? What is going on here? Let's blow this up a little bit too. All right. So if we look at it, you can see we've had some kind of a downward trend. We've had a couple things going on. First off, when we look at currently, we're definitely in a downtrend, right? So if we were to draw our trend lines like around here, so let's say here, and you can see we're in this definite downtrend. Well, I wouldn't say definite downtrend because we only really had one touch of it. If I moved a little closer, maybe I might have a second touch. In fact, a second touch might more establish that, or certainly a third touch of that downtrend, which is a good way to look at that because what do we have going on here? All of a sudden, we have a spike in the Nifty 50, right? So we have a spike in the Nifty 50, and there's a gap up, right? So take a look at the lessons around gap and gap up. So we have a gap up opportunity. So we might want to be watching here as far as what's going on with that gap up. What could be happening, don't know yet, but what could be happening is we might be having had a little bit of a pullback, and now we're going back above. So if we look at, let's say, a trend line from, let's say, back here, and you see, well, actually, if we look back here, back in time, we had a big gap down. Let's go back a little bit. So we had this long run up. So we have a long trends here. Let's say that's an outlier. Let's just put him out of there for a second. Long trend up. And then we have a big gap down, right? So we have a big gap down, now if we look more current time on the Nifty 50, we could say, okay, we have a big, a more of an established trend here we had this trend here, and then what happened? We had a gap down with a long wick at top. So this is showing that we went below the trend, we broke the trend, or the trend was broken, and we had buyers trying to push it back up above that trend, but the seller said, no, we're going to close. Not only are we going to start the day down, we're going to close down as well, too. That's why it's a red candle. A little bit more doji, like a real narrow body. It's not a true full doji, as opposed to like this one right here. But we're having, they couldn't get it up there. They did raise it. I mean, they did open the day higher here on this next day, but then it closed lower. So really fighting to try to get it back above that trend line didn't work. So this trend has definitely been broken. This particular one we're looking at here. So that wouldn't be valid. I mean, it's just not happening, right? Now, what could be happening is we're starting maybe either a new trend. We've got one touch, or we might be having a little bit of a temporary pullback here. But it's a little deep for a pullback. A pullback might be more like in this area here. And then if this was to start to come back around and go back up, that might be a little bit of a pullback. But this is, well, we look here, 1, 2, 3, 4, 5, 6, 7, 8, 9. We're like 10 days below that trend line. So that's very much where, if anything, we're either looking at a downtrend or we're waiting to see what's going to happen here to see if this picks up on this gap up, if this is going to keep going here. So we might let our trend is our friend, develop a little bit here. Let's put a couple other things on this chart too, just to see, see what we can see, so to speak. So let's look at something like, let's see, market sentiment. Like, let's look at Bollinger Bands. What might be going on here in terms of, let's say, maybe a Bollinger Band? Again, if you haven't seen those lessons, go back and take a look at the lessons. All right, so if we look at our Bollinger Bands, what are we seeing here? We're seeing a definite back in time a little bit, a definite long walk up the band. Look at that. That's nice. That's a beautiful thing. Look at that long walk up the band. Then it started to drift to the middle, right? It got a little indecisive. Now we're headed down. We're headed down below the middle there of the Bollinger Bands. And now we're actually touching the bottom band. When the bands are touched, as a reminder, that means this might be a continuation pattern. So if I looked at this, I would say, if just on this day, that might be, oh, there's a continuation pattern possibly, but it really hasn't developed yet. And look what happened. The actual next day, the live trading day, it actually, jumped back up, right? It had a gap up to the middle here. So right now, we're in a real period of indecisiveness, right? We don't know if we truly have a downtrend, though it might look like that. We had a touch of a bottom Bollinger Band, which might be a downtrend. We're in the middle here, but it's not a big long wick or anything, so there's a little bit of indecisiveness. More indecisive in the middle than if you're at either end. And it might be looking to see if this will develop and maybe start going up and maybe touch this upper band. We also might be looking at a squeeze here. See how wide this is between like these points here? But now we're getting narrower, and this might even get narrower still. We'll see what the future holds for us here. But you can see we might be actually approaching a squeeze. If we looked at, let's say, momentum like RSI, that can kind of tell us stuff too. RSI was always a nice little indicator. RSI, relative strength index. If we look at that below, remember from our RSI, if you are at above 70%, then it's a sell signal, and if you're below 30%, that's a strong buy signal. So you can see in the past here, there was a lot of sell signals. Now this was a strong uptrend, and strong uptrends can last. They can last above 70. Just because it touches above 70 does not mean it's going to automatically sell. Strong uptrends or downtrends can overcome that. But then it came off that and went more down towards the middle, and now we're coming back up a little bit. But we're still in the middle here. See where we're still in this 50 range here. So we might be watching that as far as there's a lot of indecisiveness going on. So what would I take from all of this? I would say Nifty 50, nice gap up, worth a watch. We'll see what happens, and be watching for something to develop, a trend, a chart pattern, something to develop that might give us a little bit more indication something might be going on. Let's leave these lines on here, and let's go ahead and let's go take one of the components of the Nifty 50 and see what that looks like. If you've ever been in Delhi, and I've been in Delhi, and I've been in Mumbai and Chennai, I've done some speaking engagements, you're going to see Tata all over the place. Tata Motors, Tata Automobiles. So, and you can see here, okay, this is what this is. And you can see how Tata's doing. Now, a lot of times they'll follow along with the index. But you can see with Tata here, look at how long, look at the squeeze here they had. You know, they had this real squeeze here, a lot of indecisiveness, but then it started to go up here to the band. And very similar to Nifty 50, had a nice long walk up the Bollinger Band, right? But then it has come off, right? So it's had a little bit of a come off. You could say if we look at this a little closer, we could say more of a downtrend might have formed because we had two touches, two touches. But, you know, again, the more touches, the more confirmation you have. And here we say, oh, two touches, that's a downtrend. I'm going to buy into that. And then the next day it starts to really kind of go above that line, above that trend line. So we might have some indecisiveness there. And when we do, from a Bollinger Band standpoint, because we've definitely come well off of our walking up the band. So that's showing a change might be coming here. We had an earnings announcement that happened the day before. In the trading view, if you click on it, it'll show you what was estimated, 4.67, and they had a nice earnings surprise, you know, where they did 3.35 as far as that goes, which seems a little odd. I'll tell you that just seems a little odd because it seems below. It should be a negative number, but either way, it looks like they're taking that as a positive sign, and we might be ready to get up into an uptrend. But right now, we've crossed that trend line, so that might be an indicator that we might be on the buy side. Let's put a moving average on this and see what that might tell us. I mean, it is telling us it might be oversold, or excuse me, overbought, because we're above that 70. So that's a little concerning. Overbought, Bollinger Bands, it's off the Bollinger Band. We're breaking that trend line, so maybe something's happening. Let's look at a moving average real quick. We'll just do another simple moving average here. In fact, let's do a weighted moving average just to weight the more recent time frame here. So here's weighted moving average. Again, whatever you're using might be different. I like to use this one for core stuff because it's free and you can kind of practice with it. Again, time frames will be different. You can see the time frames that we're using here. So this might definitely be back in time depending when you start up with a course. But it doesn't matter. The concepts are going to be the same there. So if we look at our moving average, it's hard to see because the colors are the same. And at least with these guys, Trading View, you can change that style. So let's say we're going to change this to more of an orange is nice. And we're going to change this to be a thicker line so that really stands out. And this is right now on a as a 9-day. So let's say we change that to something a little longer. Let's say it's a 20-day. You could use 9. Let's say 10. Let's do a 10-day moving average. Not a big difference between 9 and 10. And you can see that we crossed this came through and it crossed this moving average here. Definite sell signal, right? We've got into a downward trend. If we look into this, crossed the moving average line, definite sell signal. We had some nice earnings, it looks like. So though it went up a little bit, it's closed the day down, and right now we're trading up a little bit. So we're right on that moving average line, at least for the 20-day. If we change that to, so we're not a true buy signal yet. We're close though, right? This is where you got to kind of let it develop, right? Because we don't have a true uptrend yet. We haven't crossed the line as far as breaking this downtrend. Our RSI is saying, hey, this might be overbought. So there's a lot of concern in there, but we might be able to break through that moving average if that's our primary indicator and say, okay, well, that might be more of a buy signal. This is a 10-day moving average. let's say we change that to 20-day and see what that changed. So we'll watch that orange line. You see how the orange line changed. It showed on a 20-day moving average how this can change. It didn't cross it yet. So it's depending again how you use your moving averages. A weighting moving average is going to weight the most recent time period heavier, and a shorter time frame is going to weight by nature is going to have a more weighting than the previous time frame. So when we're looking at 10 days, 6, 7, 8, 9, 10. So we're looking right about here. As far as a 10-day, a 20-day, we're going to go back further in time. So you can see, I would look at this and say, watch it closely. There's some indecisiveness there. There might be an opportunity, but it could go either way right now. It could go either way. Let's look at one more for fun. Let's look at Infosys. All right. So Infosys is a lot of you might work for Infosys as far as a company, and you can see the same thing. The nice thing here, where it leaves my previous indicators up, so it's easy to compare. So we were comparing that to Tata. You can see they had a little bit of touch, but they've been in a little bit of a middle, more of a squeezy type look here for a while now. Where this is the current 20-day moving average. So you see it's below the 20-day moving average. Definitely, let's change that to 10 again and see how our line looks there. All right, so you can see it's there, but looks like we're definitely in a downtrend, right? You can see we've got some downtrendy type stuff going on here. Let's say if we connected here to here. Okay, so we got a downtrend, and we're below that downtrend. But our RSI, see how it's different than Tata? How it's now around 45 here, 46. So it's still in the indecisive range. Where if that went down closer to 30 or past 30, that would be a better indicator for us. But here's a situation we might say, okay, we're in a downtrend. We got like you could say 3 touches, definite downtrend. This is good as far as RSI that it might turn around, so be aware of that. But we're definitely below our moving average line. So we might want to monitor this too and see if our RSI goes down to more of a buy signal, but also maybe if we're trading off the moving average, we might trade off that. And we did have a negative touch of the Bollinger Band. It came out, well, it's still pretty close actually. So the following day here, whatever is in store for us the next day, this might continue to walk that band, and that would walk the band down, especially if we get out of this squeeze and it starts going more down. Then this would be, a kind of a warning sign on that one with Infosys in terms of a short-term trade. So there you have it. For my friends in India, we have some India stocks here. And oh, by the way, I should say, you can see how this is at 1260.90. This is in rupees, right? Because it's an India stock, so that would be in rupees. So, but when you actually do your trades and with your broker, then and actually complete the trade, it'll be in the currency that you've set up with your broker. It'll automatically convert that. But if you're looking at it and say, wow, they are at 1260, but then when I go to my broker, it's so much less. Well, it's because that's in rupees, which is kind of cool. Actually, I kind of like that actually. So there you go. Some India stocks as an example of different ways you can trade and some different things you can do. Okay, I'm at tradingviewhere.com. We're gonna take a look at electric vehicles and look at some how we can use exchange traded funds, and we'll look at a particular individual one too that might be interesting. And right now I'm at this thing called iDrive, right? It's IDRV. It's an exchange traded fund. Now here's the thing with exchange traded funds; those are baskets of stocks. So instead of buying, let's say, Tesla, I could buy a basket of stocks that might have 25, 30, hundreds of stocks within a particular thing. So like the S&P 500 is the 500 largest USA stocks, and the Nifty 50 is the 50 largest by market cap India stocks, and you could go into particular sectors like electronic vehicles. And so it's real important to know what you're looking at if you're going to be following something. So this iShares, iDrive, a lot of people think, oh, that's electric vehicle maker, but they're actually electric vehicles and autonomous driving technology. So it's both autonomous and electric vehicles. So it's not a pure electric vehicle play. So if I look at, let's say, go to the iShares website as an example, and I start looking at their holdings, that's a key thing, I can see that I'm not seeing a whole bunch of electric vehicle manufacturers. Obviously, there's Tesla, and that happens to be their #1 weighted thing at 5% weight of their holdings. But you can see I've got Samsung, Apple, Intel, Alphabet, which is the parent company of Google. Toyota makes cars, Qualcomm, NVIDIA, and Advanced Micro Devices. So other than Toyota, and certainly Tesla is an electric vehicle maker, and Toyota has potential on that. these are more involved in that autonomous vehicle type sector. So if you're saying, I want to really invest in pure electric vehicles in an exchange traded fund, you're not getting this with this. It's both. So you can see it's iShares, self-driving electric vehicles, and tech ETF, is the full name of it. So just always good to be aware. All right, well, let's learn some of the concepts that we've been learning in the course and apply some of those to an exchange-traded fund. You might still like this. Say, no, I love this. Look at all these great stocks. I want to invest in this and get that diversity there because I do want to play in both EV, electric vehicle, and autonomous driving. So let's say here we are at iShares, and which is the exchange-traded fund. You want to go to full featured chart. Again, whatever you might be using, I use this one because you can use a free aspect of it with TradingView. So let's go to full featured chart here. Okay, let's blow that up here a little bit. Here we go. And here's what we're looking at, those electric vehicle and autonomous driving. One thing too, because you saw it had all those different types of stocks in there, like Apple, some of them pay a small dividend. So on your iDrive, if you hold it for more than a quarter, you would get paid a 0.67% dividend, a very small dividend at this point. So you get a little income on it too. So if we look at this, we can see, what are we seeing here? So we're seeing a definite gap down as far as what's going on here, right? We see a definite gap down over these this is a current trading day, and then the 3 days prior, we can see that we have a definite gap down here. But if we look at it long term, and a lot of people might trade like an exchange traded fund like this, over a more longer term period, for example. So let's put our tools up here, and if we looked at this over a real long term, we could see going way back here. Let's say we'll put it right here, and we connect ourselves, and we can see, okay, what are we seeing here? So we have this nice long term, and long term I'm talking about. We're going back for about 4 months, about a quarter. So going back a quarter, we've had this very nice long term upward trend with a big, nice space in here. So and we've got some touches in here, and it held above that line. Went up a little bit more, approached the line a couple more times. But now what's happening, even with our long term, we broke through the trend line. So, and it is a definite break here. Look at that. It's a full gap down. It's a full breakage of that long-term trend line. Even if we looked at more of a short-term trend line, it would be breaking that as well. Maybe we're looking here where it was more sideways, looking at more short-term. And, technically, if you go like here, maybe we're not breaking it as much if we're looking at, like, let's say these guys here. So maybe we are in more of a pullback here. So that could be a way to look at. We've had a gap down though, but maybe we're in more of a pullback that might be occurring here. So with that, it's something to consider as far as, do we trade on it? So maybe what we do is, instead of looking at these, we're looking at these lines, we could be saying, well, maybe we're in a new downtrend here. Maybe that's the other possibility that's happened. We don't know yet because this is our peak here. Like here's our peak. And we maybe have a touch here and touch there. Well, there's two touches. So, you could argue definitely that there's a downtrend here as well. But we've had a nice up day here, or currently during the day, but there's some indication there. So we might need some more indication going on here. So there's our trend type stuff. But let's say we put on, let's take a look at this and say we'll put on a moving average on here. And then we can look at these moving averages from, different time periods, whether you might be trading a short time frame or a long time frame. So let's say we're going to use a weighted moving average. And the real key is, with our weighted moving average, is how long we want that time frame to be here. Let me take one off. I put 2 on by accident. And I'm going to just adjust my weighted moving average in terms of style so you can see it a little better. So I'm going to make my weighted moving average in orange. I'm going to put it real thick so you can see it. And this is on 9 days right now. So it's just 9 days, looking at the last 9 days, weighting the more recent days a little bit heavier with the weighted moving average. And you can see how we've been above the weighted moving average, but then it broke through a little bit here, but then it went back up and hung in there, and then it's definitely below the weighted moving average. So this was a definite gap down, a definite sell signal. We might be on a definite downtrend for all we know. So right now, this would be, if you wanted to buy, you might be cautious on this in a short-term type frame because we're looking at 9 days. But let's say we just believe in autonomous vehicles and electric vehicles, and we know long-term that's the future, right? We think that's the future. So we go backwards, we can see we still have that moving average where it's a 9-day moving average, and it's followed along there and stayed above it. Now let's change our moving average to something a little bit more longer term. Okay, so if we look at it from a 50-day moving average, you can see how we're well above the 15-day moving average. Went up here, so that was a buy sign, and then stayed well above that for a very long time. Now it's approaching it. So we might want to look at this and say, okay, from a long-term viewpoint, we might still believe in it, but we might say we want to see if this is going to turn around and start going back up. So that's something we might want to look up here and see if that's going to turn around and go back up, because it definitely have a gap down. We definitely might potentially have a downtrend after our gap down. I mean, that's something you got to be noticing there, and just see what happens here. Are we going to continue that long-term, upward trend? Is it just a minor pullback? But a gap down is really concerning with that. But if we look at a longer-term moving average, okay, that hasn't crossed yet. Maybe what we might want to do is let's use an indicator, a moving average crossover roll. We're at a 50-day. Let's use a 10-day weighted moving average. We'll keep them the same and look where they cross and see if we have a crossing opportunity. So not only, as you know in the lessons, how we have where moving, okay. So our shorter term one is in blue here. Let's change that color just so it stands out a little, or let's make it a little bit more thicker. Let's just do that. There we go. Okay, so as you know, not only when the price crosses a moving average, that's a definite buy or sell signal, right? So if we look at this is now a 9-day moving average in blue here, you can see right here, once it gapped down, that was a definite breakage of that. That's a definite sell signal, right? But we're still above the longer moving average. So if we're looking at, maybe we want to look at a moving average crossover where we're not looking at the prices, but if you remember that lesson where we're looking for the two crossovers to basically cross each other over, right? So they're gonna cross each other over. Maybe something like, it's gonna look, where it's gonna cross each other. Let me go up closer. So if these two lines here, the solid blue line and the orange one, had a crossover, and the blue one is crossing below the orange one, the shorter term's crossing below the other one, then we know that's a definite sell type signal. Or it could rebound and start going up and look at other indicators that we've broken through a trend line and we're headed trending up, for example. And you can see way back here where we had a crossover, you can see where it crossed over to the downside here. We go back in time. And then when it crossed above the line, the blue line, that was a buy signal. And we've been well rewarded with that buy signal. It came back and touched again, but then we either went down a little bit or it crossed above, and now we had a definite, look at that nice long run. And then now we've had this long run. And by the way, if you were in this here, maybe you have a stop loss at a level like around here. If you have a trailing stop loss, it might have trailed all the way up, following up this whole thing. You would already booked your profit. If you don't have a stop loss, I suggest you always have a stop loss and keep adjusting it as needed. But if you don't, this might be an opportunity to say, if I bought in around here, let's say I bought in on this point right here, look at all that profit I've made. I might want to just sell here just to get my profit, just to lock it in, because right now it's getting, I'm not sure which way it's going to go. Or I might be able to say, okay, I can go down a little bit further. I'll take a little more risk, but I don't want to keep going all the way down. I want to book in that profit. And then I can look for these buy signals to maybe buy in again. So that's one way to look at from just the simple from weighted moving averages and some crossover type things. Let's look at another, let's take these off here, and let's look at another, let's look at another one here. And Tesla is one everybody will look at. Let's look at something a little bit more just different, right? So let's say you're interested in Nikola, right? Nikola, which makes electric vehicles, more emerging, stock in that field. Tesla is dominant, at least at this point, but Nikola is emerging and does some interesting things. The other thing that's interesting about Nikola here, I'm going to go back, just to apologize for my screen movement here, and I want you to see here. You see how we have this long kind of flat line here? It's hard to see because there's not much trading volume here. These are all individual tickers. I mean, if we were to zoom in on that, you would see individual opens and closes, but they're really staying around the $10 mark here. See how it's like around 10.23, 10.50, 10, staying real solid there. I have a course called SPAC investing, special purpose acquisition companies, which is like an IPO. It is an IPO, whereas basically a SPAC company raises a bunch of money and goes to a private company and tries to work out a merger deal and bring them public. Bring them public means they can trade on a stock exchange and we can trade them. So before Nikola became a publicly traded company, there was a SPAC out there with a different name that was you would buy in at $10. That's kind of the standard amount. And then what happens is they announce that they're going to merge with Nikola, and they're going to bring it public. And you can see how it had this sharp spike up here, right? It's hard to see maybe, but you had a sharp spike up here. Because now it's going to eventually trade as Nikola, and that's where it goes through this period where they're going through the due diligence period, and then it's more of an IPO, probably right around in this time frame. Certainly right here, we had some, look at some of these spikes up here. So that's, if you're interested in special purpose acquisition companies or SPACs, check out that course. But that's why it started so low. But if I was looking at Nikola, because it's a more of a new emergent type of stock versus, let's say, even Tesla, which is much more established, much more volatile, right? Much more real highs and peaks and valleys, much more volatile in terms of how that would look. And you can even say long-term, if we looked at this as a long-term trend, let's say that's an outlier and we just ignore that. Let's go start here. But you could say long-term trend on Nikola, you're looking more of a downtrend. Now you could draw like these two, or you could draw up here, let's say here, and you'd be watching for that to break through. I'm not going to alert. You might be watching for that to break through in terms of the trend. But let's look more at our more recent time frame here, because this might be something we want to trade a little bit more, more in and out. So we had, if we look at recent time here, we had a bottom here and we had a trend here. We could say, okay, that's still above the trend, so that's good. And we had some real spike ups, but then we had some profit pullback. That's probably what's happening here. We've touched the line 4 or 5, 6, look at all these touches. So it's a nice strong uptrend, a nice peak here, but now we're having some pullback. The question is that pullback going to start to level out, or is that pullback going to break through our line? Let's look at another factor here. Let's look at something like a rate of change, right? So let's just to bring in some different types of lessons here. So we're going to look at a momentum indicator rate of change. Now RSI tends to be a more popular and used indicator, relative strength index. But let's look at rate of change just because we have a lesson on that. And as you recall from rate of change, you can see that if you're above zero, the idea is if you're above zero, that's showing uptrends, right? That's kind of telling you there's an uptrend. And below zero is telling you it might be in a downtrend, right? So you can see it's not always perfect, doesn't always match up perfectly, but you can kind of see we're more likely to stay in an uptrend. We've been in an uptrend for a while, and this is indicating to us that it could be more likely to stay in an uptrend. Versus right here, it's kind of indicating this could go to a downtrend. It didn't. It actually stayed or had been in a downtrend. Actually, you see how it had been in a downtrend, and it stayed there, but then it started to turn around, went to touch that thing, but we're still above zero. And really, once it got to here, and you can see the line up here, right about here is when the ROC was starting to indicate, no, it looks like we're definitely in an uptrend, and it did continue from there. So if we look at this from a current standpoint, we could say from a rate of change that we're above zero, could be still in an uptrend, so that's a good sign. We've had some down days, so there might be a little pullback. Our long-term trend, our longer-term trend has been pretty solid. So these are all, good types of indicators around, Nikola, though we have to be aware with Nikola that it does get spiky at times. So you just have to be aware and ready for that as well. The other thing with Nikola too is they have lots of really narrow trading ranges, right? You see, or as far as open and closes, some have a little bit longer wicks, but look at all these kind of more doji-like stuff all over here, a little more established here, but right in here there was a lot of indecisiveness too. In fact, let's look at like some market sentiment and some volatility. This is a volatile stock, right? So this is where maybe a Bollinger Band might be helpful, right? So let's go down and find a Bollinger Band, put that on. Okay, so what's this telling us? If we look at Bollinger Bands, you can see like, oh, look, we had this, let's go back a little bit further. We had a walking down the band. We had a little walking downtrend band, went to the middle, and as this one walked back up the band, right? And even had a big outlier here. But then came down, and then had a big gap down, which brought it way down in the middle here, and then started to kind of be in the middle and drift to the bottom, touch the bottom, maybe a downtrend a little bit. But now we enter the squeeze period here. See how it's really getting tight there? That's the squeeze. So that's a period of indecisiveness. But right about here, that gets a little more decisive and starts to touch a band on up. That's an upward trend signal. Came off it though pretty quick, but then it went back on it. So walked up the band a little bit, and then came off, and then on a little bit. and now we're off again. So this is telling me we're still in a squeeze, though it looks like we might be coming out of the squeeze. So if you're interpreting this and saying, okay, we might be on, on a nice uptrend, maybe a temporary pullback, it'd be interesting to maybe wait and see what happens this next day to see if we go back and touch up there. Also, what's seeing happening with our ROC, it's still above there. That's a buy signal as well. So there you have it with Nikola, as far as a couple different ways you can look at that. And, look what's happening with this trend line. Are you going to break through it? Are we going to go back up on that Bollinger Band? This is looking nice as far as a buy signal. But right now, we might be in a little bit of period of indecisiveness. Now, you could trade this, actually. Though it's a little indecisive, you could trade it and just make sure you put a stop loss in there below it, right? So you put a stop in there to, in case it does start to go down and break through that band. In fact, you might put your stop, or through that trend line, you might put your stop just below the trend line, because if it bounces off it, then you'll stay in it. But if it, let's say, breaks through the trend line and really establishes a downtrend, then you're getting out before it goes way down. By the same token, if let's say you had bought way back here, or maybe you bought here, you've had a nice little upright here. You've got some nice profits. If we put, let's say, some 2 lines on here. Excuse me. Let's see if we put some horizontal lines here. Let's say you had bought on this strong signal here, and you had bought let's say right in here somewhere, right? So that's one line. Well, that's our line. So anything above this line, we're going to have profits. So if you put your stop loss in here, you've booked in some of that profit between here and still stayed in your position if you had bought this previously. So a couple of different ways that you can apply a few of the indicators into both an exchange traded fund and also into, in this case, a very spiky type of emerging electric vehicle stock. Oh, and one last thing, I put volume on here. Usually volume will default on it, but you can see along the bottom, this is volume, some bars that show you how volume has been going as far as trading volume, how many actual trading transactions. You can see it's been pretty steady, a little spike up here that brought it up, and then in terms of volume, and you can see how we have this long upper shadow, and then the volume stayed pretty steady, a couple nice days in volume, but then now the volume is really kind of petering out. So, there's not a lot of, like if I was worried that this was going to have a big spike downward, I would expect this volume to be higher. The same token, if this was going up and I might, like maybe a gap up, I might expect this volume to be upward too. But right now it seems pretty calm. People are watching, people are waiting, but I think if there's some buy signals coming up here, maybe you'd see this volume coming up to here or maybe up to a high level. So be kind of watching for that as an example of how you can use volume as another confirming indicator. All right, let's have some fun trading some kind of fun stocks, right? We're going to look at Activision Blizzard. You might have played some of their games. They're a video game company. Blizzard is famous for World of Warcraft and Overwatch, amongst others, and Activision for Call of Duty. And they merged several years ago, and they're a big player in the video game market. And we've got another stock we'll look at in this lesson too. That's kind of a fun one as well. So doesn't mean you should trade stocks just because they're fun, but you might trade stocks that really interest you, and that's okay, especially if you learn about those stocks. Maybe you love Blizzard. I know a lot of people love Blizzard, for example, and so they would trade Blizzard, pre-merger, and they might still be doing that also. So if I'm here on TradingView and I'm at the Activision Blizzard, I just had put in their ticker tape or their ticker, and you can see that we still got time in the market day here, so we're going to look at that. And if you're using the free account or just playing online without signing up, you'll want to look for something that says like full featured chart. You'll have like a little square somewhere. So you want to click on that and go into the full featured chart. Okay, so let's take a look at this one here as far as Activision Blizzard and what's happening. So first off, if we look at it from a longer point of view, you can see it's had some really nice long trends, right? If we look at the long view here. And then we'll look at, there's some interesting things going on in the short term over here as far as something that's more, might be more impactful as far as what's happening in the near term. But if we look at the long term, let's draw a trend line on here. Let's say we start, near the bottom here, and we're going to connect those two there, and we're going to kind of connect all the way through. In fact, we could go like that and start connecting through. You can see, how we're kind of, we'll go like that. All right. So you can see if we drew this long trend line, that, this has had a long period. I mean, this is back about 2.5 months worth of data that's showing this long kind of overall trend, especially up in here where it went way above the trend line. So you can see a very strong long trend. And then as we get closer, more the near term, you can see it really came down. And the wicks had crossed below the trend line. And you could say, well, okay, I'm going to sell on that. The sell rule would say, once you break that trend line, you sell, and it did during that day. But you might be using a style where I need the close to go below the trend line, or I need a full candlestick to go below the trend line. Look at the trend line section as far as different ways that you can filter out those things and try to reduce, let's say, sideways movement or a pullback. In fact, I think that's what might have happened here at first. It looks very much like that. We had this strong upward trend, and there were some, prices up here started to really peak out. And then we had a really long close down day, a lot of profit taking. We've had this long uptrend, so we're going to take some profit. Might have gone a little too far, so it was another up day and then down again. Not a full gap, because you can see the wicks overlap, so not a full gap, or downward gap, but there's some profit taking in here. It never really fully broke through the trend line. But if you were trading on this and say, well, once it breaks through a little bit, that's perfectly fine. You would have sold. And if you had bought way back in here, you would have made quite a bit of profit just following that simple rule. That's why it's a good rule to follow as far as breaking the trend line. But let's say you didn't. Let's say your rule, you filtered out and you said, I want to make sure a whole bar goes below or a whole candlestick goes below. Well, then maybe you didn't sell and it actually went up even further. And you can see it start peaking up here and then came back down. And then we had a big gap down, right? So now we're looking, this is the current trading day. 3 days back, we had a big gap down, right? There's a big gap down here. So that would tell you, okay, there's a big gap down. So let me take off my long-term trend here. Let me just do that real quick. And maybe I say, okay, there's a big gap down. We had a peak here. So maybe my trend is looking more like this in the short term, right? As far as a down type trend. But then you can say, okay, well, that's good. Maybe I'm not buying in here because this is now a downtrend. I might be watching this. But then at the same time, there's like this short little, definitely start forming uptrend here, right? We've got this going on here with them, where we've now had 2 touches of the line here. We have 1 touch here. So not technically a fully formed downtrend, but I mean, sure, it looks steep, doesn't it? And we had a big gap down. That's a definite, downward move, right? A big gap down. Long candle bars to the down. Those are, we had 1, 2, 3, 4, 5 days in a row of downward closes. But now it looks like we're coming back here a little bit. So this might be a double touch here, close here, and on our current trading day, maybe we're looking at an uptrend here. But you can see how they're, we want to walk through this a little bit and think through this a little bit. So let's look at some other factors. Let's look at some other things in here that might help us. So let's look at, let's say a moving average. And we don't want to use necessarily a long moving average. You can, but that would, count for all this stuff. Let's say we want to use a shorter moving average, either like a 9-day or a 10-day, or a 9-day, 10-day, or maybe 20-day, because we want to put more weight to this by having a shorter moving average, more to this recent term. In fact, we can even use a weighted moving average. Let's do that. To you put even more weight on the more recent stuff that's happening. Might be a way that we're thinking through this. So we're looking at moving average. We're going to choose weighted. This defaults to a 9-day. I'm going to make this look a little easier to see. So I'm going to make that an orange, and I'm going to make that line a little thick so we can really see it well. And now you can see our weighted moving average going above and then through this whole kind of whipsaw area here, right? Where it's going below and above the weighted moving average. These are our sell signals going below, and these are buy signals going above, right? So, a lot of whipsaw here, up and down. Then we're above, and then once we crossed here, and we crossed that line, it's another sell signal as well. And with the big gap down, cross the moving average line on the 9-day, boy, look at that. That's definitely selling, would have turned out that way because there was a big gap there. In fact, that might have been what fueled the gap. People were already like seeing it coming down for straight days, big gap, and they're like, got to get out. And maybe take my profits from way back when. I didn't take them earlier, I'm going to take them now. So people got out for profit taking, possibly, and now we're looking at this uptrend coming back up. And it's real narrow trading, body here, but you can see we're right along that moving average. We're above it a little bit or below it a little bit. Maybe we want to wait for another full day to see whether it does go above or below. Might be a way to look at this. Or let's adjust our moving average. Maybe we want to look at, instead of 9 days, maybe we want to look at 20. Let's see what that does to our moving average if we go to 20. A little bit of change, but not much. You can see like here, it's still, the main body is still below, below it, and this is below. So, there still might be an opportunity here either to wait or see how it goes. Let's look at, so this might be something where what's going on is we're kind of seeing something that might be in a turn here. The other thing that's going on here is you see this E down here. That means there's an earnings announcement scheduled. If you see it like D's, those are dividends. You know, so if a dividend was going to be paid, that you would see a D here. I don't see any D's, lots of E's. Yeah, here's a D way back here, right? So that's where they pay a small dividend. But we're looking at this near term, and we've got an earnings announcement coming up. So we look at our current day, right here, our current trading day. We're 1, 2, 3 days away from an earnings announcement. So people are anticipating things for that earnings announcement. Let's take a look at volume. A lot of times volume will be automatically along the bottom here, but let's put in volume because that might indicate to us whether what the traders might be thinking around, is it a real actively traded type time or not? And I suspect it won't be, and it isn't. So if we look at that big gap down, it's what we suspected. You'd have a lot of trading volume, a lot of transactions, people getting in and getting out, depending on what's happening and where they're at in their position. And then we get kind of some normal days, and we're uptrending, so it's a nice solid uptrend. And then we get quiet. Not a lot of trading volume, uptrend, still above the uptrend, close to the moving average, hugging that, but not a lot of trading volume. If this was really spiky, let's say this really spiked up, and this went up way up here, well, that might be a gap up or something, or the same thing if it went down. But there's not a lot of trading volume. So what might be happening is we might have some quiet days leading up to the earnings announcement, where people are trying to wait it out and see what happens to the earnings announcement, and then they're going to react to that as far as traders. Let's look at instead of volume, let's take volume off here, and let's look at more of a market sentiment thing. So let's see what the RSI is going to tell us, a relative strength index, because we might say, look at this big run up. Yeah, we went a little sideways, but still peaked here. Are we overbought? Are we in an overbought situation? Or because it went down so steeply, maybe we're in an oversold situation? Our relative strength index is what helps us with that as far as an indicator. So let's put in RSI, find relative strength index, and that's going to be along the bottom here. And as you remember from the relative strength index lesson, if it's a 70, it's an overbought situation. It's an overbought situation. It's above 70. And so we might want to sell the security if we own it. So it might be overbought. And if it's below 30, that means it's oversold. It might be a great opportunity to get in. And what are we seeing right now in this current day? It's kind of middling, right? It's right in the middle there, around 52, 53, around that range. So, it's nothing, nothing exciting there as far as we still don't know which way it's going to go, up or down, right? So, the advice around this might be, we might want to just watch this and see how it plays out, right? We might want to watch to see how it plays out. But let's say for fun, we've got paper trading and we want to take we're kind of like, okay, this is okay. And we might want to take a little risk and just see what it does here, and maybe for fun, we'll put in a trade here. So let's do that for fun. If this was real trading, I don't think I would do it. I might wait a little bit more. I might wait one more day, and maybe that would have rewarded, or maybe I would have, not been. Or maybe I put in a small amount, as far as something. Maybe I put in half of what I want to trade, and then I put in the other half if it busts through that line. And if it doesn't, I put in some nice stops in here too as well. So let's say I'm going to go into trading here. So let's say I'm going to buy, right? Here's our prices. This is sell, and this is buy over here. So a little bit of spread. You can see it's a very close trade. If you had a wide spread, that would be a lot more volatility in it. But this doesn't have a lot of volatility. You see it's within a couple cents of each other. So I'm going to click on buy, and we're paper trading here, so I'm not risking real money, so it's okay. And let's say I wanted to buy 100 of these, right? 100 shares of this. And I said, okay, well, if I do that, I'll put in like 9,151 if I bought this, at what's kind of currently trading at that 91.51, around that thing. Again, I could put in a limit order. Maybe I want to say, well, I want to buy, but I don't want to buy until it gets above this line. Or maybe I want to buy if it falls a little bit below. You can decide how you want to put that buy thing. But maybe I'm thinking, well, I want a little more, confirmation. So I might put in a limit order to say, I want to bust above that moving average line. So I might say, I'll buy at 92.41. Or I don't want to buy here because it's too close. So I want to buy if it dips a little bit further. So I might buy at 91 as an example. So I can use those types of things as far as the trading. Though actually, I'm noticing something. Before we trade this, I want to show you one more thing here on this, because there is something interesting that might be happening, and that might affect where we put our stop level on our buy. All right, so we're going to close this here, and I'm going to just remove some things here, and I want you to look at a couple things that might be happening here. So one, look at this here. This looks like an engulfing candlestick, right? So this has engulfed this guy here. which would be a bullish sign, but it's not fully because of our range is up here. It's not fully engulfed. But if this had very small wicks on it, and this was like 4 times larger than this one, that's a bullish sign, a buying sign. So it's not fully an engulfing candlestick, but it is something to take note of. You know, that might give us a little bit more note on that. Though I wouldn't put a lot of weight on it, it's something to notice. But another thing to notice is look at this in our more recent term here. Might we be in a rectangle? Let me put some lines on here and let's talk about that. And the rectangle, then we can kind of trade on that rectangle. So let's say we're down here and we're really looking at these last couple ones, let's say, maybe right around here. All right, so there's a line there, and let's put a top part of our rectangle here. Oops, let's go here, and let's see how these are all kind of tight at the top here. Let's go right here. Okay, so if we look at this, you could say, well, from here, we had this go up in profit or in price. It came down, approached this line here, which would be a support line, and bounced off it and went back up. But then it came back down and bounced off it again. So that's a touch. That's a first touch. These guys got in there, got close. Maybe we don't count that as a touch, but you know, we can see that we're still above this support line. It's not breaking through this level of 87 at 84. By the same token, at the top, our resistance line, 95.88, you can see how it's touched here. These are both pretty close. You can almost count that as 3 touches. Though a better way to do it, maybe to consider this as one big touch, might be another way to look at it. But either way, it's tried to bust through this support line, or excuse me, resistance line, and wasn't able to. You know, the bulls, the buyers said, let's get up high here. Let's go past this. And they're like, no, we got to bring this down. Still closed higher, but it didn't go past. Then the same thing, we got up higher, but closed down lower, actually, lower again. And then even, again, approached that line, and then closed down here at lower, at 93.36. Lower again, then we had our big gap down, and now we're down here. But, and we're coming here, is that close enough for a touch? Is that close enough, you know, in your mind? What it is, that's a one, that might be from here, 1, 2 touches. Maybe this is close too. So this might be a burgeoning, you know, support line in here. So what does that mean for if we wanted to trade it today? Right now, we know we've got definite downtrends. We know we got, or not definite downtrends, but we've got some downtrend ideas. We've got some uptrend ideas. We're kind of in the middle. Our RSI was not telling us anything other than it's middle of the road, not an overbought or oversold situation. We've got an earnings announcement coming up. So maybe we're thinking like, well, if this does go down, maybe it's going to bounce off that support line. And that could be a way we could trade this today and then put a stop loss, you know, in relation to that support line. But by the same token, if this continues the uptrend, we could buy in today and ride that nice uptrend and then see what it does up here. If it bursts through here, we're going to like keep riding that pony, so to speak, because now we're on a definite uptrend because we burst through a resistance line and we've got an uptrend going, right? So that would be a good thing. But if it starts turning down, we can say, okay, it looks like we're turning down, headed maybe down towards back to the resistance line. We could sell in here, for example, to capture this profit and then kind of repeat that process. So with that said, let's put in a buy order, paper trading for fun. Let's see what we can do here, right? So let's say we're going to take a little risk on it. Maybe we wouldn't put as much money in it or you know, as we might normally, whatever your trading plan is, but let's say we're going to put in some. So we're going to go in and we're going back here and we're going to do our buy again. All right, so now we're at 91.62 something. And let's say we normally would buy like 100 shares of this. I'm just, you know, this is paper trading, and we would buy for 91.60. Let's say we normally would buy 10 shares. It'd be 915, you know. So let's keep it small. Let's say it's 915. So we're going to, you know, trade for 915, but we're not sure we want to risk 900 bucks on this guy. So we're going to put in 5, right? So we're going to bring this down to 457. All right, so that's what we would buy it at approximately. This is still changing. We haven't placed our order yet. Now, we could put a target level here. That's the take profit level. And we could put a target price in here. But I don't want to do that in this situation as much because I could say a target up in here, but I'd rather see how that runs out. I don't want to sell too early when I might break through a support line. If anything, I know it's going to come back. So if it bounces off that, resistance line, if it goes past that resistance line, breaks through the resistance, I want to keep riding that. So I might not put a target price in this particular one. But what I might definitely want to do, and I always want to do, is put a stop loss in, right? So I'm going to choose a stop loss. So my stop loss, because I got this earnings sound, there's a lot of things that are going on here. I might say, okay, I've got my support line here around 87.87 or 87, 80 something. And I'm like, well, if it gets to here, I don't want to sell because it might bounce off this and go back up. In case I haven't evaluated this correctly or things can happen. Maybe the earnings announcement turns us down for a little bit, so it turns it down. but if it bounces off that support line, I don't want to sell too soon. So I might put my stop loss below that support line. Maybe I put it like, let's say 5% below that support line. So let's say approximately 87, half of that would be, well, 870, let's call it 9, 450. So let's say instead of 87, we might put it at 84. Let's put it at 84, is what we want to put our stop loss in. So let's put in 84. So as you can see, whoops, not 9,184, 84.00. All right. So let's say we're putting this in at 84. So that means if it got down to this 87, I'm not selling it. I needed to go down even further to get down to that 84. So it'd have to really truly break through that resistance line. Then I just want to get out, right? All right, so this looks good. I'm not putting an upper target. I've got a stop loss in there. We'll see how this does. I put in a smaller quantity because I'm getting so many mixed messages. I might not even want to trade this, but I might trade this rectangle a little bit. Let's see what happens. That earnings announcement is going to be important too, so we'll have to watch for that. So we'll see how this ends up doing, but for now, let's go ahead and we're going to buy. We're going to click that. It's going to do the buy. Over here, you're going to see that the orders are placed as paper trading, so they're all being executed pretty much immediately. See how it's executing all that. I got my market order and I got my stop loss. I could have put limited orders in too, but market order, I basically, did that all at the same time. So if I've now bought this, you can see that I bought it, and and if I go under my paper trading account here, I open my paper trading panel. You can see I bought some Johnson & Johnson a little while ago, and then I've got some Activision here. And right now, it's so early, don't even look at this, but you can see we're kind of right there. As far as the average fill price was 91.60, so that's nice. Stop loss at 84, and then we can kind of evaluate from there and be watching that. So there you go. We took a risk on Activision there, and we'll see how they do. So what type of trader do you want to be? Well, you probably already answered that. Like, I want to be a good trader. I want to do really well. Well, I do. I want you to do well too. That's the purpose of the course, and I hope the course really helped you to do that and helped you to do that. So we want to all be profitable traders, of course. But there's different, kind of categories of where people fit as far as a trading style, and it's not an exact science, by the way. And it really kind of develops over time, actually. People sometimes come in saying, well, I want to be this type of trader, but then as they start actually trading, they find that they're maybe actually and are more of a different type of trader. So the key on that is, and we'll give some examples of these trading types here in a second, is if you're not sure, you don't have to try to have one that fits, right? You can try different ones and see what fits, right? And see what fits. And that's the nice thing about things like with paper trading, where you can practice with fake money. You can try different trading styles that we'll talk about in the next slide and see, well, what fits for you. And if you find you don't like it in the paper trading aspect, well, then adjust it and see what fits you. And you can always change your mind. And life events, come up where you might need to change your style because, something has changed in your personal life, and you might have less time to devote to trading, or you might have more time to devote to trading, and that can really impact your trading style for sure. And that's where time frame comes in. So again, you don't have to have it like sign right now on the dotted line, I'm this. You can adjust as you go. So what are we talking about here? So if we think about time frames, this is a way a lot of people will define the type of trader you are. And it really is a matter of looking at the time frames on how frequently you're trading and looking at what types of time frames you're using for your analysis, what type of, with your technical analysis. As you recall from way back at the beginning of the course, the technical analysis works no matter what time frame. It's just you need to choose the time frame and be consistent with that as far as then applying the tools. So if you look at time frames, you could be different types of traders, right? So one type was what's called like a scalper, or some people refer to as an arbitrage. There's different names for all these, by the way, but these are the most common. So a scalper would look at things in minutes, right? They're not looking at days or even hours. They're trying to get little bits of profit and doing a lot of frequent trading, and they're doing scalping techniques and really trying to get in and out of trades real quickly. We had a lesson on guerrilla trading, for example, or guerrilla setups. Really it kind of looks towards scalpers particularly. A lot of people really like the idea of day trading, right? They're looking at minutes and hours. Day trading's been around for quite a long time, and it's a very legitimate way to do it. So they really like to this is more, you can almost think of it like their job in some cases, but or when they do trading, they're really looking at maybe a full day, and they're looking at minutes and hours, and they're closing their positions each day as far as a classic day trading, definition, so to speak. Swing traders might be looking at time periods of when they're setting up their charts and their technical analysis over hours or maybe over several days. So they're looking for these swings, these momentum changes, this kind of stuff. They're not doing it all within a tight time frame of minutes and hours. They're looking at hours and then stretching possibly out to days. So they're more looking for those swings and getting in and out with buying and selling around hours and days. A lot of people are very common as what's called position trading. You might also have termed like active trading. I like to kind of call it active trading, but it's position trading where you're looking at days to weeks. So you're really looking at those candlesticks with those open and closes, for example, because that's going to give you a full open and close with like things like candlesticks or the price bars. And you're really looking at days and looking at weeks as far as time periods, maybe over the course of a one full month, looking at weeks and looking at, as far as position trading. Investment timing, also kind of a form of active trading, but not as active as, let's say, day trading, is you're looking at that time from of weeks to months, right? You're looking at individual daily price bars, but you're really looking for those trends to really start become more established over a period, maybe even over several months period. And so you might be looking over several months as far as some of these longer term trends that you're looking at. And then a buy and hold investor is less of an active trader where the trading, where the tools come into play is their entry, their buy point. But they're less worried about putting in stop losses. They're less worried about even a security going down real significantly. They're holding for the long term, which could be many, many months. You're really looking at years, maybe multiple years, maybe forever, for example. And they're buying and holding through the big wide ups and downs because they know over time the securities will rise over time, is what they're looking at. But where they get in is when they can use all the stuff you've learned in the course. If you figure out you want to be more of a buy and hold, or you have a part of your overall portfolio that might be more buy and hold, and then you have another part that might be more position or swing trading, you can do that too. For your buy and hold part, you might be looking at when do I buy in? When's a good time to buy in? Is it undervalued, or does it look like a good buying opportunity? So as you see with each of these, this is where people say, well, I'm this type of trader, I'm that type of trader. Using this kind of time frames can help kind of understand, what we're talking about when people refer to that. That's the kind of the idea of the time frames. But the most important part of the takeaway from this is two pieces. One, your technical analysis, your tools, your indicators, and your plan and all that works no matter what type of trader you are, what type of security you're trading on either. It all works. It's just a matter of time frame on there. And also you can practice with your paper trading, and before you decide to do with real money a certain type of thing. If you think I want to be a scalper and you find this is just too much for me, too much active trading, and I'm getting a little nervous about it, well then back it down and become a day trader or a swing trader or whatever trader. You can always learn by your paper testing, and then you can always adjust at any period. And that's the last part of this, is you can always adjust in there. So if you went into this course thinking I want to trade like on this type of time frame, and you find out that you changed your mind, perfectly okay, but very common actually. And that's actually a smart move to do. Don't force yourself to be something that you're not comfortable with, or you're not. Be great at what you are. One nice thing about technical analysis when you're using it for trading securities is it can help really make sense of things that don't seem to be making a lot of sense at first, right? So it can actually, because it's based on supply and demand and market sentiment and momentum and all this other types of things that are around that, you can get a feel for what the market's thinking with an individual security, for example, that might not be as apparent for somebody who's just watching in the news or using other types of analysis. So technical trading can help you be a better trader. If you use fundamental analysis, is fine, and technical trading can help you be a better investor along those lines, but it also can help explain the unexplainable, so to speak. And let's use an example of this that I think is a real classic example that I think a lot of people struggled with during this period of time. So we're going to go in our time machine, all right? So we're going to go in our time machine, and we're going to go backwards in time, and we're going to look at a particular security. We're going to look at a stock security here. So we're going to look at, we're going to go all the way back, well, maybe not that far back, but we're going to go all the way back to the year 2020. Remember 2020, great year, right? COVID and all that. So you're going back to the year 2020. And one thing that happened in the year 2020 is Tesla. You may know them, of course, for their electric vehicles or EV vehicles. They do a lot of things too. And that's one reason their stock rose so much in 2020 was not just because of their vehicles, but also their batteries and other things that they could do potentially in the industry. And so in the year 2020, Tesla stock went up 700%. Now understand the typical stock market might go up, let's say 10% over longer periods of time. So something to go up in a year 700%, that's unusual to say the least. And it really had many people flummoxed, right? Many people are using fundamental indicators. I use fundamental indicators. We'll at times we'll look at it and say, wow, look, the price to earnings ratio is through the roof. This doesn't make any sense. Tesla's way overvalued. I mean, it went up 100%, which is a crazy high number, 100%. It was way overvalued then, and it later went up to 700%, right? And then common sense would say, and you'd hear the news media talking about, a rise that high, especially that fast, that's bound to fall, right? That's a bubble, right? The bubble has gone up so high so fast, it's going to burst and come way down. So if you buy at the peak, it's going to burst and you're just going to lose a whole bunch of money. It's a bubble, right? You'd hear a lot of articles and things around that. But actually, when we applied, I went back and I applied, if you look at some technical analysis, even a little bit of technical analysis actually showed a truer story of what was going on with Tesla and really around market sentiment and market sentiment indicators. So we're going to look at the Bollinger Band of year 2020 on Tesla. If you haven't seen that lesson, go back and if you watch this part, but if it doesn't make sense to go back and watch that lesson on or watch the lesson on Bollinger Bands, either skimming forward or ahead, Go watch that lesson on Bollinger Bands. Not named after me, by the way, Steve Ballinger. I wish it was. It's somebody else. But if we look at Tesla and look at Bollinger Bands, and this is the year 2020, and this is for Tesla. If you go to the far left, that would be January 1st of 2020, and you can see the price rise all the way to December 31st to the far right of it. And I don't have the price on here, but you can kind of see from the chart, there's definitely a definite upward trend. What we do know is it went up 700%, right? So if you look at it on the far left there, and we're using our Bollinger Bands, we can see that it definitely had a walking up the band, right? Our price is in a strong trend. It's walking up the band. That continued. So if we had bought on January 1st, let's say, we would see that, that really went up and walked the band. Now, once we hit in February and March, COVID becomes known as a global pandemic. Governments start taking action. Things are getting shut down. All securities went down, particularly stocks went down. And you can see that Tesla went way down and it actually walked the band down, right? It was walking on a downward trend of band. But then it came off that low after the first early COVID announcements, started to go to the middle, and then really had this long, strong, walking up the band with a squeeze in there. But even when it squeezed a little bit, it stayed on the band, on the upper of the band. It got narrower, but it stayed on the upper part of the band. And then we had walked up the band a little bit more, came off a little bit of a pullback there. And then right before the second squeeze, see how narrow that got, the second squeeze, and then it walked up the band again. And so now we're all the way up into whatever that is, September, October, and it starts to kind of flatten out there towards the kind of the last part of the year, and then the end of the year in a more of a squeeze type situation. I think you would see a lot of profit taking also really just from a money management standpoint towards the end of the year. And then one thing we know is in the first couple of days of 2021, Tesla stock had a little bit of sell-off because people were taking profits then. They didn't want to take them in 2020 because maybe they had, from a tax standpoint, had some good profits, so they took it later in the year. And that caused prices to kind of narrow and fall in the second squeeze, or the third squeeze in this example, or what really happened here with Tesla. So if we were to look at Tesla in the news media, we'd say, this is crazy, it's up 700%, this makes no sense at all, it's a bubble. But if we applied a technical analysis indicator to it, when it's looking at things like market sentiment, we'd say, no, this makes perfect sense. Look, it's walking up the band several times. There's a time when I maybe wanted to get out, right at COVID, wanted to get out of everything for the first COVID announcements. Other than that, it had a strong walk up the band. And again, if people are buying it, that means it's going to drive the price up. It doesn't necessarily always have to make sense, but it can be explained and understood and traded using technical analysis as a tool. So Tesla in 2020, fundamentals never made sense. I had people in my courses say, this doesn't make sense. Why is this going on? But if we apply that technical analysis, it kind of made perfect sense, didn't it? Because their buyers were really strongly buying and they were not coming off that. They wanted to buy and wanted that price to go up, and they stuck in there and they fought off sellers, they fought off short sellers, they fought off everything. They believed in the security, and then they rode that up. And if you bought in, January 1st and you rode it all the way to December 31st, well, you had a nice 700% gain. Maybe you could buy yourself one of those nice Teslas, as far as an automobile. So that's where sometimes what can happen is fundamental analysis is great. I love fundamental analysis, but this is also occasions when technical analysis can really explain what's truly going on from a market sentiment standpoint, and really more from a technical and a dispassionate, unemotional way. That 700% rise, people got very emotional either for or against. You want to watch people get emotional, think about that as far as what was happening with Tesla in 2020. But technical analysis gave us a different look. All right, upcoming here shortly is the top 5 action steps plus a nice bonus step. So you do want to watch that last lesson too. But we think about overall what we've been learning and how kind of pulling this all together a little bit and pulling from a couple parts of the course here to kind of look at it overall is considering your plan from a strategic and a tactical level. Strategy, think about the overall big plan, tactics being some tangible things you're going to execute with. So think big to small, strategy to tactics. And as you think through the course and think through your learning and thinking about yourself, think about your strategic plan first off. What are the indicators that you like that you're going to start using and all that? And these are the indicators of things that are going to help you select securities, right? They're the decision-making tools that are going to help you decide whether it's time to buy or sell based on indicators. And then you want to provide some discipline around that. Trading, a big part is all about discipline, and that's where your trading rules come in. That when this happens, then I'm going to do this, buy or sell, whatever, or after a certain period of time, or maybe I'm going to maximize my profit, minimize my loss. Either way, I have a trading rule. So an indicator is helping with selection. I have rules as far as execution. And then I have some things where I put in some targets and stops. Targets to really help me maximize my profits and knowing when to execute that target to basically maximize my trend, maximize my profits, and then sell and then maximize and then lock in those profits. But also we want to be effective in terms of minimizing our losses, because not everything's perfect, of course. So that's where our stops, our stop losses, our stop limits, different order types can help us with that to help minimize our losses. And the overall idea of the strategic plan is indicators help us choose. We have rules to provide discipline, and we have targets and stops to help with maximize our profit, minimize our losses. So altogether, they'll help us to be a successful trader. And then if we look at the tactical level, really getting back down to those 5 kind of tactic things to do, first thing you're doing is using your indicators to determine if a trend exists, right? Is there a trend? Can we trade on that trend? The trend is our friend, right? The most common thing said in technical analysis. And then we have rules around opening a position or buying. What does it mean? What has to happen? If we see a trend happening from our indicators, what are the rules that we have that we actually take action? And then we can manage our money as part of that too, as far as the tactics, and we can adjust our positions or create new positions and manage our money by scaling up or scaling down as far as adjusting our positions. And then we want to have rules for closing a position too, as well. We want to know when we get out, and we want to know, dispassionately, or excuse me, we want to know when we get in, and we dispassionately want to know when we get out. They both work together. When you're an active trader, you're using technical analysis, it's about getting in and getting out and doing that over and over again. The 5th part of your tactical plan is doing it again, tracking your results, knowing what your expectancy, ratio is, how much you can expect to make per trade, and you're putting that all together, and then you're doing over and over again. You have your broad strategy, you have your tactics, and you do it over and over again, and that's how you become very successful as far as trading securities. And then the main thing with all this, as we kind of get towards the end here, is be confident. Be confident. You're ready. You are. You've taken this course, right? You're ready. You're ready to succeed. If you feel apprehensive, it's okay. Practice with paper trading, use back testing, whatever it is. Start with small amounts. All that's okay. But I want you to understand that what you've learned in the course has set you up for success. And the main thing is you're ready. So you should feel great about that, right? You should be jumping for joy. You're ready. Go out there and take action and be excited about that. Be excited about when you have great trades. Celebrate them. Don't be dispassionate. At times when you have great success, celebrate those great successes. And then lastly, you think about too, have some fun too. You don't have to trade all day long. Sometimes you can go to the beach, right? So, have some fun too, but I want you to really be confident and feel confident that you're ready and to go have some fun in your trading and outside of your trading life as well. Congratulations, you've reached the end of the course. Way to go. You know, most people don't complete their courses on Udemy. It's a kind of funny thing that way. So the fact that you have means that you really stand out. And certainly from a trading, being a trading security aspect, that makes you stand out even more and really sets you up for success. So as we have this last lesson, we're going to talk about 5 key action steps to take, plus a nice little bonus step that's kind of nice to look at as well. So first off, as far as some action steps you can take right now, is review some lessons as needed. You know, things that you might want to have a little brush up on, or maybe you have some indicators that you're really liking, and you just want to watch those lessons again to kind of cement in your mind the knowledge around that and starting to put together that plan. And that's the second part, is put together your overall plan. You know, think about it from strategy to tactics, how you're going to, do all these different parts that we learned in here. So put together your overall plan and instill some discipline in there too as well, as part of your overall plan. And then the next step, you've got your lessons reviewed, you've got your plan. Now is the time to do paper trading. Review that lesson if you want on paper trading, where we talked about paper trading and back testing. Free ways that you can do to test your thoughts and ideas. Paper trading using fake money, go use that fake money, start using your plan now and see how it works out for you. And you can always back test your plan too to see how it worked over historical data. And then when you're ready to trade actual real money, it's okay, start small. That would be my recommendation, to start small. And as far as trading, don't be like overconfident and say, I'm really ready to go and put it all in on one security, right? Start small and do more, do a lot of trades to get more comfortable. The more trades you do, the more comfortable you'll get. So start with smaller trades, do lots of them, and then you'll see, you'll start getting confidence and knowledge as you do the actual trading itself. And that's the fifth idea, action step before the bonus step, is to continue your education. There's lifelong learning is very important. You'll learn by doing with trading. You'll learn other ideas too. And some ideas that you'll see out there, and boy, forums can get real crazy as far as all sorts of ideas. Use this course as your core, but if you want to kind of build on that, that's great. Continue your learning, continue your experience. That'll serve you well. And then lastly, as far as a bonus step, or maybe more of a favor, I guess, so to speak, is to please leave a review. That's very important to leave reviews. That gives me an idea of how the course is doing, but also, more importantly, it really lets other students, potential students, know about the course as well, too. So if you like the course, you thought it was great, thought it was a 5-star course, I hope you did. That's terrific. Please leave a review. That's as a favor to me and to others. Really appreciate it if you would go out there and click that rating button and please leave a review. And then lastly, thank you. Thank you so much for taking this course. Thank you so much for spending this time with me. I'm so grateful you did. And I really, really hope that this course has helped you become a more confident and better trader. That's the whole goal here. And that you can, make a good amount of money while you do it and have some fun too. So last thought of the whole course is, I personally want to say from me to you, thank you. Thank you so much, and best of luck to you, and best of luck to you in your future.